Hello friends, welcome to your ultimate crash course on the IIBF Certified Credit Professional Examination. In the next 4 hours, we are going to cover the entire syllabus from start to finish in the most concise, exam focused and easy to grasp way possible. This is not just another lecture. This is your step-by-step guide to mastering every concept, clearing every doubt and walking into the exam with complete confidence. So whether you are starting your preparation today or revising one last time before the big day, stay with me till the end because every minute here is designed to save your hour of study time. And yes, if you want my full premium course with detailed video lessons, theory notes, MCQs, previous year questions and capsule revision, just drop a WhatsApp message on this particular number as shown on your screen and I will personally guide you on how to get started. Alright, so let's dive into and take you from start to success in that is the documentation. So which says that always mention the correct date, correct place in all document. If terms apply from an earlier date, clearly state it, right? So this is the point. Second point, and the second rule says that keep the date uniform across the promissory note and the related paper. So mention correct date and place in all document and ensure uniform date across the promissory note and all the related document. This is very important for limitation period calculation. Third point is that if the parties signed on different day, so each must mention their signing date. Legally, the first execution date may also count. So that is what I am telling you. If the parties are signing on different days, each party must mention their signing date, on which date they are signing. Legally, the first execution day may also count. Then no blank should be left. You should fill in every detail like the interest rate, loan type, amount and security. Next point is complete all document in one sitting using the same handwriting, ink and pen before disbursing the loan. Include full borrower and co-borrower detail for easy traceability. Then in the case of in promissory note, right? So in the case of promissory note, do not list co-obligant separately. Lot treat them like co-borrower. So remember, in the case of promissory note, you should not list co-obligant separately. Law treat them like co-borrower. And finally, ensure that all signing happen under the bank supervision. Right? Never let borrower take document away for signature. So all the signing should happen under the borrower bank supervision. Never let borrower take document away for signature. Then we have the loan documentation. So friends, that every page must carry the borrower full signature at the end. Initials are not allowed. This confirms that they have read and agreed to the terms and keep their signature style consistent throughout. Any change, whether in addition or deletion or correction, they must be signed again in the same style. Then the next point is, no blank should be left and name must be spelled exactly right. Mistake can make the document invalid. For illiterate borrower, take a left thumb impression or right if necessary. It is legally binding. And then, if the borrower does not understand the language, explain the term and get a written confirmation from someone who does. Sometimes, the borrower does not understand the language. So it's your duty to explain the term and get a written confirmation from someone who does. So in addition to the above quick revision PDF, we have unit-wise theory and MCQ PDF also available. So you can also take help of that. In the description section, I have provided link of the course through which you can access those content. Also, there is a Telegram group of CCP where you can join and you can check out the quizzes. I have provided you free quizzes and also some memory-based topics are there from where questions have appeared in the examination. Please check out those links. Now friends, let's continue our discussion on the loan documentation. So what it says that that every page must carry the borrower full signature at the end, right? Initials are not allowed, right? That is the point. Now this confirms that they have agreed and read to the terms and keep their signature style consistent throughout, right? Any change, whether an addition, deletion, correction, must be signed again in the same style, right? I told you these are the very, very important point. Yes, so this is the point. And I told you that no blank should be left. Name must be spelled exactly right. Mistake can make the document invalid. And for illiterate borrower, I told you, for illiterate borrower, obtain a left thumb impression or right if necessary. If the borrower does not understand the language, explain the terms. Then let's talk about the loan documentation. So basically, for illiterate borrower, note LTI, RTI of Mr. or Mrs. whenever thumb impression are taken. So friends, I told you that for illiterate borrower, you should note LTI or RTI of Mr. or Mrs. wherever thumb impression are taken. For Pardarshini women, right, ensure they fully understand the terms. Get a declaration from an unrelated woman who know the language. Then we have the branch manager. The branch manager must sign wherever required, and the branch location in the document set the legal jurisdiction, right? Then we have, if you are signing in different state, the borrower should write the place name under their signature. Witness must sign after the borrower in their presence and only to confirm the signature, not the content, right? So witness sign to confirm the signature, that yes, I confirm the signature. Then a party to the agreement cannot be a witness. As you can see, a party to an agreement cannot be a witness. Then attest only when legally required. Unnecessary attestation can mean extra stamp duty, and agreement should never be attested. Remember, these are the very, very important thing that we look at, that we keep in our mind. That attestation should only be done only when legally required. Unnecessary if you attest, what will happen? That it may attract extra stamp duty. Agreement should never be attested. Then some more points related to the loan documentation. So I told you that bond must be attested and carry the proper ad valorem stamp duty. For example, mortgage deeds, they require attestation. So I told you that bond must be attested. Next point is a witness must see the signing or get acknowledgement from the borrower, and at least 2 witnesses are needed, though not at the same time. So what I am telling you, that a witness must see the signing or get acknowledgement from the borrower, and at least 2 witnesses are needed. Now one more point is that at least 2 witnesses are required, though they need not be present together. Now if a document that legally need attestation is signed but not attested, it is called invalid. Suppose there is a document that legally require attestation, right? So a document legally need attestation and it is signed but not attested, it is invalid. So when witnesses are missing, proof of one witness handwriting and the borrower's signature is enough. Suppose witnesses are attesting, right? So when witnesses are missing, no witness is there, then proof of one witness handwriting and the borrower's signature is enough. All duty liable document must be stamped before this is a very, very important thing, that all duty liable instrument must be stamped before or at execution, and the borrower pays the duty. So what I am telling you, that all kinds of duty liable instrument, they must be stamped before or at execution, right? So first of all, stamping should be done, and then after execution should be done. 2 words are there, stamping and execution, right? The borrower pays the duty. And then I told you that bank send printed form to the stamp office for a special adhesive stamp. So friends, the next point is basically all duty liable document must be stamped before or at execution. The borrower pays the duty. Bank send printed form to the stamp office for a special adhesive stamp, right? So for a special adhesive stamp, what bank do? Bank send printed form to the stamp office. Then we have sign and date only after the stamp paper is issued or a stamp is affixed. I told you first of all, you affix a stamp, you issue the stamp paper and then only sign, right? Never cut and paste stamp paper. Revenue stamp can also be bought from the neighboring state, right? So I told you execution and dating must be done on or after the issue of the stamp paper. So once the stamp paper is issued, right, or it is affixed, then only execution and dating should be done. Then we have some more points related to the loan documentation, revenue stamps duty. So revenue stamps are regulated by the central government, and unless restricted, it can be used even if bought from other state. Yes, so other state revenue stamp are also applicable unless restricted. Postal stamps cannot replace the revenue stamps. Some instrument have uniform stamp duty nationwide. Under the Indian Stamp Act, there are some instrument which has the uniform stamp duty nationwide, like promissory note, except in Jammu and Kashmir, right? So let's talk about what is the stamp rate. So for loan less than rupees 250, 10 paise, above 250 to 1000 it is 15 paise, and above 1000 it is 25 paise. Other instrument like agreement, power of attorney, AOD and mortgage bonds, they fall under the state list. So the rate vary, right? So some things like a revenue stamp fall in the central duty, so it is uniform across all the state except Jammu and Kashmir. So that's why I told you that one state stamp can work in the other state, one state revenue stamp can work in the other state also, and these are the rate, right? Now the next point is, basically where pledge letter attract duty, ensure that they are stamped correctly. Sometimes pledge letter also attract duty, and this you have to ensure that they are correctly stamped. Now there is something called Section 11 of the Stamp Act 1989. So this Section 11 of the Stamp Act 1989, it says that adhesive stamp can be used on pro notes, even if note is on an impressed paper of proper value. Now a stamp is considered properly cancelled if it is clear it has been used and cannot be reused by an ordinary prudent person judgment. That is what I am telling you, that if the signature is only on the stamp or just a line across it, cancellation may be invalid, risking misuse. Suppose the signature lie wholly on the stamp without touching the document. It is on the stamp, it does not touch the document, or only a single line appear over it, cancellation may be deemed ineffective, allowing potential reuse. Right? So that is the point. These are the very, very important thing which we have covered just now. So I told you that revenue stamp, how does it work nationwide? So where pledge letter attract duty, ensure that they are stamped correctly. Adhesive stamp can be used on pro note, and a stamp is properly cancelled only if it is clear that it has been reused and cannot be reused again. Now we have the next point, that is charge creation and registration guidelines. So what does it say? There are two kinds of charge, right? So some more points are there, like no modification filling. So let's understand all these points. So it says that no modification filling is needed when bank limits are apportioned among branches. Filling ones with the ROC for the company registered office cover all the fully sanctioned limit. For DALC, DPG, co-acceptance case where goods or machinery are hypothecated, creation and registration of charge is mandatory. So in some cases like DPG, deferred payment guarantee, co-acceptance, in such case what happen, the goods or machinery, they are hypothecated. Since these things are hypothecated, so we have to create charge, we have to register charge. This is the mandatory thing. Section 77 Companies Act 2013 says that charges requiring registration must be filled within 30 days from creation. See, two things are there. First is the creation of the charge, and second thing is the registration of the charge. So what I am telling you, that charges which require registration, they must be filled within 30 days from the creation. Then we have the section number 77 of the Companies Act 2013. So it says that charge must be filled within 30 days of the creation. You know it very well. Now if you miss the 30-day window, so you can still file within 300 days using form CSG1 with extra fee. Right. So if the filling cannot be done within 30 days, you can submit form CSG1 to ROC within 300 days using form CSG1 with extra fees. Right. So that is beyond 300 days. So time extension require regional director approval under the terms set by the central government. Now, but beware that late registration can mean loss of priority, and early registered charges stay protected even if you file later. The delay, any kind of delay can put the bank security at risk. So if you file beyond 30 days, what will happen? It does not override earlier registered charges. Bank security may be at risk. So delay can put the bank security at risk. Then we have the loan documentation. Since late registration approval lie only within the regional director. Remember, any kind of late registration approval, they lie only within the regional director. So banks should register charge with the ROC immediately after creation. So once the charge is created, registration should be done immediately. Why? Because the late registration approval lie with the regional director. Non-compliance can cost the company 1 lakh and to 10 lakh rupees. An officer may face up to 6 months in jail, fine, or both. That is why once you create the charge, it must be registered, right? Although filling is the company's duty, the bank can also register the charge in its favor, right? So that is the point. Also, the document filling is the duty of what? Duty of whom? It is the company's duty. However, the bank can also register the charge in its favor. And if any charge is unregistered, which is called unregistered charge, an unregistered charge is void against the liquidator and creditor. So turning a secured loan into unsecured debt and losing the priority. So what I'm telling you, that any unregistered charge, it become void against the liquidator and other creditor. It makes the debt unsecured and losing priority over subsequent charge. Then let's discuss registration is required for what. So registration is required for pledge facility and documentary letter of credit with goods in the bank custody. So registration is mandatory for pledges and pledges and documentary letter of credit where goods are in the bank possession. And registration is also necessary for letter of credit and guarantee where securities are charged to the bank. Now under the rule 3 of the Companies Act 22 Companies Rule 2014, first point is you should file modification of charge if credit facility shift between branches even across ROC jurisdiction or when a second charge is created on asset. So when modification of charge should be filed, two cases are there. First case is that if credit facility shift between branches, two branches are there and the credit facility is shifting between them, then we should file the modification of charge. Or second case is that when second charge is created on the asset, then we should file the modification of the charge. Then the next point is if the main and sub limit paper are signed on different date. See, two things are there, main limit paper and sub limit paper. So if these two paper are signed on different date, you should file separately. Same date need only one filing with all the securities listed. So what I am telling you, if the loan paper for the main limit and the sub limit, they are executed on different date. So what happen in that case? File separately. Same date need only one filing with all security listed. Then procedures and timeliness are the same as original charge registration, right? So for modification of the charge, the procedure is the same and timeliness is the same. Now once dues are cleared, right? Once dues are cleared means once dues are fully paid by the borrower, satisfaction of charge must be filed with the ROC within 30 days. That is a very important point. Once dues are fully paid by the borrower company, satisfaction of charge must be filed with the ROC within 30 days, right? And the satisfaction of charge will be filed using the form CHG4, section number 82. Remember it, this is a very important point, that once dues are cleared, satisfaction of charge must be filed with the ROC within 30 days using the form CHG4. And if the bank file it, no show cause is issued, right? So that is what, suppose the bank file the satisfaction of charge, so no show cause is issued, and if the company file it, ROC may seek clarification. So what I am telling you, that suppose dues are fully paid by the borrower, then satisfaction of charge must be filed within the ROC within 30 days using form CHG4. And if the bank file it, no show cause is issued, and if the borrower or the company file it, ROC may seek clarification. Now no modification is needed for variable interest rate change. Then we have the laws of limitation. What it says, that it set the legal time frame to sue. After expiry, right remain but remedies vanish. See, basically when we talk about laws of limitation, what it is all about, it set the legal time frame to sue, right, after expiry. So right remain but remedies vanish. Lien right stay intact but bank can't recover through court once time bad. To keep the case alive, get a written acknowledgement of debt before the limitation period end. So laws of limitation, I told you, this is the legal time frame to sue, right, and it is done after expiry, right? So right remain but remedies vanish. So it does not create any right, only restrict remedies after the, I told you na, right remain but remedies vanish. So lien right stay intact. So that is the point, lien right remain unaffected, but bank can't recover through court once time is barred, right? To keep the case alive, so you should get a written acknowledgement of debt before the limitation period end. So suppose limitation period is going to end, what you should do? You should get a written acknowledgement of debt before the limitation period end. So that laws of limitation said that legal time frame to sue, to keep the case alive, get a written acknowledgement of debt before the limitation period end. Now friends, the next point is limitation can be extended, which means limitation can be extended if the borrower or authorized agent make a part payment before expiry. So before expiry, if the borrower or authorized agent, they make a part payment, then limitation can be extended, right? So for that signed proof is a must. Now one more point is, once expired, only fresh document start a new period. So once the document get expired, right, so for once it is expired, only fresh document start a new period. Now let's look at some of the key limitation period, right? So like DPN, demand promissory note, 3 years from the DP note date. Bill of exchange at site, 3 years from presentation. Usage bill, 3 years from due date. Money lent, 3 years from loan date. Guarantee, 3 years from invocation. Mortgage, 12 years from due date. So mortgage two kinds. Payment enforcement, which means enforcement or foreclosure, then 12 years from due date. And mortgage for possession, in that case 30 years from entitlement, like possession of the immovable property. So mortgage 30 years from entitlement. And suppose the last day fall on a count holiday, filing is allowed on reopening day. This is a very important thing. Now, time abroad does not pause limitation. Suppose you have spent the time abroad, so it will not pause the limitation. Now, guaranteed acknowledgement must be within 3 years of invocation. Very, very important thing that you have to obtain the guaranteed acknowledgement within 3 years of invocation. And one more point is that in the case of cash credit, you know what is cash CC account? Limitation is 3 years from the last genuine transaction, excluding interest debit, right? So from the genuine last transaction, limitation period is the 3 year. Balance sheet liabilities and acknowledgement of securities extend limitation if done in time. Now there is something called time bar debt. Time bar debt voluntarily paid can't be reclaimed, and a written promise to pay remaining binding. So that is called what I'm telling you, that in cash credit account limitation is 3 year. Balance sheet liability signed by authorized company agent, they act like a debt acknowledgement, right? So balance sheet liability and acknowledgement of security, that is called AOS. So remember, two things are there: balance sheet liability and AOS. What is AOS? Acknowledgement of security. They extend limitation if done in time. And time bar debt voluntarily paid can't be reclaimed, right? So suppose debtor has paid any time bar debt voluntarily, they cannot be reclaimed. And one more point is and written promise to pay remain binding. Remember, these are the very, very important topic. Then we have the loan documentation limitation act key principle. So that section 3 bars the remedy, not the right. Section 3 only bar the remedy. Section 3 does not bar the right. Court must dismiss case filed after the limitation period, right? Court must dismiss any kind of case which is filed after the limitation period. Then we have the section number 19, which says that any part payment of debt or interest restart the limitation from the payment date. Delays can be condoned if sufficient cause is proven. So two sections we have talked about. Section number 3, which bar the remedy, it does not bar the right. Court must dismiss case filed after the limitation period. Section number 19 says any part payment of debt or interest restart the limitation from the payment date. Delay can be condoned if sufficient cause is proven. General rule says that limitation law block remedies, not the right, except section number 27 on adverse possession, where long continuous possession can give legal ownership if the true owner failed to act. So general rule says that limitation law block remedies. Limitation law does not block the right. And there is a special section which is called 27, which is an exception to this rule, right, where long continuous possession can give legal ownership if the true owner failed to act. Now, for the acknowledgement of debt, that is called AOD, the fresh limitation start from the acknowledgement signing date, not the debt date. Two dates are there: acknowledgement signing date and the debt date. So what I am talking about, for the debt acknowledgement, fresh limitation start from the acknowledgement of signing date, not the debt date, right? So these are the very, very important aspects which I have talked just now. Section 3 bars the remedy, not the right. Section 19, any part payment of debt restart the limitation from the payment date. General rule says that limitation law block remedies, not the right. For acknowledgement of debt, the fresh limitation start from the acknowledgement signing date. These are the important points. Now friends, let's look at the types of charge that we have. So a charge is a creation or transfer of an interest in an asset, right? So either you are creating interest in an asset, or you are transferring the interest in an asset. So what are the different types of charge? Mortgage, hypothecation, pledge, lien, assignment. So hypothecation, it is a floating charge. Borrower keep possession, right? Hypothecation means floating charge, borrower keep possession. Pledge means goods given as security, lender hold possession. So pledge means bailments of good as security. In this case, lender hold possession. While in case of hypothecation, borrower keep possession. What is the lien? Lien is the right to retain collateral until dues are cleared. So this is the right that the collateral should be retained until dues are cleared. Sales only if the contract allow it. That is the lien. Next we have the mortgage. Mortgage means interest in immovable property transferred to secure a loan. Then we have the assignment. Assignment means ownership or right like receivable, insurance, share transferred via deed. Then we have the fixed charge. Fixed charge is created on asset with unchanging identity like land, building or machinery. So we have talked about charge. I told you that charge is a creation or transfer of an interest in an asset. Hypothecation, in case of hypothecation, what I told you, that hypothecation basically is a floating charge in which borrower keep the possession. Pledge means goods given as security, lender hold the possession. Lien means right to retain collateral until dues are cleared. Sell only if the contract allow. Mortgage means interest in immovable property transferred to secure a loan, right? Assignment means ownership or right transferred via deed. Fixed charge means on asset with unchanging identity like land, building and machinery. Now let's look at the types of charge, right, and mortgage. So the first thing, I think we have discussed this floating charge. So when we talk about floating charge, floating charge covers such kind of asset that keep changing, like swap stock. You can use or sell them until the bank steps in. Then we have the simple mortgage. What happens in the simple mortgage? You keep the property but promise to repay. Bank can get it sold through court if you default. Mortgage by conditional sale, which means what? That it looks like a sale but it is not. If you default, it become permanent. If you pay, it get cancelled. Then usufructuary mortgage, which means bank take the property's income instead of the cash repayment. And then we have English mortgage. You promise to repay on a set date, transfer the property to the bank and get it back once you pay. That is called English mortgage. Equitable mortgage means just hand over your property title deed in certain cities to create security. Partial deed means missing some document. You can still secure a loan with a registered memorandum. So now let's look at some other types of mortgage. We have anomalous mortgage, which means a mix of different mortgage type like combining rental income right with the power to sell. Then we have mortgage versus charge. Mortgage transfer a legal interest in the property, right? So what is the difference between mortgage and charge? Mortgage transfers a legal interest in the property. A charge just give a security right. No ownership is shift. So what is the difference between mortgage and charge? Mortgage transfer a legal interest in the property, while charge just give a security right. No ownership shift in the case of charge, right? While mortgage transfers a legal interest in the property. Now, sub-mortgage, when a lender mortgage their own mortgage right to someone else, that is called sub-mortgage. Poison mortgage, which means a second loan on the same property. First lender get paid first. Then we have right against clog on redemption. You can't be stopped from reclaiming your property after repaying in full. Suppose you have made the repayment in full, so you can't be stopped from reclaiming your property. Then we have the foreclosure. What happens in the foreclosure? Bank take over and sell your property after default. That is called foreclosure. It's kind of legal process where lender take ownership and sell mortgage property to recover the loan dues. Then we have the right of redemption, which means your legal right to get your property back once the loan is cleared. So you have cleared the loan, so it's your legal right to get your property back. Then reversion. Reversion means honor interest that return after a temporary right end, like after a lease. We have the reminder. Reminder means full future ownership that that given to someone after another person limited right end. So suppose any person limited right end, then future ownership which is given to someone is called reminder. Then we have the reverse mortgage, which means bank pays you in installment using your home value, which is popular with the seniors, right? That is called reverse mortgage. So SARFAESI tips is that where SARFAESI Act is applicable. So simple mortgage can't be enforced using SARFAESI. Use equitable mortgage when possible, except for agriculture land, right? With MOTDD. Right. So if you use a simple mortgage, then SARFAESI Act will not apply. Then we have the next point, credit monitoring. So credit monitoring means keeping an eye on the loan to ensure that money is used for the right purpose and bank stays in control. So credit monitoring starts right from choosing the borrower and continue until the loan is fully repaid. So what are the key tools for credit monitoring? Like balance sheet, stock statement, site visit, operational report, progress update, right, for guarantee or term loan. So these are the code monitoring tool like balance sheet, stock statement, MSOD, QOS, HOS, progress report, PIPR. Now follow-up kicks in after disbursement, which makes sure that repayment are done on time, conditions are met, and problem accounts are fixed quickly. That is called follow-up kicks after disbursement, right? So it makes sure that repayment are on time, conditions are met, problem account are fixed quickly. Now what are the methods for credit monitoring? Site visit, reminder, checking turnover in account. Low turnover can be an early warning sign. If the turnover is low, it's kind of early warning sign. Now, so these are the typical methods which are used. Now you know that for cash credit limit, yes, for cash credit limit, borrower must submit stock statement regularly to set drawing power, especially for export loan. Then remember, inventory limit are simply the maximum credit allowed against stock and receivable. So inventory limit refers to the credit facility maximum which is allowed against inventory and receivable. So now let's talk about the credit monitoring. For manufacturer, inventory includes raw material, work in progress, finished goods, packing material, and spares. For trader, it is mainly finished goods and some kinds of packing material. So for manufacturing, inventory is different. For trading, trader inventory is different. What is MSOD? MSOD is monthly select operational data. You know, MSOD is mandatory for manufacturing unit with limit over 10 lakh along with the stock statement. Right, remember, very important point telling you, MSOD is mandatory for manufacturing unit with limit over 10 lakh along with a stock statement, and DP is called drawing power. It is the borrowing limit based on the stock. Right, so DP is the drawing power, is the borrowing limit based on the stock. Remember, two things are there: DP drawing power, DL drawing limit. Right, DP is the borrowing limit based on the stock. If DP is higher than the DL, you can draw only up to DL. Right, so DP is higher than the DL, then you know, drawing capped as DL, you can draw only up to DL. If the DL exceed the sanction limit, the cap is the sanction limit. Right, so if the DP exceed DL, you can draw up to DL. Right, and if the DL drawing limit is higher than the sanction limit, so drawing capped at the sanction limit. These are the very important thing. Now we have the QS. What is QS? You know, QS is quarterly operational statement, operating statement, and HOS is half yearly operating statement. They show the performance, they show the fund use, they show the liquidity. Right, for multi-divisional borrower. Right, so they get both division wise and total figure also. In QS, what happen? You know, compare net working capital with the previous quarter. If it is down, act fast. So in the QS analysis, which we call as quarterly operating quarterly operating statement. In the quarterly operating statement, you should compare NWC, which is the net working capital, with the previous quarter, and if it is down, you should act fast. Then HOS has two parts: operating result and fund flow. Right, so operating result and fund flow. Fund flow is a red flag. So QS stand for, you know, quarterly operating statement, right, and HOS stand for, you know, half yearly operating statement. So QS and HOS, they show the performance, right, they show the fund use, they show the liquidity. So QS basically compare current quarter net working capital with the previous one. Right, that is called quarterly operating statement, and HOS stand for half yearly operating statement. So both of them show the performance, fund use and liquidity. For multi-division firm, you know, get both division wise and total figure. So what happened in the QS? You know, you should compare net working capital with the previous quarter. So compare NWC with the previous quarter. If it is less, right, it means you should act fast. And HOS also has two parts: operating result and fund flow. So HOS has two parts. First part is the half yearly operating result. Second part is the fund flow. It is a red flag if long-term use exceeds short-term source. If long-term use exceeds long-term source, it means short-term fund are being misused. So quarterly operating statement and half yearly operating statement, right, both has to be obtained. They show the performance, fund use and liquidity. For multi-divisional firm, get both division wise and total figure. In QS, you should compare the net working capital with the previous quarter. If it is down, you should act fast. And HOS has two parts. HOS has, you know, first of all, it shows the operating result, and second thing is the fund flow. Right, so fund flow statement and operating result. It will be red flag if long-term use exceed long-term source. It means short-term fund are being misused. So you know, these QS and HOS reports reveal if operations are profitable and if working capital is being diverted or not. Now friends, let's shift our focus to the provisioning norm. You know, RBI prudential norm based on global standard and the Narsimhan committee ensure bank keep financial statement transparent and accurate. You know it very well that a loan become NPA, that is called non-performing asset, when it stop earning income for the bank. So remember, when the loan stop earning income for the bank, right, then it become NPA or non-performing asset. Right, so what are the criteria for NPA? When NPA trigger? So first of all, take the case of term loan, which means interest or principal overdue for more than 90 days. So if the interest and principal overdue for more than 90 days, the NPA trigger. Or if it is OD and CC account, so if the NPA trigger, if they are marked out of order, if limit are breached for 90 days. Right, then we have the bill purchase and discounted. So if they are overdue beyond 90 days, then NPA trigger. If it is a short duration crop, so if they are overdue for 2 crop duration, then you know, NPA trigger. If it is a long duration crop, then if the principal and interest are overdue for 1 crop season, then NPA trigger. What is the rule for interest? So you know, if interest for any quarter is not fully paid within 90 days from the quarter end, account become NPA. So what I'm telling you, if the interest payment rule is that an account become NPA if interest charged in any quarter is not fully paid within 90 days. Then we have the out of order. Out of order means account balance stay above sanction limit or drawing power for 90 continuous day. That is called out of order. So which means account balance stay above the sanction limit for 90 day continuously. That is called out of order account. Then let's look at what are the condition for NPA under the out of order case. So you can see account is out of order even within this limit if for 90 days there are no credit. So suppose balance is within the sanction limit, balance is within the drawing power, but account is treated as out of order if for 90 continuous day there has been no credit at all, right? Or credit can't even, credit is insufficient to cover the interest charge. So if these two conditions met, then account is called out of order. What is the meaning of overdue? Overdue means any payment not made on its due date. That is called overdue. Then we have the income recognition rule, which says that no interest on NPA can be booked as income until it is actually received, even for government guaranteed loan also. What I am telling you that interest on NPA should not be booked as income until realized. This is a very, very important thing. Until you received it, you should not. No interest on NPA can be booked as income, even for government guaranteed loan also. But there are some exceptions, like interest on loan against term deposit, NSC, KVP, life insurance policy can be counted if there is enough margin. Now there is something called reversal of past interest. When an account turns NPA, reverse all uncollected interest, even the past period interest. Stop charging new interest to the income. Record it only in the memo account. Stop accruing fee or commission. Then we have asset classes. So I told you, if we talk about the asset class, the first class is called standard asset, substandard asset. Substandard asset means NPA for 12 months or less with the sign of weakness. And then we have the doubtful asset, which means NPA for more than 12 months with recovery highly uncertain. What is a loss asset? Loss asset is one the bank, auditor or RBI identify as unrecoverable but not yet written off. Then we talk about the securities value or the borrower net worth. So security value or the net worth does not decide NPA rule. Security it is completely based on the actual recovery. So remember, security and net worth is not a deciding factor in NPA classification. So what is the basic of classification? It is based on the actual recovery record. What about the temporary deficiency? Some kind of small issues like missing DP, right? Missing non-availability of drawing power, or slightly limit access or delayed stock statement don't automatically make an account NPA. Remember, this kind of temporary deficiency or a small issue like missing DP, slight limit access or delayed stock statement, they don't automatically make an account NPA. Now, but if the stock statement are over 3 months old, DP become invalid, and if the drawing stay irregular for 90 days, it is called NPA. So small issues like missing DP, slight limit access, delayed stock statement don't automatically make an account NPA. But if it remain for a longer day, 3 months old, 90 days, DP become invalid, and if the drawing is stay irregular for 90 days, it become NPA. Now loan limits must be renewed within 180 days. That is called limits renewable. Loan limits must be renewed within 180 days, otherwise the account become NPA. Then we have, if one facility of borrower is NPA, all other facility become NPA. In the case of consortium loan, each bank classify independently, but late recovery transfer from the lead bank can still cause NPA in other member book. Then we have the next point to the context of consortium loan, right? In the case of consortium loan, each bank classify independently, but late recovery transfer from the lead bank can still cause NPA in the other member bank. And finally, suppose the security collapse, right? Suppose the security is collapsing or missing or fraud is found, bank can directly classify it as doubtful or loss asset without waiting. Now let's look at the NPA classification, security erosion, agriculture advance and special cases. So if the security value drop below 50%, you should classify the loan directly as doubtful. If it is under 10%, skip the security, you can call it the loss asset. Remember, very, very important point of talking about, if the realizable value of security fall below 50% of the loss asset or accepted value, you can classify it as the doubtful asset, right? And if the realizable value is less than 10% of the outstanding asset, ignore the security and directly call it the loss asset. In fraud case, make full provision for the entire due amount immediately. For PACC, PACS, FSS on lending, only the specific defaulting loan is NPA. 2 crop season for short duration, one crop season for long duration. But in the direct agriculture loan, if one facility is NPA, all become NPA. These are the very important thing. Some loans are there which are exempted from the NPA rule, like those security against the term deposit, NSC, KVP, IVP, and life insurance. If margin is adequate, no such break for loan against gold or government security. So what is the agriculture loan NPA norms? If it is short duration crop, NPA after 2 crop season overdue. If it is long duration crop, NPA after 1 crop season overdue. For rural housing tied to crop, repayment should match the crop cycle. Right. So for rural housing tied to the crop, right, like Golden Jubilee rural housing loan, right. So what in such case, what is the rule? Repayment should match the crop cycle. Then we have some special NPA classification and provisioning rule. Loan guaranteed by the central government become NPA only if the guarantee is invoked and repudiated. But remember, that does not exempt income recognition rule. So what I am telling you, that central government guaranteed loan, which is the loan guaranteed by the central government, they become NPA only if the guarantee is invoked and repudiated. But remember, it does not exempt income recognition rule. For a state government guarantee loan, since March 2006, overdue beyond 90 days, it means NPA. Export credit covered by Exim Bank, if payment come within 30 days of invoking the guarantee, no NPA tag. So suppose payment comes within 30 days of invoking the guarantee, no NPA tag. In the political risk case like war or embargo blocking remittance, NPA tagging can be deferred up to 1 year from the date fund were credited abroad. So in the political risk cases like war or embargo blocking remittance, NPA tagging can be deferred up to how much day? Up to 1 year from the date fund were credited abroad. Now credit card due unpaid for over 90 days become NPA. Now let's talk about the provisioning, right? So loss asset write off or provide 100% provisioning. Doubtful asset you provide 100% provisioning for the unsecured part based on the realizable value. Let's look at the provisioning norms. So if it is doubtful secured portion, then provision depends on how long it has been doubtful. If it is doubtful up to 1 year, 25%. If it is doubtful, so we are talking about the secured portion only. For unsecured portion, it is completely 100%. However, for the secured portion, the provisioning depends on how long it has been doubtful. If it is from up to 1 year, then 25%. If it is 1 to 3 years, then 40%. And if it is more than 3 years, it is 100%. For large NPA, which means 5 crore plus, in that case, annual stock audit is a must, and property valuation every 3 years. Right, collateral valuation or property valuation must be done by approved valuer every 3 years. Then let's talk about the substandard asset. So for substandard asset, standard rate is 15%. If unsecured, then 25%. Right. So substandard asset general provision is 15%. If it is unsecured, then at 10%, which is 25%. If it is infrastructure loan with escrow, then 20%. And unsecured doubtful, it is 100% provisioning. Now unsecured exposure, which means it simply means if the security worth is less than or equal to 10% of the loan, then it is called unsecured. Only tangible properly charged asset count, no guarantee or comfort letter count. If we talk about the standard asset, what is the provisioning for a standard asset? So under farm credit, housing, SME, it is 0.25%. If it is CRE, 1%. If it is CRE RH means residential housing, it is 0.75%. Some more rules regarding provisioning is that standard asset provisioning are not deducted from the gross advance. They are shown separately in the balance sheet under contingent provision against standard asset. So they are not considered while calculating the net NPA. Medium enterprise, I told you, medium enterprise 0.40% provisioning rate. And floating provision cannot go back to the profit and loss. They are used only in exceptional cases, and until then they can offset gross NPA for net NPA reporting, or they are to be treated as tier 2 capital, which means up to 1.25% of the RWA. So we are talking about floating provision. First of all, floating provision, you cannot credit them back to the profit and loss account. First point. Second point, they are used in only an exceptional case, and until then you can offset gross NPA for net NPA reporting, or they have to be treated as tier 2 capital. Then we have for NPA with guarantee. So for ECGC, ECGC guaranteed doubtful asset. So provide only for the part above the guarantee after adjusting the security value. So provision is done. So we are talking about NPA with guarantee. So what I am telling you, for NPA with guarantee, suppose ECGC give the guarantee, right? So provisioning should be done only for the part above the guarantee after adjusting the security value. That means only those portion over and above the guaranteed amount, provisioning should be done. after deducting the realizable value of security first. First of all, you deduct the realizable value of security. After deducting the realizable value of security, you should do the provisioning only for the portion over and above the guaranteed amount. You know what I am telling you, numerical are asked based on these concepts. So once if your concept is clear, you can easily solve the numerical. We have a separate videos for numerical in our course. I provided you separate video of all the numerical possible in a single video. Now, if it is government credit guarantee scheme like CGTMSE or CRGFT LIH, so no provision for the guaranteed portion, the rest follow the NPA norms. Now, a special case are, interest suspense balance is not a provision. Remember, interest suspense balance is not a provision. Deduct it from advance first. Then we have RERFA. That means reserve for forex fluctuation. If we talk about the country risk, what is the meaning of country risk? If exposure to one country exceed 1% of the asset, make a separate provision in addition to the normal one. So when country risk arise, when exposure to one country exceed more than 1% of the asset, then you should make a separate provision in addition to the normal one. Let's talk about the PCR and provisioning. For loss and doubtful asset, total provision including country risk, it can't exceed 100% of the outstanding. Very, very important thing. For loan and doubtful asset, total provision, it cannot exceed 100% of the outstanding. One more point is that no country risk provision for India exposure, but Indian bank foreign branches must provide for their host country. You can see no provisioning is required for home country. However, exposure of Indian bank foreign branches to their host country must be included, right? Then, if we talk about foreign bank in India, they must calculate exposure for their Indian branches excluding India. So for loss and doubtful asset, what I am telling you, that total provision including country risk cannot exceed 100% of the outstanding, right? Very, very important. And no country risk provision for India exposure, but Indian bank foreign branches must be provided for their host country. And if there is a short-term exposure under 180 days, then we have the lower provisioning rate, about 25% of the normal rate. What is PCR? PCR is called provisioning coverage ratio. It is the ratio of provision divided by gross NPA. So in the numerator you write the provision, in the denominator you write the gross NPA, divide both of them, that will give you the PCR. So what is the benchmark of PCR? Remember, PCR benchmark is 70% as on 30 September 2010. But it must be disclosed in the notes to account. So PCR must be disclosed in the notes to account in the balance sheet. And what is the benchmark? I told you the benchmark is 70%, right? So for what is the full formula for PCR? In the numerator you write the provision, in the denominator you write the gross NPA. So provision divided by gross NPA is called PCR. Even if the loan are written off at HO level, means head office level, branches must keep provision as per the asset class. This is a very important thing. So what I am telling you, that advances can be written off at the head office level, branches must keep the provision as per the asset class. For technical or partial write-off, the balance can't be shown as a standard and their disclosure are mandatory. Finally, watch for early warning signal. Classify a stressed account and special mention account at the first default. Now let's talk about a special mention account. So I told you there are SMA categories which are based on overdue date. SMA 0 means 1 to 30 days overdue. SMA 1 means 31 to 60 days overdue. SMA 2 means 61 to 90 days overdue. For OD and CC account, SMA 1 means balance over limit or DP for 31 to 60 days continuously. SMA 2 means 61 to 90 days continuously for OD and CC account, right? So these are the criteria. Now overdue must be flagged at day end on the actual date. SMA or NPA day is the calendar day of the classification. It applies to all kinds of loan. Retail are also included regardless of the size. If we talk about the CRILC reporting, so monthly basis SMA data for borrower with 5 crore plus exposure, and weekly basis default in these account by Friday COB. So that is what you are talking about, CRILC reporting. Monthly basis SMA data for borrower with 5 crore plus exposure, and weekly basis default in this account by Friday, right? That is the point. Now once default is reported, all lender have 30 days for review period to decide resolution, restructuring or legal action. So once if you have reported the default, all lender they have 30 days, which is called review period, to decide resolution, restructuring or legal action. Suppose you choose the resolution. So all lender must sign ICA. What is ICA? Inter-creditor agreement within the review period to lock in the plan. So suppose you choose in the resolution. So all lender must sign ICA, which is called inter-creditor agreement within the review period to lock in the plan. Now let's talk more about this ICA. In terms of ICA, a decision needs lender holding 75% by value and 60% by number of the total exposure to be binding on all. That is called voting power, which means, in ICA, a decision need lender holding 75% of by value and 60% by number. So ICA must spell out right and duties of the majority lender, protection for dissenting lender, treatment for priority claim or different security, and minimum payout to dissenter should be equal to the liquidation value. Aggregate exposure cover all fund-based, non-fund based and investment exposure. For big account above the set threshold, what is the resolution plan deadline? It should be implemented within 180 days from the review period. Review period start on the reference date or the first default date after that date. So what is the RP action? So it can be clearing overdues, selling exposure, ownership changes, restructuring or other organization or other reorganization. All must be fully documented even with no terms change. If we talk about the credit evaluation requirement, remember if it is 100 crore plus, one independent credit evaluation by RBI approved CRA. So if the exposure exceeds 100 crore, so there should be one independent independent credit evaluation. In short, we call it ICE. And for exposure for 5 billion plus, 2 ICE are required. Only plan rated RP or better can go ahead. And CRA are appointed and paid by lender, not the borrower. Now let's talk about the resolution plan. So ICE, I told you, independent credit evaluation, it must be done by RBI approved agency, appointed and paid by the lender. If more ICE report are taken than required, all must rate and plan RP4 or better for it to qualify. What is restructuring? Any concession due to borrower stress, such as term change, limit increase, settlement with payment timeline over 3 months, must be restructured. So what is restructuring? Any concession due to borrower stress is called restructuring. Restructuring should be done. What is the RP implementation criteria? You must meet all stipulated conditions. If not restructuring or ownership change, borrower must be default free with all lender on the 180th day from review period, and later default must be means a fresh review. Right now, provision for delay. So how much provision we need to do for delay? So 20% provision if RP is not implemented within 180 days from the review period. So 20% provision need to be done if resolution process is not implemented within 180 days. So first of all, review period is there. From review period till 180 days, if RP is not implemented, then you have to take 20% provisioning. Second point, extra 15% provisioning if it's still pending after 365 days from the review period. So total it become 20 plus 15 means 35%. Provision capped at 100% of the total outstanding. And all implemented RP must be detailed in the notes to account. One more point is that default means stress. Every default under the framework signal borrower difficulty regardless of the reason. Even without current default, patterns of delay can mark a borrower as at risk if timely repayment seems unlikely without concession. If we talk about the restructuring, let's have a look. Even without arrear, sign of stress can mean financial difficulty. There is something called, immediate downgrade on restructuring. What happened? Standard account are immediately downgraded to NPA, which means substandard, and existing NPA keep their classification. For MSME account less than 25 crore exposure, it can be upgraded to the standard only after 1 year of satisfactory performance. This start from the first payment due date, either interest or principal on the facility with the longest moratorium. Then we have the satisfactory performance definition, which means no interest overdue for more than 30 days. It means performance is satisfactory for CCOD account or standing within limit DP for more than 30 days. If it is other account which is larger than 25 crore exposure, all facility must show satisfactory performance until more than or equal to 10% of the principal plus capitalized interest is repaid, and at least 1 year must pass from the first payment start date. Now suppose it is a large exposure account which is more 100 crore, larger than 100 crore. So in that case, they must also have investment grade rating BBB minus or better from RBI approved CRA. If it is larger than 500 crore, then 2 rating is required. If it is less than 500 crore, then 1 rating is required. If extra rating are taken, all must be investment grade. Now friends, let's talk about the restructured account. There is something called monitoring period. After restructuring, the borrower must maintain satisfactory performance. If they fail to maintain it, upgradation happen only after the phase restructuring or ownership change, plus 15% extra provisioning at the review period end. If it is satisfactory performance, then no default at any time during the period. Now there is something called a specified period. What does it mean? It means from RP implementation until 20% of the principal plus capitalized interest is repaid. There is something called provision reversal, which means these are allowed once the account is upgraded to the standard. So then there is something called post upgrade default. If the default happened before the end of the specified period, new RP plus 15% extra provisioning. What about the additional finance? Standard asset during monitoring, if borrower perform well, if performance fail, classify same as the restructured debt. Then we have the interim finance, income recognition and restructure resistance. So what is the meaning of interim finance under IBC? It is classified as a standard asset during the insolvency resolution process, but normal asset classification rule states they are treated as an additional finance under the standard norm. What about the interest recognition? So I told you that if it is a restructured standard account, the interest is recognized on accrual basis. If it is restructured NPA account, it is interest is recognized only on cash basis. If it is pre-structured NPA, so it is interest is recognized on cash basis unless there is a change in the ownership. Now we have new securities on restructuring. Any new instrument issued for overdue principal or interest take the same asset classification as the restructured loan. So what I am taking you that any new instrument which is issued for overdue principal or overdue interest, they take the same asset classification as the restructured loan. Then if we talk about the fraud or willful default case, no restructuring allowed, except if existing promoters are replaced, the company is fully detached from them and viability is proven. Criminal case still continues. Now, if we talk about the willful defaulter, non-cooperative borrower and related compliance, higher provision. A standard account with a certain repeat willful defaulter director, 5% provision. If already NPA, apply accelerated provisioning, right? So what I'm talking about is the higher provision for certain director, like suppose there is a standard account, right, with certain repeat willful defaulter director, 5% provision, no fresh credit. So no new loan to listed willful defaulter or non-cooperative borrower, right? What I'm telling you that if there is no fresh credit, then no new loan to the listed willful defaulter or non-cooperative borrower, right? So bank NFI must not accept additional finance to the listed willful defaulter. So no fresh credit should be given. Then comes non-cooperative borrower tag. So it is given, this tag is given after due notice if the borrower hinder recovery by withholding the information, blocking the asset sale or denying collateral access. It must be reported to CRILC. Then we have higher risk and provision. Any fresh loan to a tagged borrower, they need higher provision. Then we have the mandatory reporting, which means you should report all willful defaulter to credit bureau within 1 month, right? So that is called timely data reporting, that you should report all kinds of willful defaulter to credit bureau within 1 month. Then we have auditor negligence. So what are the action taken on negligence? Auditor. So auditor report to ICAI, RBI, IBA if they falsify the account. And advocate and valuers. So action if fake title deeds or inflated valuation is given. So auditors should report to ICAI, RBI, IBA if they falsify account, and advocate and valuer action if fake title deeds or inflated valuation given. What about the promoter's equity contribution? It must be from their own fund. No banking funding for equity purchase except for special entities buying troubled company under strict lending norms. Now friends, let's switch our focus to the promoter funding, risk check and CDR framework. So promoter funding risk. Lender must test viability. Lender must ensure a strong capitalization. Lender must keep debt equity ratio less than or equal to 3:1. Right. So that is called risk assessment for promoter funding. You should test viability, ensure a strong capitalization. You should keep debt equity ratio less than or equal to 3:1. Then project viability testing. So for big project, especially infrastructure project, you should run scenario analysis for delays and cost overrun before approving restructuring or DCCU extension. Then we have equity scrutiny. You should verify source and qualify of promoter equity. No parent debt disguised as equity. Then we have director verification. You can use DIN, you can use PIN. You can use DIN or PAN to avoid misidentifying individuals as willful defaulter. Always check against RBI CIC list. Then we have SARFAESI compliance. So register all security interest and securitization deal and update record continuously. What is the use of CRILC? So CRILC is used to monitor exposure centrally to detect stress early and act fast. That is the use of CRILC. What about restructuring monitoring period? So from RPA start until greater than or equal to 10% of the debt repaid, any default here trigger a 30-day review. That is called restructuring monitoring period. From resolution process implementation start until greater than or equal to 10% of debt repayment, any default here trigger a 30-day review. Let's talk about the CDR, which is corporate debt restructuring, a voluntarily 3-tier framework, a standing forum, empowered group, CDR cell to revive viable company and avoid any kind of default. Now let's look at CDR more important points. So CDR stands for corporate debt restructuring. So there is a standing committee who set the policy, CDR cell review proposal, empowered group approve plan, and it requires greater than or equal to 75% creditor approval by the debt value. There is something called compromise, which means settlement of dispute between companies and the creditor member. There is something called pre-packaged restructuring. That means pre-negotiated insolvency plan, which is presented to NCLT, National Company Law Tribunal. And OTS is also there, one-time settlement, which means lump sum NPA recovery with a part write-off. It is not for decreed account, right? And fraud case still face criminal action. What about Lok Adalat? Lok Adalat is a legal forum for quick amicable settlement. It is led by judges, lawyers, social worker. It handles pending and pre-litigation dispute within court jurisdiction. Then if we talk about the Lok Adalat and DRT, so what does it mean? Lok Adalat means case up to Rs 30 lakh can be referred. Open to all NPA in doubtful or loss category. No cut-off date. Process is ongoing. Special Lok Adalat with DRT, DRT can handle cases above 20 lakh. Supreme Court advises personal loan up to 10 lakh. Prefer Lok Adalat settlement. Right. So Lok Adalat, I told you 30 lakh case up to 30 lakh can be referred. Open to all NPA in doubtful or loss category. No cut-off date. A special Lok Adalat with DRT, DRT can handle case above 20 lakh. Supreme Court advises personal loan up to 10 lakh. Preferred Lok Adalat settlement. Then we have DRT. DRT handles bank, financial institution, debt recovery case of 20 lakh or more. It powers similar to district court. It has recovery officer for execution. It deals with NPA under RBI norm. DRT, remember the limit, the recovery case of 20 lakh or more deals with NPA under RBI norm. It enforces both RDDBFI Act and SARFAESI Act, right? SARFAESI Act 2002. Flexible on procedures for fair, speedy resolution. It can handle cross suit. It can handle counter claims. It can handle set-offs. And cannot rule on damages, service deficiency, breach of contract or criminal negligence. If you look at the DRT power, have a look. So DRT power, DRT can appoint receiver, commissioner, issue urgent order, receive it on decision, review it on decision, and hear appeal from the recovery officer. So DRT can do this thing. Now only Supreme Court and High Court can override DRT. Now appeal to DRT. We should file within 45 days of DRT order, deposit 75% of the dues, and DRT must be resolved within 6 months. If we talk about the SARFAESI Act, I told you they target NPA via securitization and asset reconstruction company, that is called ARC. So basically SARFAESI Act target NPA via ARC. They let lender enforce security without court, and the power is that they take possession of the secured property and recover due directly. So what are the recovery mode available under SARFAESI? Securitization, which means bundling loan into security for investor. Asset reconstruction, which means turn NPA into performing asset. Direct enforcement, which means sell secured asset without court. What is the default process? On default, lender issue a 60-day notice period. If it is unpaid, security interest is enforced. If we talk more about the SARFAESI Act, SARFAESI Act is not applicable to claim under Rs 1 lakh, agriculture land mortgage. If dues is less than 20% of the principal and interest, then SARFAESI Act is not applicable. Lien, pledges, aircraft security or protected property, SARFAESI Act is not applicable. Now what are the legal action that can be taken? You can act under SARFAESI Act even if litigation is pending. Action does not extend limitation period. Simple mortgage cannot use SARFAESI. Prefer equitable mortgage with MOTDT. Right. What about NCLT, that is National Company Law Tribunal? This is a quasi-judicial body under the Companies Act 2013, operational 6/2016. It handles company law matter, insolvency case, compromises, restructuring. Each bench has one judicial member, one technical member, and 16 benches nationwide. Under IBC, it is the authority for company and LLP insolvency. No other court can interfere in a matter before NCLT or NCLT. If we talk about NCLT, NCLT and insolvency, remember NCLT jurisdiction handle company compromise, merger, winding up, operation, mismanagement, revival of sick company, share transfer dispute, deposit, class action and large scale public company. Now power, they can freeze asset, they can halt operation, they can appoint investigator in India or abroad. What does NCLT do? So NCLT here appeal from NCLT, IBBI, CCI. Appeal chain is like this. NCLT appeal to NCLT, NCLT then appeal to the Supreme Court. Judicial rule is that they issue binding order, they impose penalty, they resolve the dispute and alter parties' right. If we compare insolvency and bankruptcy, so insolvency means liability exceed asset. Whenever liability exceed asset is called insolvency, and you can't pay creditor. What about bankruptcy? Bankruptcy is the legal process to resolve insolvency. Right. Now let's talk about the FPC, which is called the Fair Practice Code. It is very important thing. There is something called transparent fee, which means all charges, all processing fee and refund rule, they must be disclosed upfront and displayed on the bank website. Then no hidden cost, no surprise charge after sanctioning, all in cost clarity, which means total loan cost must be shared for easy comparison. Credit terms and limits clearly communicated and borrower acceptance is recorded. Loan agreement copy, which means borrower get the signed agreement with all document. Advance notice, which means any rate or fee change must be informed beforehand. And then we have the loan recall, which means proper notice required before early repayment demand or extra security call. No discrimination. Lending can't be biased by gender, caste or religion. Then we have the Fair Practice Code. Fair Practice Code, where it includes a release of security, which means you must return all security after loan repayment unless there is a valid set-off or lien with written explanation to the borrower. So you must return all kinds of security after loan repayment, right, with written explanation to the borrower. Then respectful recovery, no harassment, no odd hour call or coercion. Public disclosure, which means Fair Practice Code posted online, it should be shared to RBI. Then loan transfer request, which means approve or object within 21 days. Public disclosure we have talked about. Responsible recovery agent, which means you must follow ethical conduct. Contract must ban illegal practices. What about mandatory certification? All recovery agent to clear IIBF exam. Right, very very important. Legal recovery only. Seizure of collateral strictly via legal process. And you should clear the repossession clause. It means it must be legally valid and it must be explained at the time of signing. Then let's talk about the fraud risk management in credit. So what we are talking about, that basically fraud risk management is a proactive, when we talk about fraud risk management, what it is all about, it is a proactive and comprehensive strategy that every organization must integrate to combat fraud effectively. So it requires, a strong internal control, like, segregation of duty. So what is the difference between credit risk and fraud risk? So credit risk, obviously they are discussed together, but they are distinct. Credit risk use credit data to prevent mispayment, identify defaulter and assess repayment capacity. However, fraud risk focus on detecting the likelihood of a bad actor behind a transaction. Right. So one more point I want to tell you, that a strong internal control, like segregation of duties, like asset restriction, authorization protocol, these things are required. They form the foundation of fraud recovery. Equally important is continuous education and awareness to keep team alert to the potential threat. Right. Now, one more thing is that what are the modern fraud detection tool? So modern fraud detection uses advanced tool, analytics, behavioral monitoring to spot any suspicious activity early. A clear and practice response plan ensure quick action when fraud is suspected. As fraud tactics evolve, risk management must adapt continuously. Cutting edge technology like artificial intelligence, machine learning now play a key role in detecting unusual pattern and prioritizing the alerts. Now if we compare credit risk versus fraud risk management, I told you earlier that while credit risk and fraud risk are often discussed together, they are fundamentally different. Credit risk focus on assessing a borrower ability to repay the loan using credit data. It helps identify the defaulter, right? But fraud risk, on the other hand, is about detecting whether a transaction or digital interaction involve a bad actor aiming to deceive. So understanding this difference is very crucial for the effective risk management. Then fraud risk management is a systematic way to identify and rank fraud risk based on how likely they are and their potential impact. At the heart of the fraud risk is the fraud triangle, the three key elements that explain why fraud happen. The first one is the motivation, which means the personal or financial pressure driving someone to commit the fraud. Second motive is the rationalization, which means how the fraudster justify their dishonest action. Third is the opportunity, which means weak control that make fraud possible. So fraud triangle has three key elements: motivation, rationalization and opportunity. Motivation means the personal or financial pressure driving someone to commit fraud. Rationalization means how fraudsters justify their dishonest action. Opportunity means weak control that make fraud possible. Now let's talk about the IBCs, right? So IBCs is the Insolvency and Bankruptcy Code. It is the India's unified bankruptcy law consolidating various insolvency and bankruptcy rule. Right, it was set up in the year 28 May 2016 with key amendment up to 2020. Right, so what is the meaning of default? How creditor are classified: financial creditor, operational creditor. IBC consists of 255 sections, 11 schedules. They are broadly divided into 4 parts, covering the entire insolvency and bankruptcy process. Now, if you look at the IBC, basically IBC has fundamentally altered the balance between a debtor and creditor. What is CIRP? CIRP is called, corporate insolvency resolution process. It can be triggered. Who can trigger CIRP? It can be triggered by financial creditor like banks, operational creditor, or the corporate debtor himself. So all of them can initiate the CIRP. Right. On default, creditor assume control of the debtor asset. Who assume that? This is a very important thing. So the CIRP process ensure time-bound resolution as the default happen. Right, creditor take control of the debtor asset and they must finally resolve the insolvency decision within 180 days. Unlike traditional court where fees can be significant, NCLT does not require payment of court fee for insolvency application. Then we have the debtor option, which means borrower can voluntarily apply under IBC. Their proposed IP may be appointed as IRP. So whoever is the IP, which is insolvency professional, they may be appointed as IRP, which is the interim resolution professional. During CIRP, company operation are monitored by the IRP or RP professional or RP, who is tasked with preserving the business value. How insolvency is defined? What is bankruptcy filing? Please go through this. What are the types of bankruptcy? Reorganization, liquidation, default definition. Please go through this. IBC is default threshold. So if you fail to repay debt or interest of at least 1 crore, then IBC will come into action. Who are financial creditor? These are the party with a purely financial relationship, right? Who are the basically we are talking about reorganization which restructure repayment plan, liquidation where company assets are sold to repay the creditor. So two main types of bankruptcy are there: reorganization and liquidation. In case of reorganization, repayment plan is restructured. In case of liquidation, company assets are sold to repay the creditor. Insolvency means inability to pay the debt, but bankruptcy is a legal declaration. Remember the difference between insolvency and bankruptcy. Insolvency means you are unable to pay the debt, but bankruptcy is the legal declaration that it is possible to be insolvent without being bankrupt, right? Financial creditor are the lenders or the bank. Operational creditor are the supplier or the employee. When insolvency is admitted, NCLT declare a moratorium to protect the asset. No legal action, asset transfer or contract termination during the moratorium period. Then there is something called COC, which is constituted under the section 21. They comprise of all the financial creditor of the corporate debtor. Moratorium, I told you. The resolution professional RP guide the process and appoint resolution applicant to prepare stakeholder friendly plans. Right. What is the penalty for violation? So corporate debtor, corporate debtor officially breaching moratorium structure the debtor liability during insolvency. The CIRP is managed by the COC. Who is COC? Committee of Creditor. The committee of creditor decide whether to revive the debtor or to liquidate the asset. If no decision is made within 180 days, liquidation follow. Right, so 180 days is the timeline for COC to decide what to do with the asset. Right, the Insolvency and Bankruptcy Board of India, which is called IBBI, they monitor the entire process. Right, they accrediting insolvency professional, agencies and information utilities. They are the stakeholders. Right, and an IRP is appointed within 14 days of insolvency starting, and the COC confirm or replaces the IRP within 7 days. But for that 66% vote is required. Right, so IRP within 14 days of the insolvency start, it should be appointed. Who are IU? IU are our information utilities. They are they store verified financial data to support the insolvency process, and IPA certify and regulate IP under the strict code of conduct. Then we have the AA, which is called Adjudicating Authority. They have exclusive jurisdiction. You know, NCLT handles companies and LLP. DRT handle individuals. Very, very important thing. Who companies and LLP are handled by NCLT, and individual and partnership are handled by the DRT. And application follow a 3-tier system. First of all, it goes to NCLT or DRT, then it goes to NCLT and DRT, and further it goes to Supreme Court. Right, the very, very important thing. So what happened, you know, the NCLT order can be appealed to the NCLT within 30 days, and NCLT decision can be taken to the Supreme Court within 45 days, strictly on legal question. Extension of up to 15 days may be granted if sufficient cause is shown. Civil court have no power over NCLT case. IBC have exclusive jurisdiction. The law apply all over India, including Jammu, Kashmir and Ladakh. Insolvency petition must be filed at the NCLT corresponding to the company registered state. The Limitation Act apply, meaning the right to sue start from the default date, and application filed after 3 years are barred unless condoned. The IRP, the insolvency commencement date is when CIRP application is admitted and the IRP is appointed on the same date. The IRP or insolvency resolution professional manage the corporate debtor affair until a resolution plan is approved or liquidation is ordered. So that is all we have covered inside the module D. If you want such kind of PDF, you can WhatsApp me on the number shown on the screen 8292857381. I again repeat the number 8292857381, or in the description section you can get the link of the course. So basically RBI now want bank to focus on eco-friendly loan. You know this eco-friendly loan? This eco-friendly loan aligning with the Sustainable Development Goal or SDG. You can think of clean energy, green farming, etc. So we are talking about, you know, RBI want bank to focus on eco-friendly loan that align with the Sustainable Development Goal. Now, where did this change come from? Very, very important concept. You know, these kinds of update are based on suggestion from expert on MSME, agriculture and feedback from bank and other stakeholder. Now one word is the on lending. What is on lending? Simple. Bank give money to middlemen like NBFC who then lend it to further to the priority sector like farmer, like small businesses. So this is called on lending. But the time period of the loan, that is the tenure of the loan, should match between the bank and the intermediary. So when we talk about the on lending, it means, you know, giving money to middlemen like NBFC, and those NBFC, first of all bank is there and then NBFC is there. Bank lend to NBFC and NBFC lend it further to the priority sector. Priority sector includes farmer, small businesses, etc. So this process is called on lending. But you know, the time period of the loan or the nature of the loan should match between the bank and intermediary. This is a very, very important thing, right? So priority sector loan by intermediary should have maturity matching the bank loan tenure. So that is called on lending. Now let's talk about the exclusion. You must know that contingent liability or off balance sheet items, they would not be counted in PSL. They won't be counted in the priority sector lending unless you are a foreign bank with less than 20 branches. Then it can be under certain condition. This is a very, very important aspect which we are talking now, right? That is the exclusion. So friends, contingent liabilities and or off balance sheet item, they won't be counted in the priority sector lending unless you are a foreign bank with less than 20 branches. Then it can be under certain condition. Now what is the role of the bank? So you know that bank must track and verify that their loan are used only for approved priority sector purpose. Yes, bank must verify that their loan are used for approved priority sector purpose. No misuse is allowed. Now the question is, what is counted as a priority sector? So priority sector, here is the list: agriculture, MSME, export credit, education, housing, social infrastructure, renewable energy, others. So these are counted as priority sector. So friends, that is a wrap on the RBI updated PSL rule: simpler, greener and more focused lending. Now friends, let's talk about the priority sector lending targets, some more important points. So let's break down how priority sector lending targets are calculated and what bank need to follow. Sometimes, you know, numerical question based on A and BC calculation, COB calculation asked in the examination. So you must thoroughly know it. So bank have to meet their PSL target based on whichever is higher between the A and BC, which is called adjusted net bank credit, or COB, which is called credit equivalent of off balance sheet exposure. So between these two, whichever is higher, bank have to meet their PSL target based on these two. You can think of it as, you know, RBI checks how much bank really lend or support indirectly and uses the bigger number. Now the question is, how much should bank lend? So here are the mandatory target for the domestic bank. 40% or 40% should be given to the total priority sector, 40% of ANBC or COBB to be given to the total priority sector lending, 18% to agriculture, including a minimum of 10% to SM. So 40% to total priority sector lending, 18% to agriculture, which includes minimum of 10% to SMF. SMF, is a small and marginal farmer. So this is the bifurcation. 7.5% to micro enterprise, 12% to weaker section, which is gradually increased over the time. So remember this bifurcation, again I am repeating, 40% to total priority sector, 18% to agriculture, minimum of 10% to a small and marginal farmer, 7.5% to micro enterprise, 12% to weaker section, and this is gradually increased over the time. Now there is a word called all inclusive interest. So this means the total cost to the borrower. What are the total cost to borrower? Like interest rate, processing fee, service charge. Means there should be no hidden cost should be involved. Now what is excluded? So interbank loan. Remember, interbank loans shown off the book are not counted in the COB. And when bank write off bad loan, this is called prudential write off. You see this word written here, prudential write off. So whenever bank write off the bad loan, they must also reduce their target accordingly. No shortcuts. So what is excluded? Two things I told you. First is the interbank loan shown off the book are not counted in COB. Second point, when the bank write off the bad loan, they must also reduce their target accordingly. Now suppose some other points to note is that if a bank invests in certain eligible instrument that count as PSL, they should include that in ANBC. Suppose a bank is there which invests in a certain eligible instrument, and such eligible instrument they count as priority sector lending, so they should include that in ANBC. Also, farm credit is treated like PSL only if the loan amount per farmer does not cross 2 crore. Very important point I am telling you, that you can treat the farm credit as priority sector lending, but the condition is that the loan amount per farmer does not exceed the 2 crore. This is the condition, right? So in simple term, RBI makes sure that bank lend a fair share to the sector that really needs support. That is the core of the priority sector lending. Now friends, let's look at some more data. So bank can give priority sector loan to FPO. What is FPO? FPO stands for Farmer Producer Organization, FPC stands for Farmer Producer Company, and cooperative. Yes. So loan up to 5 crore can be given to FPO, FPC or cooperative, and that comes under the priority sector loan. But remember, the condition is that only if 75% of more of their members are a small and marginal farmer. See, I'm talking about the cooperative bank, right? So what I tell you, that bank can give the loan to the priority sector lending to the FPO, FPC or cooperative, but the condition is that 75% of more of their members are a small and marginal farmer. Now, so that is what I'm telling you. Then loan up to 75 lakh against pledge or hypothecation of agriculture produce for up to 12 months against NWR or ENWR. These are the important points. Now that bank can also lend to registered MFI. Yes, there is something called registered microfinance institution. So bank can also lend to registered MFI, right? How much loan it can give? So which in turn, so basically bank can lend to registered MFI, and these MFI will give loan to individual farmer, self-help group, joint liability group. So they are also treated as like agriculture PSL, agriculture priority sector lending. So this is a very important point, that bank can lend to registered microfinance institution, which in turn give loan to individual farmer, self-help group, joint liability group. These are also treated like agriculture PSL. Now let's talk about the NBFC loan to agriculture. So NBFC loan for agriculture. See what happen if a registered NBFC, let's say the registered NBFC, like we exclude the MFI here, we are not taking MFI into consideration. So suppose a registered NBFC give a loan of up to 10 lakh per borrower. Suppose the registered NBFC give a loan, as you can see, give a loan of rupees 10 lakh per borrower, right, for agriculture. So it count as priority sector lending also, right? So few points, let us just recall what we have just talked now, that loan up to 75 lakhs against pledge or hypothecation of agriculture produce, that is called ENWR, they are counted toward this PSL. Then I told you that loan up to 5 crore to FPO, FPC with assured predetermined price marketing. Then agriculture infrastructure loan are covered if the total sanction amount does not exceed 100 crore per borrower. then it is covered. Loan up to 5 crore to farmer cooperative society for purchasing of member produce count as priority sector lending. A startup engaged in agriculture and allied sector as defined by the Ministry of Commerce and Industry, they are eligible for loan up to 50 crore under the priority sector lending. Food and agro processing loan up to 100 crore per borrower, they are classified under PSL. Marginal farmer, so please understand the difference between the marginal farmer and the small farmer. Who is marginal farmer? So those who is owning up to 1 hectare of land, and small farmer are those who are owning up from 1 hectare to 2 hectare of land. So landless agriculture laborer, tenant farmer, oral lesson, sharecropper within prescribed small farmer landholding limits, they are also included. Then I told you loan which is given to the JLG, which is called joint liability group, on SHG, which is called self-help group. So loan extended to these two groups consisting of a small and marginal farmer directly involved in agriculture and allied activity, they qualify with the bank maintaining the detailed data. So suppose loan is given to the self-help group or joint liability group, and this consists of a small and marginal farmer that who are directly involved in agriculture, right? Then loan up to 2 lakh rupees. Loan up to 2 lakh rupees to individual engaged solely in allied agriculture activity regardless of land ownership, they are considered under PSL. So loan up to how much? 2 lakh. Remember, loan up to 2 lakh, right, to individual engaged solely in allied agriculture activity, they are also considered priority sector lending. Loan to FPO, FPC, cooperative with at least 70% of the land holding by small and marginal farmer, they qualify under PSL. Now bank credit which is extended to registered NBFC MFI and other recognized MFI for on lending to individual. I told you the meaning of on lending, right? So they are also eligible at priority sector advance under agriculture. And loan be under up to 10 lakh rupees per borrower from registered NBFC. We don't include an MFI here. So loan which is up to 10 lakh rupees from registered NBFC for term lending in agriculture, they fall under the priority sector lending. So all loan adhering to MSME guideline, they will classify. So, and yes, a startup that match government guideline and MSME criteria can get loan up to 50 crore. Remember, this is a very, very important thing. As a startup can get loan up to 50 crore, right, under the revised PSL. Now, loan to units in the KVIC. What is KVIC? Khadi and Village Industry, right, KVI. So, loan to units in the KVI, they are part of the 7.5% micro enterprise target. So those units which are in Khadi and Village Industry, they are part of the 7.5% micro enterprise target. So overall, remember, PSL is not just for farmer, it also includes startup, MSME and cooperative and more. Now friends, let's look at how RBI, basically we are talking about that how RBI priority sector lending support artisans, small businesses and low income entrepreneur. Let's see. So first of all, support for traditional and village industry. So bank can give priority sector loan to entities that help artisans, that help villages and cottage industry with raw material and marketing. First point. Second point is cooperative. So I told you that bank can give priority sector loan to cooperative formed by these producers, like a group of weaver or potters. So these are producers. So loan to cooperatives or producer in decentralized sector. These are included under the priority sector lending. These sector are the part of the India's decentralized economy, right? And PSL is here to boost them. Then we have the loan through NBFC and MFI. So bank can lend to microfinance institution. Bank can lend to NBFC, which is called non-banking financial company. Bank can lend to these entities. So if this MFI or an NBFC further give loan to MSME, especially micro and small business, the original bank loan qualifies as PSL. So what I am telling you, that if this MFI or if this NBFC further give loan to MSME, right? So these microfinance institution or NBFC, if they give further loan to MSME, especially micro and small business, so the original bank loan qualifies at PSL. This is a very, very important thing. First of all, bank lend to these MFI and NBFC, and if this MFI or NBFC further give loan to MSME, right? So the original bank loan, they qualifies at PSL. Very, very important thing. And just make sure that MFI are the part of the RBI recognized SRO. What is SRO? SRO is called self-regulatory organization. This you have to ensure. As you can see, RBI recognized SRO. This you have to ensure that whatever NBFC or MFI you are lending to, that is a part of the SRO, self-regulatory organization, right? This is the point. Now let's talk about the credit card and overdraft count also. in certain general credit card like artisan credit card, Laghu Udyami card that help meet non-farm business need. They are also part of the priority sector lending. Remember, two cards name I am talking about: artisan credit card, Laghu Udyami card. These two cards, they help meet the non-farm business need. They are also part of the priority sector lending. Plus, overdraft given to people, overdraft given to people under the Pradhan Mantri Jan Dhan Yojana as per government rule, they are also counted under micro enterprise target. So overdraft to to Pradhan Mantri Jan Dhan Yojana account holder, right, as per the government rule, they are counted under the micro enterprise target. So PSL is not just about farming or big industry. It's about empowering small artisan. It's about micro entrepreneur. It's about rural talent through the right financial support. Now the next point we have, loan to entities. I think we have discussed this thing, right? I told you that bank can give priority sector loan to entities that help artisans, villages, cottage industry with raw material or selling their product. I told you about bank lending to MFI if they are more than last year level, up to 2% of ANBC or COB, maximum 40 crore per borrower can also qualified as PSL, priority sector lending. Then we have loan up to 20 lakh for studies, whether formal education or vocational training. They are also eligible under priority sector lending. And now there is something called no midway charge, which means if a loan is classified as priority sector, it remains so until repayment. So no reclassification midway. So priority sector lending is not just for farmer and small businesses. It also support education, export, artisans and entrepreneur. Like you can see housing loan to bank employee and those backed by long-term bond, they are excluded from the priority sector lending classification. Afterward, some more important housing loan classification you must know. So for housing loan up to 35 lakh in metro are eligible, but the home total cost must not exceed 45 lakh, right? So in terms of housing loan, what qualify, that in metro, home loan up to 35 lakh are eligible, but home total cost should not exceed 45 lakh. And in other cities or town, the loan limit is 25 lakh and the house cost must stay within 30 lakh. So remember these two conditions. I told you again, in metro, home loan up to 35 lakh are eligible, but the home total cost must not exceed 45 lakh. And in non-metro or other cities and town, loan limit is 25 lakh and house cost must stay within 30 lakh. This helps middle income family get affordable home. Now what else is included or excluded? If someone already has home loan from Urban Cooperative Bank, that is called UCB, it will continue to count as priority sector till it is repaid, right? So that is also another point, that if someone already has a home loan from an urban cooperative bank, it will continue to count as priority sector till it is repaid. But loan to bank employee or loan backed by long-term bond, they are not considered priority sector, right? So housing loan to bank employee and those backed by long-term bond, they are excluded from the priority sector lending classification. What about home repair? So loan for home repair also qualify up to 10 lakh in metro and 66 lakh in other areas. But again, the total home cost must be within the prescribed limit. Then we have the government and affordable housing project. So loan to government bodies building affordable home or doing slum rehabilitation with carpet area less than equal to 60 square meter. They also qualify. Also private housing project where at least 50% of space is used for home and less than 60 square meter get also PSL status. So remember, private housing project where at least 50% of the space is used for home, they also get priority sector lending status. Now loan via housing finance company, very very important aspect. So you must know that loan up to rupees 20 lakh. How much? Loan up to rupees 20 lakh through an HB approved housing finance company for individual home or slum rehab also qualify. So friends, let's explore how priority sector lending helps support clean water, renewable energy, small borrower and weaker section. So you know that bank can give loan to microfinance institution who then lend to individual or SHG JLG for members for toilet, clean drinking water and related needs. And yes, this is also covered under PSL. So bank give loan to MFI and MFI then lend to individual or SHG JLG for toilet, clean drinking water and related needs. Now renewable energy funding. So you know that bank can fund project up to 30 crore for solar, biomass, wind, micro hydro, other non-conventional energy system. And for individual household, remember the loan cap is how much? 10 lakh. So remember for project, for bank can fund project up to 30 crore for these kinds of solar, biomass, wind, micro hydro and non-conventional public utility. And for individual household, the loan cap is 10 lakh. Now what about the small social loan? Remember, loan up to 1 lakh to low income individual and up to 2 lakh to SHG or JLG. So 1 lakh to low income individual and up to 2 lakh to SHG or JLG. For non-farm or non-MSME community needs also qualify, right? So this is the important point. Now let's talk about helping distressed individual. What happened that loan up to 1 lakh to person in debt, but not farmer owing money to local money lender. So loan up to 1 lakh to people in debt to repay non-institutional debt are also included in the PSL. So basically let's talk about the support for SC/ST. So loan to a state-sponsored body working for scheduled caste, scheduled tribe for inputs or marketing, they are also eligible under PSL, priority sector lending. So loan which is given to a state-sponsored body who are working for a scheduled caste, a scheduled tribe for input or marketing, they are also eligible under PSL. Now startups are also included. A startup that don't fall under agriculture or MSME can still get PSL loan up to 50 crore if they meet certain condition. Right, then we have the loan to weaker section. Remember, loan to a small and marginal farmer are automatically counted under the weaker section category. Remember, so loan which is given to SMF, small and marginal farmer, they are automatically counted under the weaker section category. Also, loan up to 1 lakh to artisans and cottage industry worker also fall under this category. So PSL is truly all inclusive, supporting clean energy, water, startup, poor borrower and undeserved community. Now friends, let's look at the next part that we have. Let's decode how RBI priority sector lending support weaker section of society. Friends, if you are looking for PDF of such kind of video, you can enroll in our CCP course, description regarding which is provided in the description section of the video, or you can WhatsApp me on the number 8292857381 for more detail. Now let's decode how RBI priority sector lending support weaker section of the society in the simplest way possible. So RBI has a special focus on helping those who need financial support the most. So friends, RBI has a special focus on helping those who need financial support the most. So who qualify under it? SC and ST, right? Fall under the weaker section. Who fall under the weaker section? We are talking about that. Women, loan up to 1 lakh rupees, fall under the weaker section. Person with disability, fall under weaker section. Minor community, fall under the weaker section. Distressed farmer who borrowed from informal money lender, fall under the weaker section. Distressed non-farm borrower, that is loan up to 1 lakh to repay informal debt, they fall under the weaker section. So SC/ST, women, person with disability, minority community, distressed farmer and distressed non-farm borrower, so all of them qualify under the weaker section. Then we have the SHG. Remember, loan to individual workman beneficiary up to 1 lakh, they are considered weaker section lending. Loan with person with disability qualify under weaker section. Loan to minority community included in the weaker section. Loan to the self-help group, right? Loan under NRLM, NULM, SRMS, government scheme, all are counted as loan to the weaker section. So overdraft availed by the Pradhan Mantri Jan Dhan account holder may be classified under weaker section. IBPC, you know what is IBCP? IBPC means Interbank Participation Certificate. So Interbank Participation Certificate bought on risk sharing basis can be treated as priority sector if the original loan meet RBI norm. Try to understand, this is a very important point. If the original loan, if the underlying asset meet RBI guideline, meet RBI norms, then even IBPC, which means Interbank Participation Certificate bought on risk sharing basis, can be treated as priority sector. So under priority sector lending, RBI ensure that marginalized and vulnerable, it can count as PSL. Right, so that is called IBPC and PSLC. What are they? Let's understand. So suppose a bank buy IBPC, which is Interbank Participation Certificate, which is linked to the export credit. So it can be counted as PSL, but only if the original bank certifies that loan is indeed for export and both bank do proper due diligence, then only. So what I'm telling you, that if a bank buy IBPC linked to export credit, it can count as PSL. Condition is that if the original bank certify that the loan is indeed for export and both the bank do proper due diligence, then only it is considered as priority sector lending. Similarly, suppose a bank buy PSLC. What is PSLC? That is called priority sector lending certificate. So it automatically qualify, not it will qualify only if the underlying loan meet the PSL norms. So bank has bought PSLC, and if the underlying loan meet PSLC norm, then it will be qualified, right? So that is the what I'm talking about. Now loan which is extended by bank to registered NBFC or MFI, right? So bank also lend to registered MFI, registered NBFC. So bank lend to registered MFI for what? For giving a small loan to individual and SHG JLG members. Bank also lend to registered NBFC, which is non-MFI, for on lending to different sector. You know it very well, right? So they also count under priority sector, but there are some limits. Now the question is, how much is the limit? So remember, for agriculture up to 10 lakh rupees per borrower, right? So friends, bank can lend to registered MFI for giving a small loan to individual and SHG JLG team, and bank can lend to registered NBFC for on lending to different sector. They also count under priority sector lending. Now how much can NBFC lend under PSL? Very important concept. See, for agriculture up to 10 lakh per borrower, bank and NBFC can lend under PSL, and for micro and small enterprise up to 20 lakh per borrower, NBFC can lend under priority sector lending. So remember, on lending by NBFC up to 10 lakh per borrower for term lending in agriculture is eligible for PSL, and on lending by NBFC up to 20 lakh per borrower for MSE is allowed for under the. So the question is, how much can NBFC lend under PSL, right? So for agriculture, remember the limit is 10 lakh, right, per borrower, and for MSE limit is 20 lakh per borrower. So these are the limits, right? Now, and for housing and finance company approved by NHB, bank can lend up to 20 lakh per borrower for housing or slum rehabilitation. Now let's talk about the overall cap for NBFC lending. So bank can count loan to NBFC including HFC as PSL, but the total lending through NBFC is capped at just 5% of the bank total PSL, right? So remember, the limits are very important, right? For housing finance company approved by National Housing Bank, bank can lend up to 20 lakh per borrower for housing loan or slum rehabilitation, and bank can count loan to NBFC as PSL, but total lending through NBFC is capped at just 5% of the bank total PSL. So let's suppose bank total PSL is 100 crore. So out of that 5% means 5 crore is the maximum limit that bank can lend through NBFC, which is counted toward PSL. Now we have the scheduled commercial bank. So basically that is called co-lending, right? What is co-lending? So a scheduled commercial bank can team up with all registered NBFC including housing finance company to give loan under the priority sector like farming, small businesses, housing as per the RBI rule. This is called co-lending. What is co-lending? See, a scheduled commercial bank team up with all registered NBFC, right? Both of them team up to give loan under priority sector. And what are the priority sector? You know it very well. So this is called co-lending. Now one more thing is the regular monitoring by RBI. So bank must report their PSL progress to RBI every quarter. RBI keep a close eye on whether banks are meeting their target or not. That is called regular monitoring by RBI. What if the target are missed? Suppose if the bank falls short of the PSL target, it must contribute money to develop fund like RIDF, that is Rural Infrastructure Development Fund by NABARD, NHB, SIDBI and Mudra Limited. So what I am telling you, that suppose a bank falls short in PSL lending, so it must contribute money to development fund. What are the development fund? Like RIDF, Rural Infrastructure Development Fund, NABARD, NHB, SIDBI, Mudra, etc. Now the question is, how is performance measured? RBI check performance every quarter, but the final calculation is a yearly average of all the 4 quarters, right? So what I am telling you, that RBI check the performance every quarter, but the final calculation is the yearly average of all the 4 quarters, right? Now what about the missed target? Low interest. Yes, RBI decide the interest and time period for the money bank have to park in this fund. Obviously interest is there. No room for error, which means if RBI or NABARD find any mistake in classifying loan as PSL, those get adjusted in the bank yearly score. Now if failing PSL target has consequences, which means that missing the PSL target may affect approval from RBI for future bank project. Now loan charges for a small borrower. For PSL loan up to 25,000 rupees, bank can't charge inspection or extra loan related fee. For SHG and JLG loan, 25,000 limit apply per person, not the whole group, right? So remember, loan charge banks exemption, loan charges exemptions are there for loan up to 25,000, and for SHG JLG loan up to 25,000 apply per person. Remember, these are the very important aspect. Now friends, did you know that bank must keep a clear record of every priority sector loan that they give? So this include when they got application, whether the loan was approved or rejected, how much was disbursed, even the reason if it was rejected. So bank must keep a clear record of every priority sector loan that they give. Whether it is on paper or computer, this record must be ready to show if RBI or other authority come for inspection. And here is something important. When you apply for priority sector loan, bank must give you an acknowledgement. This is called, token of service, right? This is called what? Token of service, right? Like a receipt that say that yes, we have received your application. Also, bank can't just sit on your application. Their board must hit a proper deadline by which they must tell you in writing if your loan is approved or it gets rejected. Now let's talk about a powerful government scheme that is called PMEGP, Prime Minister Employment Generation Program, right? So this program was launched on 4th April 2008, and this scheme is all about helping people start their own small business both in village as well as cities. Remember, PMEGP was launched on 4 April 2008, and it's all about helping people start their own small business. It is a central government scheme run by the Ministry of MSME and implemented by KVIC at the national level and by different state agencies and DICs at the local level. So remember, PMEGP is a central government scheme. Who run it? Ministry of MSME run it. Who implement it at the national level? KVIC implement it at the national level. And who implement it at the state level? Different state agency. And Pradhan Mantri Employment Generation Program. It was launched on 4th April 2008. It is a central government scheme run by the Ministry of MSME, implemented by the KVIC at the national level. Right, we have talked about it. Now, what is the maximum loan amount? This is a very important question. See, what is the maximum loan amount under PMEGP? Remember, it is 25 lakh for manufacturing business and 10 lakh for service sector. This is the maximum loan amount under PMEGP. So whether you live in a village with population below 20,000 or in a city, you can benefit from the PMEGP scheme, right? So if you are dreaming of starting your own business, so this scheme could be your golden ticket for it. So right, that is about the PMEGP. So this scheme operates in both rural population with less than 20,000 people, and urban area. At both these places, this particular thing operate. Now let's talk more about this PMEGP. So friends, what is PMEGP scheme? Yes, so let's look at the subsidy position. You can see that PMEGP loan is given to only those projects which have capital expenditure. What is the meaning of capital expenditure? Like machine, tools or other fixed asset, right? To buy these kinds of machine, tools and fixed asset, whatever cost is incurred, right? That is called capital expenditure. As the name suggests, expenditure to buy machines, to buy tools or to buy any fixed asset is called capital expenditure. And if there is any working capital project that get rejected. So remember, PMEGP loan require project to include capital expenditure only. If there is any working capital loan, then PMEGP loan will not be given for it, right? Then this scheme is only for new business only. Earlier business or existing business are ineligible for this loan. Remember, this financing under PMEGP is available only for new project. Then how much loan you would get? So 90% of the project cost, maximum loan you can get. So loan amount can cover up to 90% of the project cost. Remember, very very important, right? And if you are in a special category like SC, ST, women, then you can get up to 95%, right? Without any income restrictions. So 90% of the project cost, right? Maximum loan. And if you are under a special category like SC, ST, women, then 95% of the project cost without any income limit. Now who will decide, right? Who will decide whether loan will be given or not? So one task force is there who decide, which include KVIC, District Industry Center, DIC, and the bank people, right? So borrower are identified by the task force, and task force comprise of KVIC, KVIB, DIC and bank representative. What is the minimum age? What is the minimum age for applicant? So applicant age must be at least 18 years. And what is the education requirement? So if your project is under 10 lakh, right, for project under 10 lakh or more than 10 lakh, project exceeding 10 lakh manufacturing, or more than 5 lakh in the case of service or business, right? So at least you should be at a standard pass, right? Then we talk about the EDP. What is EDP? Entrepreneurship Development Program. So EDP training is a must. So before taking the loan, you must have 2 to 3 weeks entrepreneurship development program training, right? And if you have taken earlier, then it is also okay. then you either you have to take 2 to 3 big EDP training program, right? Then only you can take this loan. Now, if you are general category, right, then you have to pay 10% of the project cost. That is the margin requirement. And if you are a special category, then you have to pay 5% of the 5% for the special category, right, as a margin. Now, project cost. So remember, land cost is not included in the project cost, but machinery, equipment and working capital of one cycle, they are included. So remember, project cost exclude the cost of land but include capital expenditure and one cycle of working capital. Now what about the extra clearance? Very very important thing. If your project is more than 5 lakh and you don't need working capital, then you have to take approval from the highest authority. So that is what I am telling you, that project costing over 5 lakh without working capital need, they require higher authority clearance, right? So these are the important points. Now friends, if you are thinking of starting your dream business but worried about the loan and subsidy, so we are talking about the PMEGP scheme. If you look at the subsidy structure, so the government give you a big chunk of your project money at subsidy, but how much? So if you are from general category, then 15% subsidy in the urban area and 25% subsidy in the rural area, right? So this much subsidy you get. The government give you a big chunk of your project money as subsidy. Remember the limit, 15% in the urban area and 25% subsidy in the rural area. But if you belong to a special category like SC, ST, OBC, minority, women, ex-servicemen, differently able, or you are from hilly or border or northeastern area, then 25% subsidy in the urban area and 35% subsidy in the rural area. That is more than 1/3 of the project cost. So depending on whether you belong from general category or whether you belong to a special category. If you are from general category, then 15-25. If you belong to a special category, then 25-35. Important rule is that, if your project does not follow the scheme properly, bank must return the subsidy to the KVIC, who is the nodal agency. So question may be asked that for PMEGP, who is the nodal agency? Answer is the KVIC. Now what about the working capital loan? See, for working capital loan, you must use at least 100% of the limit once in 3 years. Remember, very very important part. So every 3 years, once you have to use at least 100% of the working capital loan. 100% of the limit you have to use once in a 3 year. And uses should never fall below 75%. So working capital uses should never fall below 75%. Else a part of your subsidy may be taken back. So government will give you subsidy only at a certain condition which I have provided. Now, what if the loan become NPA? If due to any reason, if due to reason beyond your control, loan turns bad, so the subsidy plus interest must be refunded. Very very important aspect. So suppose the loan, due to any reason beyond your control, your loan turns bad, right? The subsidy plus interest must be refunded. What about the repayment? I told you, you get 3 to 7 years to repay and up to 6 month holiday before the first EMI. So loan repayment tenure ranges from 3 to 7 years and up to 6 month repayment holiday. Now what is the location and social target? So remember, at least 50% projects should be in the rural area. So at least 50% projects should be in the rural area. A special focus on SC 15%, ST 7.5%, women 30% and minority 5%. So that is the location and the social target. What about the village industry? Remember, the maximum capital per artisan is 1 lakh in the plain and 1.5 lakh in the hilly area. That is the maximum capital per artisan. What about the collateral? For loan up to 10 lakh under PMEGP, no need for security or third party guarantee. Banks are protected by the credit guarantee scheme. So no need for collateral or no need for loan up to 10 lakh under PMEGP, no need for security or third party guarantee, right? So this is all about PMEGP. Now some more points regarding PMEGP, that look, if you are looking to apply for PMEGP loan, if your loan is above 5 lakh, bank must process it within 30 days. And for loan up to 5 lakh, the timeline is even quicker, just 15 days. Now listen carefully. SC/ST loan application cannot be rejected by the bank branch alone. Only higher authority can decide that. And if a loan is rejected, it must be recorded properly and with valid reason. For MSME loan, branch rejection also need approval from the higher authority. Remember, only online applications are accepted for PMEGP. There are separate forms for individual and institution. Make sure that you pick the right one. Once your application is approved by the district level task force committee, that is called DLTFC, once the loan is approved by the district level task force committee, right, you will get your loan sanction letter online. within 30 days. So loan sanction letter are issued online within 30 days by the within 30 days of the district level task force committee, that is called DLTFC. But don't delay after receiving the letter. Submit your margin money and EDP training certificate to the bank within 10 working days. Right, so these are the very important aspect. Now, good news is that if you are running a unit under PMEGP, REGP or Mudra, you are eligible for a second loan under PMEGP. Yes, that is right. If you have already set up your business under any of these scheme, you can get another round of funding to expand or grow your unit. So, if you have started small and want to scale up, this is your chance. Now, let's talk about the SRMS. Remember, SRMS is a very important aspect. Let's discuss it. Under the SRMS, what happened? So what is this SRMS scheme? This is a big help for manual scavenger and SHG. So full form is, self-employment scheme for rehabilitation of manual scavenger. Under this scheme, SHG project can get loan up to 50 lakh, right? And for sanitation work, 15 lakh term loan, and for other work, 10 lakh term loan. Remember, very important aspect. SRMS is self-employment scheme for rehabilitation of manual scavenger. So SHG project can get loan up to 50 lakh. For sanitation work, 15 lakh term loan. For other work, 10 lakh term loan. Now, microfinance loan of 25,000 rupees per person are given via SHG or NGO. Right? How much loan? 25,000 rupees. Microfinance loan. Right? Are given via SHG or NGO. Now, one-time cash assistance, that is called OTCA, of rupees 40,000 is also given to one manual scavenger per family. So OTCA, that is called one-time cash assistance of how much? 40,000 rupees is also given to one manual scavenger per family. What about the loan security? Yes, just hypothecate the asset created from the loan, that is the security. So security for SRMS loan involve hypothecation of the asset created from the loan or subsidy. Now some more point is that what about the repayment? So up to 5 years for a small project, up to 7 years for big one, with a 6-month break in the beginning. So remember, the loan repayment period is up to 5 years for a small project, up to 7 years for big one, with a 6-month break in the beginning. Now subsidy is back-ended. What is the meaning of back-ended? It means you pay EMI on the full loan and subsidy is adjusted later. So you have to pay the EMI and subsidy is adjusted later. Now training is also offered for up to 24 months with a monthly stipend up to 3,000. Yes, under SRMS scheme, training is also offered up to 2 years, right, with monthly stipend up to 3,000 rupees. Now loan are only given after the upfront subsidy is received. Once the upfront subsidy is received, then only SRMS loan is given. And yes, the mission is linked with the NRLM, which is National Rural Livelihood Mission, focused on removing poverty and empowering the women. Now what NRLM is? NRLM, are you a part of the self-help group or just want to start one? Then you must know about NRLM, which is the National Rural Livelihood Mission. It was launched in the year 2013. Its aim is to lift poor people out of the poverty, especially in the rural area. Focus is on women self-help group, that is called WSHG. But not just any group, only homogeneous group, means all members from similar background are covered. To get benefit under NRLM, you must follow the 5 golden rules called Panch Sutra. What are the Panch Sutra? First of all, regular meeting. Second is regular saving. Third is the internal lending. Fourth is the timely repayment. And fifth is the proper record keeping. So they are called Panch Sutra. Now loan are given in small parts and each part is linked to how will the group repay the earlier one. SHG can take term loan, they can take credit loan, or they can take both depending on their need. And good news is that even non-willful defaulter, means who did not repay for genuine reason, can still get the loan. So that means non-willful defaulter who did not repay for genuine reason, they can also get the loan. Now one more point is that loan distribution is quite fair. 50% for SC/ST, 15% for minority, 3% for person with disability. What about the group size? Remember, normally 10 to 20 women per SHG, but in remote area, even 5 is okay. Now what about Day-NRLM? So Day-NRLM support women group based on trust, based on bonding. For special cases, men and women can be a part of one group also. SHG following the Panch Sutra can get a revolving fund of rupees 10,000 to rupees 15,000. But remember, capital subsidy is no longer given under NRLM. So what I am telling you that Day-NRLM support women group based on trust and bonding, right? SHG who are following the Panch Sutra can get a revolving fund of 10,000 to 15,000. But remember, capital subsidy is no longer given under NRLM. Right, so this is a very easy explanation of every aspect. If you really think that you are understanding each and every aspect, please hit that like button. Under the Day-NRLM scheme, the Ministry of Rural Development give Community Investment Fund, that is called CIF. To whom they give CIF? So they give CIF to self-help group or SHG, but the money does not go directly. It flow through village or cluster level federation, who then give loan to SHG or fund community-based activity. So what I'm telling you that under the Day-NRLM scheme, the Ministry of Rural Development give Community Investment Fund to self-help group or SHG. So Ministry of MORD give what? Community Investment Fund to whom? SHG or SHG, right? But don't go directly. It flow through village or cluster level federation, and those cluster level federation then forward this fund to the SHG or fund based community activity. What else? SHG can also get interest subvention, right? That means the government help reduce the interest rate. If the bank charge 11%, NRLM pay the extra amount, so that SHG pay only 7% interest on a loan up to 3 lakh. So that is called interest subvention, which is given by the government. Now, important point is that JLG, that is called Joint Liability Group, they don't get any subsidy under this scheme. Also, if SHG have pending loan under the old SGSY scheme with subsidy, they won't get this benefit. Now one more important point is that to get loan under NRLM, SHG must be at least 6 months old. Very, very important. SHG must be active for at least 6 months. They should follow Panchsutra rule like regular meeting and saving. They should pass NABARD grading norms. And yes, KYC of all members are compulsory. So these are the very, very important aspect to get loan under NRLM. Important points is that 6 month old, Panchsutra they have to follow, pass NABARD grading norms, and yes, KYC of all members is very, very much compulsory. Even SHG that were inactive earlier but now revived and stable for 3 months can also get the loan. So some SHG that were inactive earlier, right? Some SHG that were inactive earlier but now revived and stable for 3 months, they can also get the loan. Bank must use a standard SHG loan form given by the Indian Bank Association. The goal is to give a small loan first, then gradually increase limit to help SHG build sustainable livelihood. That is the goal. First of all, give the small loan and then the bigger one, right? Increase the limit. Now let's talk about the CCL, that is called cash credit limit, right? So cash credit limit, it is given for SHG for 3 years. So it is approved for 3 years so that SHG don't have to submit document again and again, right? So first year you get 6 times your current saving or 1 lakh, whichever is more. Second year you get 8 times the updated saving or 2 lakh, whichever is higher. Third year you get minimum 6 lakh depending on your credit plan and repayment track record. And from the 4th year onwards, so first year how much you get? I told you first year you get 6 times your current saving. Second year you get 8 times the updated saving. Third year you get minimum 6 lakh. Right, you get minimum 6 lakh depending on your credit plan and repayment track record. From the 4th year onward, you can get more than 6 lakh based on your performance and future credit need. So the 3-year approval system make it easier for both SHG and the bank branch, less paperwork, more convenience. Now let's come to the term loan. It is also given in phases like this. First dose 6 times the corpus or minimum 1 lakh. Second dose 8 times the corpus or minimum 2 lakh. Third and fourth dose 6 lakh or more depending on your credit history. So overall, SHG get financial support in a step-by-step way. The better your performance, the more fund you can access. Now friends, let's talk about the next part, that is the SHG corpus or total fund, which include their own saving, which includes revolving fund from the government, which includes, so what are the things under SHG corpus? Let's understand how SHG manage their money and repay the loan. So SHG corpus include their own saving, includes revolving fund from the government, includes interest earned by lending to members, any other income, and even support from NGO or promoter. So loan given to SHG member are based on micro credit plan. What is MC? That is called MCP. MCP you call it, or micro credit plan you call it, both mean the same, right? So loan given to the SHG member, they are based on a micro credit plan. That is like a budget they prepare together to decide who need how much and for what purpose. So what I'm talking about, loan which is given to SHG member, they are based on MCP, micro credit plan. That is like a budget which they prepare together to decide who need how much and for what purpose. And the loan can be used for family or social need, paying off expensive loan, building toilets, starting a small business, or a common group activity like farming or tailoring. Now here is something important. If SHG take more than 2 lakh, 50% must be used for income generating work. Very, very important, right? Above 4 lakh if they take, right? If they take above 4 lakh, right? So at least 75% for income generation, and above 6 lakh, 85% for income activity like small businesses. This helps SHG grow and become financially strong. What is the loan repayment timeline? So first loan, pay back in 2 to 3 years. Second loan, pay back in 3 to 4 years. Third loan, pay back in 4 to 5 years. Fourth loan onward up to 7 years. Repayment can be monthly or quarterly, whatever suits their cash flow. And remember, for cash credit loan, SHG must make sure that they don't go over the limit for more than 30 days. I told you, maximum limit is the 30 days, right? Now, what about the term loan? Let's talk about it. So, you know that if an SHG pay both principal and interest within 30 days after the due date, it is called prompt repayment. What is the meaning of prompt repayment? SHG has taken a loan. They are paying both principal and interest within 30 days after the due date. So this is what we call, prompt repayment. So what is the rule? It says that no collateral or margin money is needed for SHG loan up to 20 lakh. So for self-help group loan up to 20 lakh, no collateral or no margin money is required. No lien or hold can be kept on SHG saving or any compulsory deposit. Willful defaulter are not eligible for new loan under Day-NRLM. So any kind of willful defaulter, they are not eligible. But if only few members are defaulter, the entire SHG should not be punished. So those defaulter can still join SHG internal saving activity, but bank loan will be stopped till they clear their dues. For opening an SHG saving account, only office bearer KYC is enough. You don't need KYC for every member. SHG member do not need a saving account individually to get a bank loan. Even a business correspondent or a BC, right, with bank approval can open an SHG account following the bank rule. PAN card is not mandatory. SHG can give a Form 60 affidavit instead. Now let's look at let's talk about the Day-NRLM. So Day-NRLM and Day-NULM, let's talk about it. So a special team at the regional and zonal office keep track of the SHG loan, make sure that rules are followed, and collect data from ground level to report upward. Financial literacy is a big focus. The goal is to help family understand banking, saving, insurance and loan. For this, Day-NRLM train financial literacy resources person who go to the village and teach people through local camps. Now, who fund Day-NRLM? It is a centrally sponsored scheme with 60:40 ratio holding funding between the center and the state. For Northeast state, it is 90:10. And for Union Territory, the center pay 100%. It cover, in cities we have Day-NULM, in rural area we have Day-NRLM. In cities we have Day-NULM, which was earlier known as NULM. It was launched in 2013. Friends, in cities we have something called Day-NULM, which was earlier known as NULM, and it was launched in the year 2013 by restructuring the old SJSRY scheme. This Day-NULM cover all the district headquarters and cities with a population over 1 lakh. Under Day-NULM self-employment program, urban poor, street vendor, hawker, they can get interest subsidized loan to start their own business, alone in group or through SHG. Now there is something called SEPG scheme. So under SEPG, loan can be granted either as a single group loan or as an individual loan up to 2 lakh per member with a group cap of 10 lakh based on the joint liability. So the first point says that under SEPG loan can be given in two ways. First of all, as a one combined loan to the group, right? As a one combined loan to the group, or as an individual loan or up to 2 lakh per member. So two ways through which SEPG loan can be given. As one combined loan to the entire group. What is SEPG? Self-Employment Program Group. The full form of SEPG is Self-Employment Program Group, right? So under SEPG, loan can be given in two ways, as one combined loan to the group or as individual loan of up to 2 lakh per member. But there is a total group limit that the group can't get more than 10 lakh in total, right? This is the total group limit, and all members are jointly responsible for the repayment. Then the next point is saving first, loan later. So before SHG get a loan, they must open a saving account and they must build some saving. This encourages saving habit. So then they can get loan based on their saving from 1 times to 4 times their saved amount. For example, if they save 10,000 rupees, they may get 10,000 to 40,000 as loan. Next point is bigger loan for mature SHG. So if a self-help group has a good track record, the bank may allow a loan more than 4 times their saving. This is to reward financially responsible groups. Now who monitor the SHG? It is the state or urban local body, which we call state and ULB, who identify and monitor SHG eligible for interest subsidy. Bank have no responsibility if a group was wrongly marked eligible. So in short, SHG must save first. Loan depend on group size and saving. Good SHG can get bigger loan. State and ULB tracks subsidy eligibility, not bank. Then let's talk about the retail banking. So friends, retail banking means banking for common people like you and me, individual, not businesses. It offers services like saving account, loan, credit card and more. Why is it important? Because it serves a huge number of customers. The risk is spread out. Even if few customers default, the impact is low, right? That is a retail banking. So retail banking is available via many channels, ATM, bank branches, mobile. So let's quickly understand how retail banking and corporate banking are different in simple term. So retail banking is for individual customer like you and me, and corporate banking is for business and big company. So as you can see, the segmented bank approach. So branch strategies in retail banking. However, what are the approach? Segmented approach, geography based approach, classification based approach. What is segmented approach? It means branches are grouped as resource, profit, priority or general, each with a different focus. As you can see, basically what we are doing, we are grouping the branch. So we are grouping the branch as resource, profit, priority or general, and each one with a different focus. Then we have the geography based approach. What happen? Services are customized as per the area. So they are tailored to the specific geographic area, which means services are customized as per the area. Then we have the classification based. What happen here? That products are designed differently for rural, for semi-urban, for urban and metro branches. So that is called, a strategy differ based on the branch type: rural, semi-urban, urban and metro, right? Now if you talk in terms of loan size, remember retail loan is for small mini customer, while corporate loan is for big fewer customer. If you talk about the risk, in terms of risk, in the retail banking, risk is spread across many people. In the corporate banking, higher risk is there because the loan amount is huge and fewer people are involved. So in terms of risk also, I think it is clear, because in retail banking, risk is spread across many people. In corporate banking, risk is higher because loan amount is huge and fewer people are involved. Now in terms of return, retail banking, higher interest profit because customer have less bargaining power. While in case of corporate banking, low profit per loan because company negotiate better rate. If we talk in terms of monitoring, so retail banking, more effort to track lot of small loan, while in corporate banking, since there are less account, so they are easier to monitor. In terms of deposit cost, retail banking has a smaller cost, it is cheap for bank, while for corporate banking, since deposit are big, right? So since deposit are big, so bank need to offer better interest rate. So that is in terms of deposit. You know it very well that NPA, net non-performing asset, they impact corporate banking more severely than retail banking. Why? Because of the higher loan ticket size. Yes, you know it very well that in the case of corporate banking, ticket size is very high as compared to the retail banking, right? So that's why NPA impact corporate banking. There are some kind of product like augmented, key tool for both investor and the lender to make a smart decision. So friends, financial statement analysis, it helps us understand how strong a business is financially. It is a key tool for both investor and lender to make a smart decision. Now what are financial statement? So financial statement are just like official report that shows what a company on, what it owes and how it is performing financially. So they help you make complex number easy to understand. Now there are four main financial statement. Four main types of financial statement are there. The first is called balance sheet. So balance sheet, it shows the assets, liabilities, equities at the specific date. You can think of it as a snapshot of the company financial position. Second kind of statement we have is called income statement. So income statement shows revenue, expense, profit or loss over a period. It helps assess how the business performed. Third kind of financial statement we have is called cash flow statement. So cash flow statement track actual cash in and cash out from the operation, investment and financing. How much cash is coming in, how much cash is going out from the operation, from the investment, from the financing, that is taken care of by the cash flow statement. And finally we have the statement of change in equity. So statement of change in equity, it explains changes in the owner stake in the business, right? So as you can see, cash flow statement, I told you how much cash is coming in, how much cash is going out from operation, investment, financial activity. That is shown by the cash flow statement. And a statement of change in equity, what does it represent? It explains changes in the owner stake in the business. That means how much is the owner stake in the business is changing. So these are often explained with notes or commentary from the management. So most investors start with the income statement to check how profitable the business is during a period. So from where they start from the income statement. So the next time you look at the company financial, remember these 4 statements tell you the whole story, right? Now friends, let's discuss cash flow statement in more detail. Ever wondered where a company money really goes? Let's decode 2 powerful tools, the cash flow statement and the statement of change in equity in the simple word. First of all, cash flow statement track how cash move in, how cash move out during a specific period. Means during a specific period how cash is moving in, how cash is moving out. That is what is shown by the cash flow statement. It shows the opening cash balance, it shows the ending cash balance and how that change happened, right? So we are talking about the cash flow statement. It shows the opening cash balance, ending cash balance, how that change happened. Everything is shown by the CFS, that is the cash flow statement. So it is divided into 3 key parts. The first part is called operating activity, second part is called investing activity, third part is called financing activity. Operating activity include cash from daily business operation like sale, like expenses. So whatever cash whatever is coming in or going out from the daily business operation like sales and expense, it is covered under operating activity. Second kind of activity we have is the investing activity. So basically it includes cash which is used for buying or selling long-term asset like equipment. So suppose you are buying or you are selling long-term asset like equipment. So whatever cash is being used for this purpose goes into the investing activity. And third kind of activity we have is the financing activity, which means cash from loan, equity, repayment, interest, dividend. All these are covered under the financing activity. So 3 kinds of activity I told you. Operating means cash from daily business. Investing means cash used for buying and selling long-term asset. And financing means cash from loan, equity, repayment, interest, dividend. So basically this help us understand the real cash position, not just profit, right? So I hope it is clear now what is operating, what is financing, what is investing. Now friends, there is something called a statement of change in equity. This is also called retained earning statement. It shows how owner equity changed during the period, whether due to profit, losses, dividend or new capital introduced. So a statement of change in equity shows how the owner equity changed during the period, whether the reason may be many, due to profit, due to loss, due to profit, loss, dividend, new capital introduced. Because of all these reasons, that owner equity can change, right? So that is shown by the statement of change in equity. Now every financial statement comes with detailed notes. These explain the number in more detail and are crucial for proper interpretation. Now there are 2 common analysis methods. The first method is called horizontal analysis, which we also call trend analysis. So either you call it horizontal analysis or you call it trend analysis. What it does, it compare performance across different period. And then we have the vertical analysis. So vertical analysis look at each item as a percentage of the total in the same period. So basically, the moral of the story is that, cash flow statement tells you where the money flow. Equity tell you how the value is built. And analysis helps serve all of it. So friends, if you are looking for such kind of PDF which help you revise the entire content in a very small time, you can go for our CCP certification course, the link of which I have provided in the description section, or you can WhatsApp me on the number 8292857381, right? I again repeat 8292857381, right, for getting the detail regarding the PDF. Now friends, let's move forward. So we have talked about the 2 types of analysis we have, horizontal analysis and vertical analysis, right? So I told you in horizontal analysis, also called trend analysis, it compare performance across different period, and vertical analysis looks at each item as a percentage of the total in the same period. Now let's switch our focus to the vertical analysis. So suppose you are confused between vertical and horizontal analysis, or you are wondering about what exactly asset and liability means. Let's simplify financial statement for you. So basically, what vertical analysis does, it looks at one period and express every item as a percentage of the total. So basically what it does, it look at one period and express every item as a percentage of the total. For example, income statement item as a percentage of the gross sale, balance sheet item as a percentage of the total asset. So this is how vertical analysis looks like. Horizontal analysis compare the same item across multiple period. So basically, if you want to spot trend, horizontal analysis is the best tool you have. Why? Because it compare the same item across multiple period. And what vertical analysis do? It look at one period and express every item as a percentage of the total. right? So remember the difference. Horizontal analysis help in trend analysis, help in spotting the trend. Like you can compare the same item across multiple period. Vertical analysis look at one period and express every item as a percentage of a total. Now let's talk about the financial ratio. Ratio help compare two financial figure to assess the performance. Suppose you have to assess the performance, and for that you have to compare two financial figure, and that is what ratio helps in. For example, profit margin is equal to net profit divided by sales. That is one financial ratio called profit margin. How to find the profit margin? So to find the profit margin, you first of all you take the net profit and you divide it by the sale. That will give you the profit margin. Now let's talk about the balance sheet basic. So balance sheet had three key parts: asset, liability and equity. What is asset? So when the company own that bring future benefit. What the company own that bring the future benefit is called asset. Second is called liability. Liability means what the company owe to the other is called liability. And third is called equity. Equity is the owner's share in the business. So I told you the balance sheet has three key parts: asset, liability and equity. Asset means what the company own that bring future benefit. Liability means what the company owes to the other, and equity means the owner's share in the business. So remember these three things, right? Asset represent the valuable resource owned by the company, liability reflect the company obligation, and equity reflect the owner's share in the business. And remember the golden rule. The golden rule is that asset is equal to liability plus equity. So that is the golden rule. Now friends, let's understand the asset. Whenever I say asset, it means use of the fund. They usually have a debit balance and they help you earn the income. That is the meaning of asset, right? Asset is also called the use of fund. They have the debit balance and they help you earn income. They enable the business to earn income. How to categorize the asset? So at asset are categorized into current asset. Current asset means easily converted into cash, like inventory, cash receivable. These are called current asset. Assets are also includes long-term asset. So they are held for longer duration, like machinery, like land. Assets are also include tangible asset, which are the physical item. Asset also include intangible asset, like non-physical but valuable item. So whether you are analyzing the trend or breaking down balance sheet, understanding these basics give you a powerful edge in the finance. Now friends, let's switch our focus to other kinds of asset we have. So if you want to understand how financial healthy a business is, from short-term cash flow to long-term stability, let's break down the key financial concept. What is intangible asset? Intangible asset are non-physical but valuable asset, like trademark, copyright, goodwill, right? These are intangible asset. Long-term asset include things like land, building, machinery, which are used over year in operation. These are called long-term asset. Current asset, these are short term. They are converted to cash within a year, within 12 months. For example, cash, account receivable, prepaid expense. So, cash is a kind of current asset. Prepaid expense means expense that you have already paid is a kind of current asset. Account receivable is a kind of current asset. Now, if we talk about the liabilities and honor equity, so liability are the debt that the business owe. Basically, the creditor claim on the asset. So, liability has also some parts like current liability. Current liability means, due within a year, like account payable, like accrued expense. So these are called current liability. So they are due within a year, right? Then we have the long-term liability, which are payable after 1 year. Remember, long-term liability are payable after 1 year. So two kinds of liabilities are there: current liability and long-term liability. And there is a equation. The equation is that honor equity is equal to asset minus liability. Very, very important thing. One equation I told you here. What was the equation? This is a very important equation. Let me just summarize you that asset is equal to liability plus equity. So this can also be written as like honor equity is equal to asset minus liability. Right? I hope it is clear. Now friends, it is also called net worth or book value and shows what the owner truly own. What shows honor equity. Now friends, there is one more equation which says that asset is equal to liability plus honor equity. This equation, asset is equal to liability plus honor equity, shows how a business is financed, through debt or through ownership. So there are some ratios which assess the bank financial strength. The first ratio is called liquidity ratio. It shows the short-term strength. Then we have the current ratio. Current ratio, this is current asset divided by current liability. Then we have the quick ratio. Liquidity ratio we talked about. Current ratio, it includes current ratio like current asset upon current liability. Quick ratios, quick asset upon current liability. Net working capital, which includes current asset minus current liability. So remember, these are the important formula. I am again repeating, right? Current ratio, right? You must know what is current ratio. You must know what is quick ratio. So current ratio, remember, current asset by current liability. Quick ratio is, this is also called acid test ratio, which is quick asset by current liability. Net working capital, how to calculate that? Current asset minus current liability. Working capital gap, current asset minus CLOBB. What is CLOBB? Current liability other than bank borrowing. Then we have the solvency or leverage ratio. So what is included under solvency or leverage ratio? So they indicate the long-term strength. Under the solvency ratio, you have the first kind of ratio, that is debt equity ratio, tangible net worth, etc. Then we have the activity ratio. What are the activity ratio? This is stock turnover ratio, this debtor velocity ratio, creditor velocity ratio. They are called activity ratio. So broadly we can say liquidity ratio includes current ratio, quick ratio. Solvency or leverage ratio include DER, tangible net worth, and activity ratio include stock turnover. So let's continue our discussion further. Working capital, net worth, expenses type, these are confusing terms, not anymore. Let's decode them in the simple word. So what is the meaning of net working capital? It is current asset minus current liability. It shows a company's short-term liquidity. Another approach is that you compare long-term source versus long-term use to understand the owner's actual contribution. Right? Basically, net working capital shows what? Owner's actual contribution. Whenever a bank gives loan, it asks the owner to contribute something, and that contribution is called net working capital. So how to get this net working capital? You subtract current asset minus current liability, or you compare long-term source versus long-term use. Then we have the working capital gap. So it is a difference between current asset and current liability excluding the bank borrowing. So this gives a clear view of the working capital need without bank support. Yes. So how much working capital you need without bank support? That is characterized by WCG, working capital gap. Now one more thing is the net worth. Net worth, how to find? So you add capital and reserve, you will get net worth. Right? You add capital to reserve, you will get net worth. Net worth just means sum of two things, capital and reserve. Net worth are of two types, tangible net worth and intangible net worth. See, tangible net worth, how to find? See, so first of all, you take the net worth and you subtract from them intangible asset. So net worth minus intangible asset, this will give you the tangible net worth. Then some ratios that you must know. First is the stock turnover ratio, which is net sale divided by stock. How to find the stock turnover ratio? In the numerator you write the net sale, in the denominator you write the stock value. So it tells us how quickly inventory is sold, right? That is called stock turnover, right? What is the net sale? How much you have sold, and in the denominator you write the stock, right? So per unit stock, net sale, that is called stock turnover ratio. Second is called debtor velocity ratio. These are the very important ratio. Debtor velocity ratio, so how fast you collect your receivable. What is the meaning of receivable? Receivable means what? Suppose you have a business and suppose you are engaged in giving out some kinds of goods. Okay, so suppose you sell some goods on credit and you have not received the payment yet. So that payment that is yet to be received is called receivable. And this receivable, how fast you receive the receivable, is shown by the debtor velocity ratio. So what is the formula for it? Quite simple. In the numerator you write the debtor. Debtor simply means the amount that is owed to you, that you will get right after a few time. So debtor you have to write, you have to multiply it with 12 and divide by net sale. This will give you the debtor velocity ratio. Then we have the creditor velocity ratio. So creditor velocity ratio measure how quickly you pay your supplier. Sometimes you also take some goods or services on credit, right? And obviously you have to pay that. So that is called creditor. In the numerator you write the creditor, multiply it by 12, divided by the net sale. So this will give you the creditor velocity ratio, means how quickly you pay your supplier. So remember, these are these three ratios: stock turnover. In the stock turnover ratio, we divide net sale by the stock value, and the remaining these two ratios we divide debtor and creditor by the net sale, and here by purchases. Now friends, one more point is the DER, debt equity ratio. As the name suggests, in the numerator we write the total long-term debt. In the denominator we write the tangible net worth. Remember, we don't write the net worth, we write the tangible net worth, equity, right? I told you now. Basically, if we talk about the net worth, it includes capital and reserves, right? And tangible net worth includes net worth minus intangible asset. So here we are taking only tangible net worth. We are not taking intangible or net worth, right? How to find the tangible net worth? So what you need to do to find the tangible net worth, first of all, you take the net worth, and from the net worth, you subtract the intangible asset. This will give you the tangible net worth, right? So that is how we calculate the DER, debt equity ratio. So basically, sometimes some expenses are also there. Some expenses like prepaid expense. Prepaid expense, these are paid in advance for future service like rent, you have paid the rent in advance. So it is treated as a current asset. Remember, these are the very important thing. Prepaid expense always treated as a current asset. Pre-operative expense, they are incurred before the business start operating. And the preliminary expense, they are cost during company setup. So both pre-operative and preliminary expense, they are treated as intangible asset. With these basics, you are ready to interpret financial statement like a pro, one ratio at a time. Right. Now friends, let's switch our focus to, is your business financially stable in the short run? Let's decode the balance sheet and the current ratio in the easiest way possible. The balance sheet shows the gross block, which means the original value of the fixed asset like the land, machinery or the building. But after subtracting depreciation, we get the net block. Obviously, you have the gross block, you subtract the depreciation, you get the net block. Net block is the actual value of the asset today, right? So that is what balance sheet shows. It shows the gross block, and after subtracting the depreciation, you get the net block. Now let's understand the current ratio. Current ratio is a major liquidity indicator. What is the formula for current ratio? Current asset by current liability. It tells whether the business can pay off its short-term obligation or not. So this current ratio tells you whether a business is capable of paying its short-term obligation or not. Now what are the current assets? So basically, these are items expected to turn into cash within a year or the business operating cycle, whichever is longer. Two things are there. Either basically these are the items which are expected to turn into cash within a year or within the operating cycle, whichever is longer. Either operating cycle is longer or within or a year is longer. Whichever is longer, turn into cash. Even if it takes over a year to convert to cash, it is still like a current asset if used in daily operation. Sometimes it takes over a year, more than a year to convert to cash, like in long production cycle. So it's still a current asset if it is used in daily operation. Now what is current liability? I hope current asset definition are clear. Now current liability, basically this includes amount due within 12 months or the business cycle. Right? Some amounts, they are due within 12 months or the business cycle. They are called current liability. Even every types of working capital loan, though sometimes sanctioned for more than a year, they are considered current liability because they are payable on demand. Remember, this is a very important thing I am telling you, that working capital loan, even though they have been sanctioned for more than a year, still they are considered current liability because they are payable on demand. Now the question is how to read the current ratio. So current ratio can be above 1, can be exactly 1 or can be less than 1. If it is above 1, so it is good, means company can meet the short-term debt. If it is exactly 1, it means just enough asset to cover the liability. And if it is below 1, it means risky. You may struggle with the short-term payment. But remember, there is no fixed ideal ratio. It varies by industry. So it is best to compare with the peers. Above 1 means, company can meet the short-term debts because, current assets, so current ratio, so the current asset by current liability means obviously, you have to, those assets, how can you manage those assets? By having current liability. So if it is above 1, it means asset is more, current liability is less. It is a good signal, right? Then if it is exactly 1, so it means, it is just enough asset to cover the liability. Yes, we have to cover the liability. We have just enough asset to cover the liability. Right? And if it is below 1, it may struggle. But one more thing I want to tell you, if the current ratio is higher than 1, sometimes 1.8, 1.9, what does it indicate? It indicates that we have more inventory at our disposal. So this means, this lower our efficiency, right? So, gross block, net block, current ratio, each number tells a story. Know the meaning and you understand your business better. Now friends, let's switch our focus to the quick ratio. Quick ratio and cash ratio give us more accurate picture of liquidity. They exclude less liquid terms like inventory and prepaid expense. They are less liquid. So all those are excluded, showing whether the company can meet short-term debt immediately or not. So this is called, quick ratio. I hope it is clear. Right. So how to find the quick asset? It is nothing but current asset minus inventory or any kind of prepaid expense. You subtract this and you will get the quick asset, and divide it by the current liability, that will give you the quick ratio. Now let's talk about the activity ratio. Activity ratio measures the efficiency, which means they also call the turnover ratio or efficiency ratio. That tells us how well a company uses its asset to generate sale. Yes, see, while we're talking about the liquidity ratio, what we were more focused on, we were more concerned with whether a company is able to use its asset to generate liability. That is what we were focused on when we were talking about the asset, right? Whether the particular company is capable of converting, basically whether the company have enough asset to cover its liability or not. That we were concerned with. Now when we talk about the activity ratio, what we are concerned with, whether the company has enough asset to generate more sale, right? That is what activity ratio shows. So basically they compare sale with a specific asset like inventory, receivable, helping us see how efficiently the business run. So basically what we do in these kinds of activity ratio, we compare two things. What two things we compare? We compare, asset and sales, right? So assets like inventory we compare, receivable we compare, right, with respect to the sales. Now first of all, the first kind of ratio we have the stock turnover ratio. This is also called inventory turnover or stock velocity ratio. This ratio shows how often inventory is sold and replaced during a period, right? How often inventory is sold or replaced during a period. What is the formula for it? So it is very simple, COGS divided by average inventory. In the numerator you write the COGS, which is cost of goods sold, and divided by the average inventory, right? So this is called a stock turnover ratio. I told you basically we are comparing the sales. We are comparing the sales with respect to the asset. And what is our asset here? Our asset here is the inventory, right? So it sells as COGS upon average inventory. So what is COGS? COGS is the cost of goods sold. How to find COGS? First of all, you take the opening inventory, then you write any kind of purchase you made or any manufacturing cost you have, and you subtract the closing inventory from it. So you will get the cost of goods sold. Very simple to understand. Means whatever goods you have sold, what is the cost of that? So first of all, how much investment you have done? That is the opening inventory. Then is some kind of purchase you have made, that is also a cost that you incurred, and you have to subtract the closing balance from that. So that will give you the COGS. So that COGS has to be written in the numerator, and this COGS it's just like a sales. And in the denominator you write the inventory, which is a kind of asset. So basically average inventory, which means initial inventory plus final inventory divided by 2, right? So basically if we divide the COGS by the average inventory, this will give us the stock turnover ratio. So what does it indicate? It indicates how fast our stock is moving. Faster movement means our sales is efficient and less money locked in the inventory. It's quite simple to understand, because you look at this particular ratio. In the numerator we have COGS, in the denominator we have the inventory. So basically this ratio shows how fast our stock is moving, right? So if the stock is moving very fast, it simply means our sales is quite efficient and the less money is locked in inventory, right? So that is what it indicates. I hope it is clear now. Friends, if you really think that this video is helpful to your understanding, please hit that like button. This will motivate me to make more such and such content, right? Now friends, let's talk about the next kind of ratio. We have the inventory holding ratio. So inventory holding tell you the average time it takes to sell the inventory on hand. And this inventory holding is very critical for business managing supply chain and stock level. So better liquidity, smarter stock control, efficient asset use, that is what this ratio help you track. Master them and you master business insight. Now friends, have you ever wondered how fast a company get paid after making sales on credit? Let's decode the debtor turnover ratio in the simple term. So if we talk about the debtor turnover ratio, this is also called receivable turnover ratio. It tells us how efficiently a company collect money from its credit customer. It shows how quickly credit sales are turned into cash. So why it matters, if this ratio is higher, it means fast collection, good liquidity, efficient business. If this ratio is lower, it means slow collection, possible cash flow issue. What is the formula? How do we calculate the debtor turnover ratio? The formula is very simple. If you want to basically this account receivable ratio, the formula is net credit sale divided by the average trade receivable. Don't get confused by this term. They are very easy to understand. Net credit sale means how much sale you have. See, remember one thing, all kinds of activity ratio just deals with two things, sales and asset. Just remember it. Just keep it in mind. Whether it is stock turnover ratio, whether it is debtor turnover ratio, whether it is a creditor turnover ratio, no matter what, everything deals with two things, sales and asset. Now let's talk in the context of this debtor turnover ratio. What I told you, in terms of sale we have the net credit sale. Yes, some sales we have done on credit, so that we write in the numerator. That is called net credit sale. In the denominator we write average trade receivable. What we write? Average trade receivable, right? So I hope it is clear now. Now you will not forget it for the lifetime, because you have just got the crux of it. Whenever we deal with any kind of activity ratio, be it a stock, be it inventory, or be it any type, we are just dealing with sales versus asset. That's it. So in the sales, here since we are giving the sales on credit, so we have the net credit sale, and here the asset is what asset we have. The kind of asset we have is the trade receivable is the asset. In the stock inventory case, the inventory was the asset. Here trade receivable is the asset. Only the asset nature changes. That's it. So basically, what is the significance of this ratio? This ratio tells us how many times receivable were collected during a period, right? That is called debtor turnover ratio. And there is something called debtor velocity. How to find this debtor velocity? See, it is very simple. It tells you how long does it take to collect money from customer. So what you do to find the debtor turnover ratio, debtor velocity? First of all, you take the average book debt. Book debt is the same. Do not get confused by the book debt. Book debt or trade receivable both mean the same. So average book debt divided by the net sale multiplied by 365 for day or multiplied by 12 for month, that will give you the average collection period, right? Also called debtor velocity. So why it is useful? Because it helps a business to plan in cash flow, meet payment on time, avoid cash crunches. So remember, these two ratios, they are super important. First of all, we talked about debtor account receivable turnover ratio. Second ratio we talked about is the just now we talked about the average collection period. Now the fast collection cycle means better cash flow. So track your receivable closely. They are not just number, they are your incoming cash. Now friends, then the next kind of activity ratio we have is the creditor turnover ratio. Now friends, let's talk about the creditor turnover ratio. So basically, if you want to know how fast a company pays its supplier and what it say about its credit worthiness, let's simplify the creditor turnover ratio. So it is also called account payable turnover. So this ratio shows how quickly a business pay off its supplier. So it is a key sign of the company's payment discipline and credibility. If this ratio is higher, it means fast payment to supplier, it means good credit worthiness. And if this ratio is lower, it means if the credit turnover ratio is lower, it means delayed payment, it means possible cash flow issue. But remember, this depends on the credit term. If supplier give long payment period, this ratio may naturally be lower. So pay your supplier on time, but also utilize the full credit period offered. This helps with the better cash flow management, right? So what is the formula for credit turnover ratio? So in the numerator you write the credit purchase, in the denominator you write the average account payable. So this shows how many times you clear your payable during a year, right? That is how to show. Now there is something called average payment period or creditor velocity. See, it shows how long on average does a company takes to pay its supplier. So what is the formula for average payment for this average payment period or creditor velocity? So you write average creditor divided by purchase multiplied by 365 for days or 12 months, 12 multiplied by 12 for months, right? So average creditor divided by purchase multiplied by 365 for days or 12 for month. There is something called trend analysis, is that if the creditor turnover ratio decreasing ratio, it means you are delaying payment more than before, and if the ratio is increasing, it means you are setting your dues faster. So paying supplier on time builds trust, keep operation smooth. Track this ratio to keep your credit reputation strong. Now friends, let's have a look at the next ratio. Ever wondered how money flow in business from buying goods to receiving payment? Let's break down working capital and the operating cycle in a plain English. So first of all, gross working capital refers to the total investment in the current asset like cash, stock, receivable, etc. So what is your total investment in the current asset? That is shown by the gross working capital, right? I hope it is clear. Total investment made in the current asset is called gross working capital. Then we have the net working capital. It shows how much of the current asset are funded by the long-term source. Yes, total investment in the current asset means gross working capital. But out of the total investment which we are doing in the current asset, how much is funded by the long-term investment, long-term source? Basically, the owners or promoter investment in day-to-day operation is what is called by the net working capital. It is also called the surplus of the long-term fund over long-term use, which act as a cushion to fund the working capital need. Yes, so you have to fund your working capital need. Working capital is a kind of asset, right? So to fund those working capital need, you require some long-term source like promoter security, right? So these things, this particular thing is shown by the net working capital, means you have to put money into the current asset, right? So current asset has to be funded. But what is the source of those funding? The source of those funding is long-term source like promoters or owners investment, right? So total investment in the current asset, that is gross working capital, but the total investment in the current asset made from the long-term fund or long-term source, that is the net working capital. So, and then we have the working capital gap. So which is, this gap reveals the part of the asset that must be financed by the business itself or other long-term source, right? So those part of the asset which has to be financed by the business itself or other long-term source. That is called working capital gap. So how to find the WCG? Current asset minus current liability excluding the bond. Reveals the part of the asset that must be financed by the business itself or other long-term source. That is called working capital gap. Now let's talk about the operating cycle. So operating cycle is a full circle, right? So operating cycle, it is a full circle which of how working capital flow through the business. So what are the parts of it? I told you that it includes, buy raw material, produce goods, sell finished product, collect cash from customer and pay to supplier. So this is how the working capital cycle looks like. So for trading business, as you can see, working capital cycle, again I'm repeating, buy raw material, produce goods, sell finished product, collect cash from customer and pay to customer. For trading business, the cycle starts from buying inventory to selling it and collecting money. For manufacturing, it includes raw material purchase, then production, then sales and then collection. Now there is something called red flag. Red flag is that a rising account payable turnover ratio may looks good, but if it is too high, it might mean company is not investing enough back into the business. So understanding working capital and the operating cycle is the key to manage the cash flow. Now let's look at the profit and loss statement. If you want to know if a business is actually making money, let's break down the profit and loss statement step by step. What is this PL&A statement? It is also called income statement or statement of operation. It shows a company revenue and expense over a specific period, like a quarter or a year, right? So how much is the company revenue, how much is the company expense over a specific period is shown by the profit and loss statement, right? So it tells us how will the company generate profit, through higher sale, lower cost, or through both. So how will a company generating the profit, either through higher sale or through lower cost or both? Obviously if sale is higher, then profit will be higher, cost is lower, profit will be higher, or both will be done, obviously the profit will be higher. There is something called revenue. Revenue is the money earned from selling goods and services after returns and discounts. And the cost of goods sold, that is COGS, is means all direct costs tied to making or buying a product. All kinds of direct cost which is connected or which is tied to making or buying a product is called COGS, like raw material, labor and shipping. How to find the gross profit? See, gross profit is the subtraction between, if you subtract the net revenue, if you subtract the COGS from the revenue, you will get the gross profit. So you take the COGS, means all the direct cost, and you subtract the revenue, you take the revenue, you subtract the COGS, that you will get the gross profit. Simple formula. The profit formula, sales minus cost. So your revenue is the total sales, COGS is the cost, subtract both of them, you will get the gross profit. Then we have the operating expense. So these are the indirect costs needed to run the business. So it includes some selling expense. What is selling expense? Like advertisement, commission, shopping. It includes some administrative expense like office, salary, rent, insurance. So these are some of the indirect costs needed to run the business. Then we have the operating income. Operating income after subtracting, first of all we have the gross sale, right? So we have the revenue. From revenue we subtract the COGS, we get the gross profit, right? Then we have some indirect costs needed to run the business like selling expense, administrative expense. After subtracting the operating expense from the gross profit, we get the operating income. So from gross profit, if we subtract the operating expense, we get the operating income. So this is a cycle, right? First of all, you take revenue, subtract COGS, you get gross profit. From gross profit, we subtract the operating expense. You will get the operating income, which is the company core profit from running the business, right? So the P&L statement, that is profit and loss statement, is like a report card of a business. It shows what comes in, what went out, what is left. Master it, and you will understand the heart of any business. Now, friends, there are some more important points. So first of all, we have other income and expense. So this include things like dividend, interest earned, interest paid, gain, losses from the financial asset. They are not part of day-to-day operation, but still impact the bottom line. So first of all, income before tax. How to find the income before tax? You write the operating income, you add other income, and you subtract any other expense. That will give you income before tax. You have not paid tax yet, however, whatever income you have. So operating income plus other income minus other expense. This give you the PBT. Right, profit before tax, income before tax, PBT. How to find PBT? Operating income plus other income, subtract expense. This will give you PBT. Now comes the star of the show, which we call net income or net profit. So this is what the company truly earned after all cost, all taxes, all expenses are subtracted. It is the final profit. So to evaluate performance, we also have some kind of ratios called profit ratio. This question is asked, what is the gross profit ratio? How to basically gross profit ratio to calculate it, gross profit by net sale multiplied by 100. It shows how efficiently the business is managing production cost, right? How efficiently the business is managing the production cost is shown by the GP ratio. A higher GP ratio means either higher selling price or reduced production cost. See, the ratio is quite simple. In the numerator we write the profit, in the denominator we write the sale, multiplied by 100. So if the ratio is higher, it means selling price is higher or production cost is lower. Both are the good sign, right? If the GP ratio is higher, it simply means the selling price is higher or production cost is lower. Both are the good sign. But if the product price drop, input cost rise, or the operation slow down, so the GP ratio will fall down. So that is what is indicated by the GP ratio, how efficiently the business is managing the production cost. Then we have the net profit ratio. Net profit upon net sales multiplied by 100. It tells us how much real profit the company is making from its sale. Higher net profit ratio means lower overall cost, means better financial strength. So remember, net sale is equal to cash sale plus credit sale minus sales return. Net profit is equal to revenue minus all direct and indirect expense. So these ratios, if you track over the time, they help you analyze the performance and spot any kind of trend. Now friends, if you have a low, so I told you now that let's quickly decode some key financial concept. First of all, we have the net profit. Suppose your net profit is low, it means that your direct or indirect costs are too high, eating your profit, right? If your net profit is low, it means your direct and indirect costs are too high, so it will eat your profit. Then we have the operating income, right? So net profit, we have talked about operating income. This is what you get after subtracting operating expense. So after you subtract your operating expense like wages, rent, utilities, logistic. So after you subtract these kinds of operating expense from the gross profit, what you get is the operating income. So how to calculate the net profit? From operating income, when you subtract interest and tax, you get the net profit, which is the company final earning, right? So how to find the net profit? Very simple. First of all, you take the operating income. From operating income, you subtract any kind of tax you have paid, any kind of interest you have paid, and you will get the net profit, right? And how to get the operating income, right? I told you very easily. Now, the next point is profit and loss management. Managing the profit and loss statement means keeping a close eye on both the income and the cost to boost your profitability, right? So from gross profit, if you subtract operating expense, you will get operating income, and from operating income, if you subtract the any tax you have paid, any interest you have paid, you will get the net profit. So remember the sequence, right? Now friend, there is something called net DSCR. DSCR is called debt service coverage ratio. So basically this tells you if the business can pay debt using its cash flow or not. So what is the formula for DSCR? In the numerator we write the net cash inflow, and in the denominator we write the total amount of obligations we have, loans we have, means interest and principal we are paying, right? So revenue divided by debt service, that's it. Revenue divided by debt service means how much cash flow inflow we are generating and how much is our debt service. We compare both of them, we will get net DSCR. Remember, if it is more than 1, you are safe. If it is less than 1, your repayment is in trouble, right? You have the repayment trouble, remember it. Now let's talk about the gross DSCR. What happened in the gross DSCR? You subtract operating expense from the revenue and divide by the debt service. See, in the net DSCR, what we were doing, we were just writing the revenue in the numerator, and in the denominator, what we are writing? In the numerator, we are writing the revenue. In the denominator, we are writing the how much expense we have, right? How much debt service we have. That will give us net DSCR. If it is more than 1, you are safe, means you have enough revenue to cover your debt service. If it is less than 1, you are unsafe. Now let's talk about the gross DSCR. When we talk about the gross DSCR, what we do, we subtract operating expense from revenue and then divide by the debt service. That's the difference. See, in the net DSCR, we just write the revenue in the numerator. In the gross DSCR, we subtract the operating expense from revenue, right? So basically, gross DSCR include non-cash expense like depreciation also, right? So it shows the potential to repay, while net DSCR shows the actual repayment capability. So remember, if gross DSCR is high but net DSCR is low, it means non-operating or non-cash costs are draining the real cash. So two kinds of DSCR we have: gross DSCR, where we subtract operating expense from revenue and then divide by the debt service. It shows the potential to repay, while net DSCR shows the actual repayment capacity, right? So suppose gross DSCR is high, net DSCR is low. It means non-operating cash or non-cash costs are draining the real cash. Let's do the fund flow analysis now. So we have talked about the cash flow statement, we have talked about the balance sheet, we have talked about the P&L account. Till now we are talking about the same. Now let's switch our focus to the fund flow analysis. So it helps you see where the fund are coming from, where they are going, connecting the short term and the long term financing. So remember, track cost, manage cash wisely, and monitor DSCR to maintain the financial strength. So what is the fund flow basic? It compares two balance sheet to track where the fund came from, like new loan, capital, and where they are used, like buying the asset. Now try to understand. If the liabilities goes up, that is a source of fund. If the asset goes up, that is a use of fund. If liability fall, that is a use of fund. If asset fall, fund get freed up. Remember it, right? So liabilities goes up, asset goes up. So friends, if we talk about the fund flow basic, you know it very well. If liability goes up, that is a source of fund. If the asset goes up, that is a use of fund. So using long-term fund for short-term need is okay, but using short-term fund for long-term asset, that is risky. It can reduce liability, it can reduce liquidity, and it can reduce the current ratio. This is called diversion of fund. What is diversion of fund? Suppose you are using long-term fund for short-term need. It is okay. You can use long-term fund for short-term need. That is what NWC is all about. But you are using short-term fund for long-term asset. You are using short-term fund for long-term asset, right? So that is risky. You can't use short-term fund for long-term asset, right? So it can reduce liquidity ratio and it can reduce the current ratio, right? So this is called, what happened, that when term loan installment are paid, the outstanding loan balance reduces and fixed asset reduce in value over the time due to depreciation, right? So that is what I'm talking about. When term loan installment are paid, outstanding loan balance comes down and fixed asset reduce in value over the time due to depreciation. On the flip side, retained profit increases reserve balance. So that is term loan and depreciation. Now friends, if you compare fund flow and cash flow statement, so fund flow statement work on accrual basis. Very, very important part I'm telling you, right? Remember, this fund flow statement, it work on accrual basis, right? That means they show the real movement of the fund. But cash flow statement work on the cash basis, means they record actually the actual cash transaction only. You know the meaning of accrual basis and cash basis? It is very simple. For example, depreciation or revaluation, no real cash flow is there, so it won't show in the cash flow, right? So fund flow statement work on the accrual basis, means it is recorded only when it is accrued, right? So that is cash flow basis, right? So they show the real, they will show the real movement of fund, that fund coming in, fund going out, that is the fund flow statement. But the cash flow statement work on the cash basis. They record actual transaction happen. Suppose, for example, let me give you one example, like depreciation. So depreciation, you can't show the depreciation, right? You can just anticipate that this particular machine is going to have wear and tear in the next 4 months or 4 years. So that is called accrual basis. No real cash flow is there in the case of depreciation. So it will never be shown in the cash flow. It will be shown in the fund flow statement, which is be very, very important point. Remember this thing, right? Now friends, some terms you must know, that fund flow statement is also called source and application of fund, movement of fund statement, where fund come from and where the fund went. Then we have the next point, that is called ROE, return on equity. To compute the return on equity, we write the net profit and we compare the net profit with respect to the TNW. What is TNW? Tangible net worth. And we multiply it by 100. So it shows how efficiently profit is generated using the shareholder money. So we are talking about ROE. ROE means return on equity. In the numerator of the ROE, we write the net profit. In the denominator, we write the tangible net worth multiplied by 100. That will give you ROE. It shows how efficiently profit is generated using the shareholder money. We have the shareholder money, how efficiently we are able to generate the profit, that is what is shown by ROE. Then we have the ROI. What is ROI or ROCE? So this is basically we compare net profit with respect to the total investment. This shows return compared to the total capital invested. That is called ROI. So return on equity means equity, right? Shareholder money, that is equity. That is called tangible net worth. So remember, tangible net worth is the same, right? There are some net worth which are intangible. Can you give me some example of intangible net worth? Please type in the comment section. So there are some net worth which are intangible, but there are some net worth which are tangible, which are actual shareholder money. So when we compare profit with respect to the tangible net worth, this is called ROE. And if you compare profit with respect to the total investment, this is called ROI, or we call it ROCE. So now let's talk about this ROI and ROE in detail. So friends, return on investment and return on equity both measure the performance, but ROI include debt while ROE looks at only shareholder equity. A company can have high ROE but low ROI or vice versa, depending on how much debt is involved. I hope it is clear. ROI versus ROE, what does it mean? Now there is something called operating profit ratio. So this ratio shows how efficient a company is in its core operation. So how to calculate this operating profit? Very simple. In the numerator you write the operating profit, in the denominator you write the net sale, multiplied by 100, that will give you the operating profit ratio. So higher the operating profit ratio, the better the operational efficiency. Very simple. The third ratio we have is called FACR, or fixed asset coverage ratio. It checks whether fixed asset can cover long-term debt or not. How to calculate FACR? In the numerator you write the net fixed asset, in the denominator you write the secured long-term debt. Divide both of them. This will give you fixed asset coverage ratio. Remember, there is a benchmark of 1.33:1. It means asset should be at least 1.33 times the loan. Because when we say FACR, in the numerator we are writing net fixed asset, in the denominator we are writing the debt. So that is what we are comparing, fixed asset versus the secured long-term debt. Then we have LLR. LLR is called loan life coverage ratio. This is also called loan life ratio. It is similar to DSCR, but it is used in project finance. I told you DSCR what it was all about. Remember it? In the denominator we write the debt coverage, in the numerator we write the revenue. Similarly, this LLR is similar to DSCR, but it focuses on project finance. While DSCR focus on a specific time, LLR look at the entire loan tenure to see if the debt can be covered over the long run. Right, that is the difference. Now let's talk about financial and non-financial risk. So financial risk come from market activity, which includes market risk, right? Which includes market risk like due to the change in the interest rate, stock price, exchange rate, market risk can arise. Currency risk is there, which affect global business as currency value change. Credit risk is there, which indicates the danger of default or counterparty failure. Liquidity risk is there, when selling an asset quickly leads to sharp loss. Settlement risk is there, which where delays or failure in the transaction payment. Legal risk is there, which means lawsuit or contract breach by other party. So these are the financial risk. On the other hand, we have some kind of non-financial risk which come from external factor like regulation, environmental change, supplier issue, etc. etc. Now friends, do you know what really put your business at risk? It is not just market crash or interest rate hike. It is the risk you might not even see coming. So first of all, let's break down the compliance risk. Right, it is the risk of facing penalties, extra taxes, have to redo your account if the law or the tax rule get changed. Next we have the model risk. This happens when the financial model give wrong value because of the flawed assumption. We have assumed flawed, because of which our model give the wrong result. Then we have the tail risk. So tail risk, you can think of rare extreme event like the 2008 crash. These don't happen often, but when they do, the impact is massive. Then we have the operational risk. It's all about things going wrong inside the company, bad system, error by staff, poor process. It's all included in the operating risk. Solvency risk means your company might run out of cash and be forced to sell asset at a bad price. Let's talk about the non-financial risk. So these are the risks from things outside the financial world, like new regulation, climate event, supplier issue. Every risk, whether financial or non-financial, it has three parts: the cause, the event, and the impact. They are the three parts of every risk: cause, event, and impact. And remember, almost all risk eventually hit your bottom line. So financial risks like market risk, credit risk, liquidity risk, they are usually managed by the finance team. But non-financial risks like operational failure, poor strategy, they are harder to measure and often handled by different departments. These risks are also hard to control because there is a limited data. They depend on people across the company. There is not just a single risk team. Lastly, don't ignore the big picture. There are some big picture. So, there are some macroeconomic factors like inflation, GDP, unemployment. They can seriously shake up your risk landscape. So these are most out of control, driven by government or global event. That is why non-financial risks need as much attention as financial one. Then we have the net present value. Let's discuss in detail. So want to master capital budgeting in just few minutes? Let's break down the most important tool, that is called NPV, IRR and payback period break-even point. What is NPV? So NPV help us judge if the project is worth it or not. We calculate the present value of the future cash inflow. We calculate the present value of the future cash inflow and then subtract the initial investment from it. That will give us NPV. Now two things are possible. NPV can be positive or NPV can be negative. If NPV is positive, go for it. If NPV is negative, reject it. Remember, all among project, the one with the highest NPV wins. Second kind of investment measuring tools we have is IRR, that is called internal rate of return. It is the rate at which the NPV becomes zero. In simple word, it is the return that a project generates internally. If IRR is higher than the required return, it is a good investment. But IRR ignore things like inflation or market trend. It is purely internal, right? So what I am telling you that IRR is the rate at which NPV becomes zero. In simple word, it is the return that a project generates internally. If IRR is higher than the required return, it is a good investment. But IRR generally ignores things like inflation. Then the next tool we have is the payback period. What is payback period? This tells you how long it takes to recover your investment. For example, suppose you spend 1 lakh and recover in 3 years, so your payback period is 3 years, right? So shorter payback period means less risk. That is what the meaning of payback period. It compares investment project by calculating how many years it takes to recover the initial outlay. If the payback period is shorter, it means you have the less risk. Then we have the break even point. So it means no profit, no loss. It is when your sale cover all the cost, right? No profit, no loss. Basically, it is when your sale cover all the cost. What is the formula for break even point? Fixed cost divided by selling price minus variable cost. Then we have the margin of safety. This shows how much cushion you have before the loss start. Higher the margin, safer your business. It tells you how much sale can fall before you start making loss. Then we have the ROCE, which is the return on capital employed. It shows how efficiently you are using your capital. Formula is net operating profit multiplied by 100 divided by capital employed. So if the ROCE is higher, it means performance is better. Then we have the capital employed. It is the total long-term money used in the business. Equity plus reserve plus long-term loan minus current liability will give you the capital employed. Then we have the ROA, which is return on the asset. It shows how much profit you earn from every rupee of the asset, right? How much profit you earn from the every rupee of your asset. Formula is net profit by total asset, return on total asset. Very easy to understand, right? So NPV, IRR, payback, break even all help in choosing the right project. So we are dealing with ROA right now. So ROA tells us how efficiently a company is using a total asset to earn profit. Then ROI. ROI is the return on investment, which is called earning power ratio. It compares the return earned from an investment to its cost expressed at percentage. It also includes some negative return. It gives us a full picture of the performance. Then we have the PERT and CPM. So basically these are the project planning tool. They help manager plan, schedule and control the project effectively. Both use network diagram to show the order and dependency of the project activity. So they focus on two things. The first thing they focus on is the event, which means which mark achievement needing no resource. Then second thing they focus on the activities, which is the real task that take time and resource between event. Event which mark achievement. So event require no resource, whereas activity which is the real task that take time and resource between events. Now if we move to the credit analyst, which is the core part of the financial risk assessment. Credit analyst review financial statement and assess loan request, new, modified or refinanced. They present their finding to the management, especially about the repayment capacity, always following the latest lending rule. A strong credit score make it easier to get loan and better terms. India follow a 300 to 900 score system. A score above 750 is usually needed for loan approval. RBI recognize 4 credit bureau. What are the 4 credit bureau? Experian, Equifax, Civil and CRIF Highmark. These bureau collect and share borrower data with bank to assign a score. Credit score usually uses a statistical model to judge a borrower creditworthiness. Right. Now friends, let's talk in detail about this credit scoring model. Ever wondered how your credit score affect your loan or what commercial paper really means? Let's understand. Credit scoring tells the lender how likely you are to repay your loan or how likely you are to repay your default. In India, its score can range from 300 to 900. A score of 750 plus is considered excellent. This means lower interest rate and higher chance of loan approval. So what are the key factors that affect your score? Let's look at it. First of all, payment history. Even if you missed one payment, it can drop your score by 100 plus point. Credit utilization ratio, that is called CUR. So using too much of your available credit lower your risk score. Credit mix, which means a mix of secure like home loan and unsecured like credit card loan, it is better. right? So secure and secure mixture is better. Hard inquiry, too many loan application can signal credit hungry behavior. So this can affect your credit rating. Then we have the commercial paper. What is commercial paper? It is a short-term loan instrument used by big company to raise quick money, like for salary or for bill. It is unsecured instrument, meaning there is no collateral involved. Only the company promised to repay. It is sold at a discount. CP offer lower return than bond. Commercial paper offer lower return as compared to the bond, but they are popular due to their short duration. Very short duration they have. Right, company can raise the quick money, but the return they offer is lower than the bond. So longer CP terms means higher interest cost, but still cheaper than the bank loan. Obviously, right. In India, RBI introduced CP in the year 1989 based on the Vagul Committee recommendation. Remember the name? Vagul Committee. So to issue a CP, a company must have 5 crore net worth at least, good dividend paying history. RBI regulates CP volume every year. Minimum issue 1 crore, minimum lot is 5 lakh, right? So individual lot should not be less than 5 lakh and minimum issue is 1 crore. And remember, CP are not treated as unsecured bank advance, they are regulated separately. So whether you are maintaining a healthy credit score or understanding how big firm raise fast cash, these concepts are key to mastering the financial literacy. Again, I am telling you, if you are looking for any kind of courses on CCP, please WhatsApp me on the number shown in the description section, or you can see the course link directly in the description section. Friends, commercial paper is a short-term debt instrument used by company. Net worth must be 5 crore. DER should not exceed 1.05. Debt servicing ratio should be close to 2. Current ratio should be 1.33 or more. And the company must be listed on the stock exchange. Now, commercial paper can be issued in two ways. Either at a discount to its face value or with an interest component. And here is a bonus. There is no stamp duty on issuing or transferring the commercial paper. Now let's talk about the letter of credit. It is a guarantee from a bank. It promises that the seller will get paid if they meet the term which is set by the buyer. Let's simplify it further. It's like the bank is saying, seller, if you do your job, I will make sure that you will get paid. Now there are different types of LC. Let's understand the term one by one. The first is called inland LC, which is used for domestic transaction within the same country. Then we have the documentary LC. So what is documentary LC? The seller must submit the documents of title and other paper to get payment. Then we have the clean LC. Clean LC, no documents of title is required in the case of clean LC. So LC follow UCP 600 rule internationally. There are 39 standard rules set by the ICC. So what are the common documents which are required? Which includes invoices, railway receipt, lorry receipt, bill of lading, way bill, draft, etc. Now types of LC. Irrevocable LC, which means once issued, it cannot be cancelled, it cannot be changed unless everyone agree. Revocable LC, which means it can be modified or cancelable anytime by the issuing bank. Revolving LC, it is called reusable LC, reusable credit. Once used and repaid, it get automatically refilled, saving the effort of issuing new LC each time. Confirmed irrevocable LC. What is confirmed irrevocable LC? Here a second bank apart from the issuing bank guarantee the payment, giving extra safety to the seller. Then we have the transferable LC. So it allows the original seller, who is the beneficiary, to transfer part or full value of the LC to another seller. That is why it is called transferable. It allows the original seller to transfer the part or the full value of the LC to the another seller. Right. So these are the different kinds of LC we have. Then we have back-to-back LC. So basically imagine you are a middleman, not the manufacturer. You receive an LC from a buyer and you use the same LC to open another one in the favor of your supplier. That is back-to-back LC. Leveraging one LC to support another. Smart but needs control. Deferred payment credit. This is called Ujans LC. Payment is not immediate. No drafts are allowed. LC clearly mentioned when the payment will happen in the future. It's all about agreed date. Acceptance credit. Similar to deferred, but here the beneficiary must draw a Ujans draft. The designated bank accept it and pay on the maturity date. Drawing the draft is mandatory here. One thing is caution that banks should avoid LC that have a without recourse clause. Why? Because it means additional risk. Bank could end up liable beyond the LC amount. Risky business. Who are the key parties in a letter of credit? Applicant means the buyer requesting the LC. Issuing bank which means the bank that issues the LC. Beneficiary means the seller receiving payment. Advising bank means communicate LC detail to the beneficiary. Negotiating bank who pays after verifying document. Reimbursing bank who handle the actual payment to the negotiating bank. Again I am repeating. Applicant is the buyer requesting the LC. Issuing bank is the bank that issues the LC. Beneficiary is the seller receiving the payment. Advising bank communicate LC detail to the beneficiary. Negotiating bank pays after verifying document. So what are the do's and don'ts for bank? Issue LC only for credit-worthy beneficiary. Get a status report not older than 1 year. Don't issue LC based on guarantee from another bank. Don't provide guarantee for LC opened by another bank. What are the LC documentation rule? So basically, original LC must carry a revenue stamp. It should be sent through the negotiating branch. Changes to irrevocable LC are valid only if accepted by the beneficiary. So remember, draft must be drawn on the bank, not the applicant. That is UCP 600 Article 6 says the same. Draft, any kind of draft must be drawn on the bank, not on the beneficiary, not on the applicant. Expired LC can't be extended unless requested by the opener. After 3 weeks of expiry, bank should reverse the LC liability. For revolving LC, what happened for revolving LC? New funds are allowed only after the previous bill are paid. Right. Now friends, let's talk about some more important point regarding the charges. Yes, very important aspect. So we will break down the concept of bank guarantee, contingent liability, and terms like EMD, security deposit, etc. etc. Suppose a bank account has insufficient balance and a bill is charged to it. It does not count as a real payment, right? So the liability is still active, so it is called contingent liability and it stays until the actual settlement. So what I am telling you, that suppose a bank account has insufficient balance and a bill is charged to it, it does not count as a real payment. Rather, the liability is active. It is called, contingent liability. Now, what is a bank guarantee? Under the section 126 of the Indian Contract Act, a guarantee is a promise to fulfill someone else's obligation if they default. Remember this section? What is a guarantee? It is a promise. What kind of promise? To fulfill someone else's obligation. If someone default to fulfill their obligation, this is called, basically guarantee. A contract promising to fulfill a third party obligation if they default. So basically a bank guarantee is this promise made by the bank, assuring the creditor that if the customer fail, the bank will pay. Who are the three parties in a guarantee? The guarantor, which is the bank, the principal debtor, which is the bank customer, the beneficiary, who is the creditor. So there are three parties involved in the guarantee. Who is the first one? Guarantor. Guarantor is the bank. Principal debtor is the bank customer. Beneficiary is the creditor. So the main duty lies with the customer. The bank steps in only if the customer fail. Who has the main duty? The guarantor has the main duty, right? Now friends, is the money given immediately? No. When a guarantee is issued, the bank don't pay any money unless the guarantee is invoked. So this is called non-fund based facility. There is no cash outflow at the time of issuing. That's why it is called non-fund based facility. What is the impact on bank ratio? So since there is no actual money involving during the issue, this does not impact the credit deposit ratio. Credit deposit ratio remain intact. Bank usually collect fee upfront and it is recorded as income whether the guarantee is used later or not. Now there is something called PG. PG is called performance guarantee. It covers only monetary loss. If the contractor failed to meet obligation, it covers only monetary loss. It does not guarantee actual work performance. If we compare EMD and security deposit, so contractor may give a bank guarantee instead of EMD or security deposit when bidding for tender. What is EMD? Earnest money deposit. It is refundable. It is generally under 5% of the tender value. And if the bidder back out after winning, EMD can be forfeited. So 5% of the tender value has to be submitted in the form of EMD. And if the bidder back out after winning, so EMD can be forfeited. Security deposit is collected from winning bidder to cover any loss if the contractor failed. So EMD and security deposit. To summarize, bank guarantee are non-fund based commitment. They help ensure contract performance. No money flow out unless the guarantee is called upon. EMD and security deposit help prevent tender misuse and protect the buyer. Then let's talk more about the DPG, security deposit, etc. So we are talking about the security deposit, Security deposit, after winning a bid, bidder must deposit security. This can be cash, this can be BG, this can be NSC, National Savings Certificate. So their EMD or earnest money deposit is refunded only after the security deposit is accepted. Right? Earnest money deposit is refunded after the security deposit they have deposited. Then we have the DPG, which is called deferred payment guarantee. It is a non-fund based facility, commonly used for buying machinery. The bank promised to pay the installment to the supplier if the buyer fails to do so. Suppose buyer did not pay. So the bank promised that yes, I will pay to the supplier. That is called DPG. So banks are usually cautious while giving DPG to new business. Then we have advance payment guarantee. So if the principal give money in advance to the contractor, the guarantee ensures that money is repaid if the contract terms are not made. What are the restrictions on guarantee? Bank cannot issue guarantee for company raising money via NCD. So suppose some company is raising money via non-convertible debenture. In that case, bank cannot issue guarantee. And bank also cannot guarantee intercompany loan, NBFC repayments to or support deposit with non-banking firm. What are the types of guarantee we have? The first type we have is a secured guarantee. What is secured guarantee? It is fully backed by the asset or government guarantee. Then we have unsecured guarantee. If the recoverable value is less than 10% of the guarantee amount, it is called unsecured guarantee. Then we have the conditional guarantee. It can be invoked only if a specific condition are fulfilled. Then we have the unconditional guarantee, which means it can be claimed anytime within its validity period. So if we want to assess a DPG, suppose if you want to assess a DPG, that is called the deferred payment guarantee. How to assess it? So you should check the DER, you should check the margin, and you should check the DSCR. So all of these checking, right? Then you can assess the DPG. Now some more points regarding BG you must know. Bank guarantee are very powerful tool in banking, but if not handled correctly, they can become risky. So first of all, we have something called protective clause must. Every bank guarantee must clearly mention the guaranteed amount and the valid claim period. No open-ended liability should be there. Then they have the dual signature. Remember, as per RBI, any BG above 50,000 must be signed by 2 authorized officials. You should use only a standard format. BG should use the bank standard format. Any change in it need approval from the higher authority. Avoid onerous clause. Do not include clauses that are vague, that are difficult, that are legally risky. Do not include such kind of clauses. Next point is separate claim period, which means the claim period is a separate window, maximum 6 months, for submitting claim after the BG expire. It is not part of the validity period. Then we talk about the limitation period, which means what is the meaning of limitation period? Limitation period, for government guarantee, the claim limit is 30 years, and for other only 3 years is that. Advance payment guarantee. In the case of APG, good must be placed or hypothecated like in the fund-based limit. So APG, they are treated like performance guarantee. Items under APG should reduce the drawing power. Now friends, company charge. If a joint stock company take APG, the charge must be registered under the section 125 of the Companies Act. Suppose partial work is done, which means bank liability won't reduce for incomplete work unless the beneficiary give written confirmation. Now before contract guarantee, ensure that client has technical skill, experience and resources to complete the work. Now what about the interest in the guarantee? If interest is included, it need explicit approval. It must mention clear amount, clear rate, clear time period. And bank liability has 2 parts, principal plus interest. Right? Remember it. And avoid auto renewal clause. They are treated as onerous and must be avoided. Auto renewal clause. Now friends, let's talk about something more about guarantee. So some guarantee have self-renewable clauses, which means they renew automatically at the beneficiary request, even without the borrower consent. That is risky for the bank. So this should be avoided. Onerous clause means high obligation. If the clause make the bank responsibility uncertain or excessive, it is called onerous clause. Such clauses should only be included after approval from the competent authority. Then arbitration clause. So while issuing guarantee to the government department or PSU, you usually don't need an arbitration clause unless the beneficiary specifically asks for it. What is the meaning of arbitration clause? It means any dispute will be settled by the arbitration, not in the court. It is also called Scott versus Avery clause. Then we have dispute settlement. Let's understand how disputes are settled on the amount involved. Up to 50,000 handled by RBI. Up to 5 lakh need CMD approval. Above 5 lakh need board approval plus government appointed arbitrator approval. Then if we talk about the jurisdiction clauses, so where disputes are settled, so these specify the location where legal disputes should be handled. Right? So remember, these are the very, very important aspects we are talking about. Now friends, let's talk about more. Let's understand the key rule about the bank guarantee. So there is something called, a standard banking practice. So what happened, that bank must follow uniform guarantee practice, which is recommended by the high level committee led by the Sri A. Ghosh. So there is a high level committee led by the Sri Agos, and he recommended, standard banking practice. This ensures safety and consistency. Now, central government guarantee. So if a guarantee is for central government department, it should be formally addressed to the President of India. But any communication should go to the actual beneficiary official who accepted the guarantee. If it is a state government guarantee, you should address to the governor of the state. Always mention the exact department, beneficiary name, and the purpose in your documentation. Now there is something called, prompt payment on invocation. Whenever a guarantee is invoked, bank must make payment immediately. No legal opinion, no delay, no higher approval. Delay can cause damaged trust in the banking system, especially while dealing with the government body. Now, what is the impact on delay? If the bank delay payment, it can harm the bank reputation. It affects the government revenue collection. It creates suspicion of collusion between the bank and the customer. Now, let's talk about the extension of guarantee. Bank can extend the guarantee period if the customer requests for it, but the original terms and conditions must remain the same. So to summarize, following proper guideline, ensure trust, smooth operation, and protect the credibility of the bank when dealing with this kind of guarantee. Now friends, there are some more points. Let's have a look. Renewal request. Customer must request renewal before the guarantee expire. Once it expires, renewal become tricky and may not hold legal value. Now post-expiry renewal. If the beneficiary insists on renewal after expiry, the bank should issue a new guarantee with a clear start date, and the old one must be formally closed. Now let's look at how guarantee is monitored. For guarantee worth 5 lakh or more and valid for over 6 months, bank must review them every 6 months starting from the first 6 months. Then we have the expired guarantee. If there is no pending claim, expired guarantee must be reversed from the book to avoid hurting capital adequacy. What is the meaning of protective clause? IBA advised bank to follow a standard format with protective clause in guarantee. Suppose a guarantee does not have this clause, reversal should only happen after getting the original document back or no claim letter from the beneficiary. There is something called judicial guarantee, which means guarantee issued during court cases remain valid until the case is over. Now some more points, have a look. So friends, if the claim under a bank guarantee is under court scrutiny, the bank must wait for the final court order before making any payment. And if the bank is involved in the case and the court rule in the favor of the government, no certified copy is required. But if the bank is not a party, it needs an attested court order or minute to proceed until the planned appeal. Now how to compare the guarantee and letter of credit? Let's see. So letter of credit, common in the international trade, payment assurance across country. However, BG, they are often used in real estate or infrastructure project within the country. So LC are short term, around 90 days, while standby LC, which is called SLBC, they are long term, typically 1 year. If you look at the legal standards, so regular guarantee are governed by the mutually agreed law. Remember, regular guarantee are governed by the mutually agreed law unless they follow URDG 758, right? As SBLC, a standby letter of credit, follow international norm like UCP, ISP 98, right? So as SBLC in India, Indian bank are only allowed to issue commercial SBLC for import, not financial SBLC. There is something called, bill co-acceptance. It is the don't take risk with your deposit, right? So the rule number 1 is the safety. So what does it safety ensure? So safety ensure that since they are using customer money, they only lend to borrow who are likely to pay it back. Second point is the diversification. So diversification means lower risk. To avoid putting all egg in one basket, what bank do? Bank spread loan across different industries, different region and different collateral type. If one borrower fail, the other balances the loss. So that is the second point, that is called diversification. The third point is stability with the government bond. Bank love government bond. They are stable, they are liquid, they love low risk, right? So during crisis, what happen? These kinds of government bond acts as a financial safety net, ensuring that bank don't run out of cash. Next point we have is the predictability, which means that basically predictable returns. Unlike a stock, government security have a steady interest rate, making them a reliable income source. This helps bank stay profitable without wild fluctuation. So the next time you deposit money, know that bank follow a strict rule. So we have discussed the 4 rule, right? Safety, diversification, stability and predictable return. So I hope this concept is clear. Now friends, let's look at the next slide. So friends, did you know that RBI has a strict rule to protect borrower like you? From loan transparency to fair treatment, here is how bank must behave. First of all, the first key point is RBI's loan restriction. So RBI can ban loan against essential good like food grain and cotton. Why? Why RBI can ban loan against these kinds of essential good? Because to prevent speculation and to keep price stable for everyone. So that is called RBI loan restriction. Right. So why RBI restrict the loan against this essential good? To prevent speculation and to keep price stable for everyone. Now, second point is loan are not just about collateral. You know it very well that bank now check loan purpose and national interest, not just your security. So liberalization forced them to adapt, making credit smarter and making credit fair. So loan are not just about collateral. Next point is the Fair Lending Practice Code, which we call FLPC. For loan under 2 lakh, FLPC ensure no hidden charge, clear timeline, courteous services. Bank must disclose rate, terms and fees upfront. That is called Fair Lending Practice Code, which was implemented from 1st January 2003. Now friends, the next point is the borrower right. What is the so specific about borrower right? You have the right to a written acknowledgement, that is called token of services. So you can see that you have the right for a written acknowledgement and a processing timeline. Sanctioned loan need your signed acceptance, no surprise. So that is called all standard terms. It must be provided to the loan applicant within the application form, right? So branch should display correct current interest rate and service charge. One more thing I told you, that branch must issue an acknowledgement, that is called token of services. That is a written acknowledgement and a processing timeline. Then I told you that one more important point is that for priority sector loan up to 2 lakh, this acknowledgement should specify the expected processing time frame. So time frame should also be specified. And one more thing is that once a loan is sanctioned, so it very well that once a loan is sanctioned, what happened? The borrower acceptance of the terms and condition must be formally recorded with their signature on the sanction document. So that is the point, that sanction loan need your signed acceptance, means no surprise. So friends, the point is that knowledge is power. Now you know how RBI safeguards the borrower, right? I hope you agree with this. Now friends, let's switch our focus to the next slide that we have. Why do bank reject loan? What is this base rate? Don't worry, I will explain banking rule in the simple term. First of all, your loan right. Bank must send you regular statement unless you say no. If they reject your loan, they must tell you why. There should be no secret. Second point is FLPC. I told you about this Fair Lending Practice Code. It ensures that customer grievances are addressed within the defined time frame. Next point is the base rate rule. So forget BPLR, right? You forget BPLR. Now bank use base rate to decide the loan interest rate. You must know that no bank can charge below this base rate unless RBI allow it. And one more point is regarding the staff loan, right? So BPLR, benchmark prime lending rate, it has been replaced by the base rate system. And one more point is that a staff loan is not a special treatment, means even bank staff play normal rate on most loan. Only a special staff benefit get discount, rest pay like everyone else. Then one more point is that late payment will cause penalty. If you miss a payment, bank charges extra interest, that is called penal interest. It apply for delays or breaking loan rules. Then one more point is fixed versus changing rate. What is the meaning of this fixed versus changing rate? See, fixed rate means same interest rate forever. Floating interest rate means it changes if RBI or base rate change, right? So you should pick what suits you. So now you are a loan pro, right? These are the important points which you must keep in the mind. So remember, if the interest rate remain unchanged throughout the loan period, regardless of the fluctuation in the base rate, it is called fixed rate. And obviously the opposite of the fixed rate is the floating rate, floating interest rate. So the next point we have fixed or floating rate. Bank rate versus call rate. Confused? Let's break down loan interest rate in just few minutes. But bank can still change it if RBI allow or if they warn you in advance. Now what about the variable rate loan? See, floating rate loan are called variable rate loan. In this case, what happens that EMI changes when RBI or bank rate change. It is good if the rate drop, it is risky if the rate rises. So that is called variable interest rate, because the name itself suggests that interest rate can vary after loan disbursement. Is called variable interest rate. Now the question is, who gets cheaper loan? So big businesses, high tech company, they often get discount. So what happened, bank check their value, credit score and how profitable they are. So borrower with large or technologically advanced facility, they may receive preferential rate based on account rating, business value, servicing cost and internal criteria. Now let's compare bank rate and call rate. So basically, bank rate is the RBI loan rate to the bank. So it is the rate at which RBI lend to the bank or RBI buy certain commercial paper. So remember this section 49 of the RBI Act, right? So what happened in the bank rate? The bank rate is the rate as which RBI give loan to the banks, right? RBI lend to the bank or RBI buy certain commercial paper under section 49 of the RBI Act. Remember it. Then what is the call rate? So call money rate is the rate at what bank charges each other for overnight loan. So suppose two banks are there and they are mutually lending between each other. So obviously they will charge the interest. So whatever bank charge each other for overnight loan is called call rate, right? And usually it is very short term loan between the banks and obviously overnight. Both bank rate and call rate affect your loan rate. One more point is that remember, since April 1st 2002, bank calculate loan interest on a monthly basis as per the RBI instruction, right? So this is a very important point. What about the late bill payment? If you pay a bill after its due date, bank charge extra interest monthly, so avoid delays, right? So interest must be recovered at the time of purchase or discounting the bill for relevant period. And when a bank purchase or discount inland or foreign bill, both standard charge and upfront interest are collected. And I told you, if a bill is settled after the due date, additional interest for the delay is charged at a penal rate. So these are the important points which we have covered in this particular slide. Friends, if you are looking for any study material for CCP in the form of PDF, in the form of previous year questions, so you can enroll in our CCP course which is available on our app, JIB and CIB Made Simple. The link of the course is provided in the description section, or you can WhatsApp me on this particular number to get more detail. Now friends, let's look at the next point that we have. So the next point, did you know that bank can't lend to their own director? Or bank cannot charge interest unfairly. Let's uncover 5 banking rules that you must know. First of all, farm loan work differently. Farm loan follow seasonal interest rule. So what is the seasonal interest rule? Not monthly, rather the farm loan follow the seasonal interest rule. RBI, NABARD decide when interest is charged, helping farmer match the crop cycle. So RBI or NABARD decide, when interest is charged, and it basically help the farmer matching the crop cycle. One more point is that bank can't play favorite. Bank can't lend against their own share, or bank can't lend against their own share, or bank cannot give loan to the director, right? So they cannot, they cannot lend against loan which is secured by their own share, as per section 20 subsection 1 of the Banking Regulation Act. And also lending against the share of the bank on subsidiary is not permissible. Means they cannot lend against their own share, or they cannot give loan to the director unless it is secured by FD. Remember, so they cannot extend credit to the director or to entities, so unless it is secured by the FD, insurance or government bond. Very, very important point. Bank cannot extend credit to the director or to entity in which director have a significant interest, right? And these restrictions do not apply to loan provided to director. So suppose some loan is given to the director, and when such loan is basically secured by government security, LC policy, fixed deposit, in that case bank can lend, but in all the situations they cannot do. Now one more thing is that no BIP treatment, which means even CEO, even director need RBI approval for personal loan. Right, very, very important point. So suppose the CEO need personal loan, so loan can be given in the form of personal loan, but before that they need RBI approval. Normal rule apply, no special discount. Now one more thing is a zero discrimination, which means bank must treat all borrower equally. No bias based on caste, gender, religion. So your loan depends on merit and not the background. So that is called non-discrimination. Then we have the next point, that no bullying for repayment. So it means that bank can't harass you for repayment. No call at odd hour or no threat. Only fair human recovery methods are allowed. So that is the point, that no borrower should be harassed. No borrower should be contacted at inappropriate hour or subjected to coercive method for loan recovery. So these are the important points which we have just covered. Now friends, let's switch our focus to the next slide. Did you know that bank can't give loan to kids or people with certain legal issue? Let's break down who can and who can't get a loan. So the first point is who can get a loan. You know it very well that banks lend to adult. Adult means 18 plus only, as per the Indian Majority Act. So who are the minors? Minors are those people who are under 18 as per the Indian Majority Act, right? Or under 20. So bank lend to adult only. Minor can't sign contract, so no loan even with the parents' help. So that is a very important point. Minors are not legally eligible to enter into contract. Next point is guardian matter. So if a minor has no parent, court appoint guardian, but even then also no loan till they turn 18. So that is what I'm telling you, that individual who are mentally incapacitated or legally disqualified, he cannot engage in loan agreement. And legally, if anyone 18 is considered as minor and he lacks the capacity to contract, so this is the point. And I told you very well that adulthood is reached as age of 18. So whether guardian is natural or court appointed does not matter. Guardian of minor comes in 3 types. So what are the 3 types? One more thing I want to talk to you, that if someone can't make legal decision due to illness, due to disability, so bank can't give them loan. It is the law, right? And 3 types of guardian I told you: natural guardian, which is typically the parents; testimonial guardian, which is appointed by will; and legal guardian, who is appointed by the court. So 3 kinds of guardians are there: natural, testimonial, testamentary, and legal. So one point you must note that basically a testamentary guardian steps in only when both natural guardian are deceased. Yes, so both natural guardian means fathers and mother. If both are deceased, then only testamentary guardian comes into picture. Now court will assign a legal guardian when neither a natural nor a testamentary guardian exists. A natural guardian ceases to be one if they renounce Hinduism or become a sannyasi. Right. So let's look at some more points what we are talking about. These are the very, very important aspect. So question is, can kids take loan, sign check, become business partner? The answer will surprise you. See, first of all, no loan under 18. With court guardian it is 21 and minor can't sign binding contract ever. Remember, this is a very important point. According to the section 3 of the Indian Majority Act, anyone under 18 is minor unless a court appointed guardian is involved. I told you there are 3 kinds of guardian. The first type of guardian is called natural guardian, which is by nature. Second kind of guardian, testamentary. If both the natural guardian are deceased, then comes the role of the testamentary guardian. And if suppose natural guardian is also deceased, testamentary guardian is also deceased, then in that case court approved guardian comes to play. And the rule says that basically if the court appointed guardian is involved, legal adulthood is reached as 21. Very, very important. So with court guardian, the legal adulthood is not 18. Legal adulthood is age 21. Remember it. And one more point is that minor cannot appoint agent or delegate authority to other as per section 183. So they cannot delegate authority to other. And also they cannot sign the binding contract ever. Very, very important point. Right? Minor may be made an agent. Only the principal is bound by this action, not the minor. Suppose you made a minor agent of, so in that case minor is not liable for any activity. Rather, principal will be the liable. You know it very well. Now one more point is that signing the check. Very, very. The adult co-signer pay if it bounce. So remember, minor can sign or endorse check and bill, but bear no legal liability for them. Responsibility rests with the other party, and they are not allowed to nomination. Yes, this is a very important part. Remember, minors are not allowed to nominate someone. If a deposit is in minor's name, only an authorized person can make a nomination. Conversely, a minor may be nominated. Yes, he can be nominated. Minor cannot be a partner in a firm. Very, very important. Kids cannot be business partner, but can get profit share. Yes, they may receive benefit from the partnership arrangement. One more point is that upon turning 18 or 21, if it is court guardian, I told you if it is a natural guardian or if it is testamentary guardian, it is just 18. Then in the case of court guardian, it is just 21. So at 18/21, they get 6 months to opt in or walk away. Right? So minor must decide within 6 months whether to continue as a partner. Failing to respond with, he can walk away. Now, a minor has no authority to stop payment of a check issued by a partnership. Very, very important. Suppose a partnership firm has issued a check. Minor has no authority to stop payment. Once majority is attained, check signed by the former guardian should not be honored, even if the dated prior to the adulthood. Very, very important. Name changes involve minor. Yes, very, very important thing when talking about that, guardian power. What is the power of guardian? So, the power of guardian is, father is the primary guardian, mother is the backup. But guardian lose control the day the kids turn adult. This is a very important part. Right? So, according to the section 6 of the Hindu Minority and Guardianship Act, a Hindu boy or unmarried girl, father is the primary natural guardian, followed by the mother. Now, that is the point. Now, another rule says that, did you know that a 16-year-old bride husband become a legal guardian? How guardianship really work in India? Let's have a look. So as per the Hindu law says that if the minor girl is married, husband become guardian. If she become widowed, father-in-law takes over. But if dad become a monk, she loses the right. So that is the point. For a married Hindu minor girl, her husband is recognized as a natural guardian. If her husband is a minor or if she is widowed, guardianship passes first to her father-in-law, then to her mother-in-law, despite them being not the natural guardian. And if a Hindu minor guardian renounces Hinduism or become a hermit or sannyasi, then that person loses the natural guardian status. This is the very, very important thing. Now in terms of Muslim law, what does Muslim law say? That father is a primary natural guardian, grandfather is a backup, mother only if named in a will. So remember, in the case of Muslim law, father is the primary natural guardian. Muslim father may appoint a testamentary guardian through a will, and mother may also serve as a testamentary guardian. Now one more point is that if the Muslim father dies without a will, guardianship is assigned to the paternal grandfather. Now one more point is that following the death of the paternal grandfather, any guardian named by him will assume responsibility. If no testamentary guardian will be appointed, the court will assign one. Then the court will come. And one more point is that among Shia, Sunni tradition, only the father is recognized as the natural guardian. The mother role as a guardian is not acknowledged even after the father's death. Now what about the Christian, Parsis and Jews? Remember, father is the automatic guardian. Mother needs court order except for married daughter. So there is no specific statute appointing them as the mother as the minor guardian. Rather, father acts the guardian by default unless it concerns a married daughter where the husband may act like a guardian. Now one more point is that for Hindu minor, even if the father is alive, the mother is permitted to open and manage any deposit account in the minor's name. Right? Remember, very, very important point. Suppose a Hindu minor is there, right? And even if the father is alive, mother is permitted to open and manage any deposit account in the minor's name. Now there is a very, very important aspect we are going to discuss now. Question is, can a 10-year-old open a bank account? Can mom control kids' money? So banking secret that no one tells you. Let's understand. First of all, minor power. So kid who are age 10 plus, right? They can open and operate account if they can read, if they can write. This is a very important thing. So if they can read, if they can write, those minor, they can operate account and open account also. Two siblings can even share a joint account also. This is the power of minor, right? What is the mom's right? I told you that Hindu mom can manage account freely. What about other? So only court approved guardian, but they can't loan or be declared bankrupt ever. So this is a very important point, that any joint account holder can stop check payment, but all must jointly revoke the stop payment instruction. Yes, check payment can be stopped, but they must jointly revoke the stop payment instruction. And operation condition must maintain. This is a very important aspect, right? So what I'm talking about, did you know that a 10-year-old can have a bank account, or that partner can be personally liable for firm debt? So let's look at it. First of all, let's talk about the joint account. I told you that in joint account, if one holder dies, money goes to the survivor. You can see clearly written here, right? So suppose in joint account two person are there. If one person dies, if one holder dies, so to whom the money goes to? Money goes to the survivor. And when all the joint holder passes away, nominee or legal heir inherit. So remember, always set a nominee. That is the point. So the bank pay the surviving account holder, right? And legal heir if one or more account holder pass away. This is the point. Now one more point is that what is the survivorship rule in the case of joint account? In joint account, I told you the money goes to the survivor if one holder die, right? And when all passes away, nominee or legal heir inherit. Now let's simplify the account operation. First of all, joint account can work in three ways. The first way is anyone can operate, right? So you can see joint account can operate in anyone can operate. Second is almost signed together, and third one is only the first name person will sign. As you can see, three operation written here. Operation severely means anyone can operate. Then operation jointly means almost signed together, and third one is only the first name person operate. So these are the three way joint account can work. Now you must know that repayment option for term deposit include repayment mode. Okay, these are not that one important. Yes, this is a very important aspect. Remember, as per the Companies Act 2013, a firm can now have 100 partner, but minor, NRI, mentally ill can't join it. What is the biggest risk is that each partner is personally liable for all the debts. So we are talking in the context of partnership firm. You must know that in the context of partnership firm, a firm can have 100 partner, but who are not included? Certain entities like NBFC, HUF, minor, insolvent, mentally unsound person, they cannot be the partner, and each partner will act like an agent for the firm and other partner. Remember it, very very important. Now one more thing is that what happened after death and banking? See, whenever a partner dies, the firm dissolves, but survivor can still operate the account. For joint account, check stop if the first holder pass away. So suppose a partner dies, what will happen? Then the firm will get dissolved. However, the survivor can still operate account. Right? So that is the point. Now one more point is that suppose a partner died and the partnership account is overdrawn. So what does it say? Let's have a look. Suppose one partner dies. Can the other partner still use the account? The answer could save your business. Let's look at it. See what happens if a partner dies with an overdraft or overdrawn account. So you should freeze the transaction immediately. You should determine the disease share, else surviving partner pay all the debt. That is the point. Suppose a partner die and the partnership account is overdrawn. So account operation must be halted. Account operation must be ceased. Right? You should determine the liabilities of the deceased, retired, insolvent partner. Otherwise, the Clayton's rule will apply. Right? So freeze the transaction immediately, determine the deceased person's share, and else surviving partner pay all the debt. Now what is the registration rule? Suppose the firm is unregistered. So you cannot sue the debtor, but they can sue you. So always register your partnership firm. See, it is not mandatory to register the partnership firm. So if the partnership firm is registered, what happens? So a registered partnership firm can sue you to enforce contractual right. Any partner, including a sleeping partner, can stop check payment issued by the other. Right? So any partner can stop payment, even silent partner also. But reversing it needs everyone approval. Now who can join? So remember, partner cannot delegate their authority to outsider without written consent. And Indian Partnership Act 1932 governs all the partnership agreement. One more point is that when transacting with a partnership firm, lender must confirm the firm registration status. This is a very very important aspect which we are talking about, right? So let me explain one more thing is that 2 to 20 partner can be maximum. You can see a partnership must have at least 2 partner. The maximum is 10 for banking and 20 for other firms. No minor, no insolvent is allowed. And one more point is that all partner liable for every rupee. Very very important aspect. Now let's talk about HUF. So the question is, HUF can't partner, trust can't join firm. 90% don't know this partnership rule. Let's see. First of all, let's talk about the traditional partnership. Remember, HUF, that is Hindu Undivided Family, cannot enter a partnership because they lack joint accountability for other member action. Then trust. What about trust? Trust are also ineligible for partnership firm. Why? Because partnership are intended for business, not for trust. One more point is that registration is handled. Partnership registration is handled by the registrar of the business. Suppose you want to register a partnership. So registering a partnership firm is optional. However, one more is, this is a very important point. What is the point? That unregistered firm cannot sue for recovery of debt. Yes, it is. I told you earlier that registration of the partnership is optional. You need not, it's not mandatory. But if it is unregistered, what will happen? That if the firm is unregistered, it cannot sue for recovery of debt, while others retain the right to sue them. And every partner carry unlimited, both joint and individual. So every partner carry unlimited liability for the firm action during their tenure. And suppose the partner become insolvent, very very important, right? So if the partner become insolvent and the account is in credit, the remaining partner may continue operation only with a new banking mandate, and they should pay on old check issued by the insolvent partner, require their confirmation. So what I'm talking about, traditional partnership is easy to form. They don't have unlimited liability, right? So that is the point which I've just discussed. So, all partner can operate the partnership account, and any operational change need unanimous consent. And partner cannot delegate their operational authority to the other. These are the super important point which we are talking about. Now friends, let's shift our focus to LLP. So what is LLP? Limited Liability Partnership. So it blend element of partnership and limited liability company into a single corporate entity. So friends, if we talk in the terms of LLP, which is Limited Liability Partnership. So remember, liability is your investment only. You can have unlimited partner. Very, very important thing. Try to understand. A traditional partnership cannot have unlimited liability. But this LLP, here he has, as a name suggests, Limited Liability Partnership. So there are two elements. element of partnership and limited liability company into a single corporate entity. So it is a distinct legal body. Is it a distinct legal body? It is separate from its partner, and it must include the limited liability partnership or LLP in its name. LLP is liable up to the full value of its asset, while each partner liability is limited to their agreed upon contribution. Yes. Whenever LLP is formed, every partner agree upon their contribution, and they are only liable up to that, not more than that. One more point is that LLP require at least two partner. Very, very important. That LLP require at least two partner with no maximum cap on partnership size. Which means limited liability partnership require at least two partner, and there is no maximum cap on partnership size. And a body corporate including an LLP can itself become a partner in another LLP. So LLP can become partner in another LLP. This is allowed. One LLP is there, it can partner with another LLP. Now one more important point, very, very important aspect talking about. So your LLP can live forever even if the partner quit. That is why smart entrepreneurs choose LLP. This is the very important aspect talking about. What I am telling you, that your LLP, it can live forever even if a partner quit. While in the case of partnership firm, what we recall, if any partner quit, the firm must be dissolved, right? So this is a special criteria. So let's talk about the LLP superpower. So I told you that change in the LLP partner do not impact the LLP existence, right or liability. Partnership firm, private limited company, unlisted public company, they can be converted into LLP. However, LLP cannot be converted back into company or partnership firm. So vice versa, very, very important thing. So LLP superpower is that it never dies. Partner can come, partner can go, LLP will continue. Second superpower is that no asset registration. Unlike company, in the company you need to register your asset, while in the case of LLP you require no kind of asset registration. The third superpower of LLP is that it is easy decision. No board meeting is required. Let's talk about it in that detail. HUF and minor are not permitted to partner in LLP. In the case of partnership, what we talk about. A minor can be a partner, but he will have no liability. However, here in the case of LLP, what I am talking about, that he cannot be HUF and minor, they are not permitted to partner in LLP. And LLP must be registered with the ROC. What is ROC? ROC stands for Registrar of the Company. So remember, LLP must be registered with the ROC. LLP can open current account and term deposit in their name. And one important aspect talking about that the LLP agreement. So this agreement is signed by all the partner. It must be provided. So LLP agreement must be provided. If none agreement is exist, so a Schedule 1 of the LLP Act signed by all the partner will apply. So remember, LLP agreement must be provided. If none agreement exists, a Schedule 1 of the LLP Act signed by all the partner will apply. One more point is that designated partner are the authorized signatory for the LLP. So friends, the next point is that the LLP is liable up to the full value of the asset, while each partner liability, I told you it very well, right? And one more point I told you, that LLP must be registered with the ROC. They can only open current account and term deposit in their name. Designated partner are the authorized signatory for the LLP. KYC compliance is mandatory for every LLP partner. No formal resolution is needed for routine LLP decision as per the LLP Act. And there is no provision for registering charges on asset of LLP with the ROC. So you need not register charges on asset of LLP with the ROC. And suppose LLP has more than two partner, they must maintain continuous existence regardless of the partner changes. Suppose partner got changed, right? So LLP who have more than two partner, they must maintain continuous existence. Now let's talk about the HUF. So friends, did you know that a woman can now become a Karta of HUF? And here is how Hindu family business really work. Let's look at it. So how HUF is formed, HUF are formed by individuals from Hindu, Sikh, Jain community and center around a shared ancestor and their descendant, now including female since September 2005. Joint owner in HUF, they are known as co-partner. Yes, joint owner in HUF are called co-partner, and HUF consists of one common living ancestor and up to 3 generations of male or female descendant. The elder co-partner include female, act as the Karta of the HUF. Yeah, very, very important. Females are also included in that. So Karta is the boss. Even if living abroad, he is the boss. All major male and female member are co-partner. Right. So the eldest co-partner act like a Karta of the HUF. Now one more point is that the senior most co-partner remain karta regardless of the residence, even if outside India, right? If he is outside India, he remain karta, no matter he inside India or outside India, and he can delegate management to another co-partner or third party. So remember the senior most co-partner. So who are the co-partner? Remember the word co-partner, joint owner in HUF, they are called co-partner. And HUF consists of one common living ancestor and up to 3 generations of male or female descendant. The senior most co-partner remain karta regardless of the residence, even if outside India, and can delegate management to another co-partner or third party. Remember, only those authorized to operate the HUF account can stop check payment. Co-partner without permission cannot. Remember, very important aspect we are talking about. Only those authorized to operate the HUF account. You know, some people are authorized to operate the HUF account. Only those people can stop check payment. Co-partner without permission cannot stop the check payment. Right? Some person who are authorized to operate the HUF account, they can only stop check payment. Karta holds sole authority to incur debt for family business and legal necessity. So only Karta can take loan for the family. That is what I mean to say. And members' liability is to only their share. Like in the case of LLP, we have discussed that member liability only to their share. Similarly here also. Right? And if we talk about some shocking HUF fact, see, HUF can't form partnership. Since HUF is not a legal person, so it cannot enter into a formal partnership agreement. Second point is that new babies, they become automatically member. So Karta bear personal liability while co-partner liability are limited to their respective share. Remember, this is a very important aspect. Private limited company must know that minimum 2%, maximum 200 member are allowed. Public subscription to capital is prohibited, means no public fundraising is allowed in the case of private company. And one more point is that minimum 2 director is there, maximum no limit, and minimum paid up capital is 1 lakh. These are the very important aspect about private limited company, must remember. So okay, tell me, what are the limits of the member? Minimum 2, maximum 200. Is public fundraising allowed? No. Minimum how many director? 2 minimum director. Maximum limit? Nothing there. What is the minimum paid up capital? 1 lakh minimum paid up capital. Right. One more point is that, Karta signature, all other stopping check, only authorized member can stop a check. Now friends, let's talk about the public limited company. So friends, one director company, 7 member rule, 90% entrepreneur don't know this company law. So if we talk about the public limited company, you must know that minimum 3 directors would be there and maximum 15 can be there without approval. So in the context of public limited company, it must have minimum 3 director, maximum no limit is there, and if the director exceeds 15, central government approval is required. Very important aspect, right? So minimum 3 director, maximum 15 without approval, and 7 plus shareholder, right? 7 plus shareholder. Such company require a minimum of 7 member with no upper limit. 7 plus shareholder are there, and 5 lakh is the minimum capital required for this public limited company. This is a very important aspect we are talking about. For public limited company, remember 3 things. First point, minimum 3 director, maximum 15 director without approval. 7 plus shareholder, 5 lakh minimum capital. So these are the important aspect about public limited company. Now one more thing is the OPC secret. What is OPC? One person company. So as the name suggests, only one person is required, right? Only one person is required. Then one more point is that single director, he has the full control, and it is perfect for solo entrepreneur. There are something called solo entrepreneur. So this OPC is perfect for solo entrepreneur. So it permits only one director. The registrar of the company issues the certificate of incorporation, and this certificate of incorporation, it serves as the company birth certificate. The certificate of commencement of the business is issued once the minimum public capital subscription is confirmed. See, OPC is formed, capital subscription is confirmed. Once the minimum capital subscription is confirmed, now the certificate of commencement is issued. Now friends, let's talk about the MOA. What is MOA? Memorandum of Association. It is a company constitution defining its relationship with the external world and limiting its power. And you know it very well. So you can call MOA as the company's constitution in single word. Amendment. Suppose you want to amend MOA. You can do that. Can you amend the MOA? See, you can amend the MOA, but for that, you require a special resolution with 3/4 majority and central government approval. Very lengthy process. You can see, first of all, you need central government approval. Also, you require 3/4 majority, right? If they pass, then only you can amend MOA. That's why MOA is called constitution. So if you violate MOA, it is called ultra vires. It means beyond company power. Director, not the company, are held responsible. And now let's talk about the AOA. What is AOA? AOA is called Article of Association. You know what is AOA? So AOA is like, internal rule book, right? It comprises the company internal rule and bylaws governing management. So AOA details director borrowing power and processes for appointment, removal, retirement and rotation, right? So AOA act like an internal rule book. Suppose you break MOA. So if you break MOA, it is the director personal risk. At the director personal risk, you can break MOA. So what we have talked about, article of association, it can be amended. I told you now, for amendment of MOA, you require 3/4 majority as well as you require government approval. Now what about AOA? Suppose we want to amend AOA. Can we do that? See, AOA can be amended by a general body resolution. Even if borrowing power are not mentioned, trading company possesses implied authority to borrow. So breaking MOA is at the director personal risk. So changing MOA needs 50 to 75% vote and government nod. And AOA is much easier to amend. As you can see, it can be amended by the general body resolution, right? Now the question is, what suits your business? You can comment. Now one more point is that, regarding AOA, your company can borrow beyond its capital. But 90% director don't know this loan rule. Let's look at it. First of all, let's talk about the borrowing power. Okay. So before that, let me talk about, private limited company have, yes, remember, private limited company, they can take unlimited loan. Public limited company, they can, their loan taking limit is limited to, capital plus reserve limit. So what I'm talking about, if it is a private limited company, they have unlimited borrowing power. If it is a public limited company, they may borrow up to the sum of their paid up capital and free reserve. Let's take an example. Suppose there is a firm whose paid up capital is 100 crore, whose free reserve is 50 crore. So can you tell me what is the maximum borrowing power? It is nothing but 100 plus 50 is 150 crore, not more than that. If you want to borrow beyond this, it requires shareholder approval in a general meeting. So let me summarize what we have talked about just now. If it is a private limited company, you can take unlimited loan. If it is a public limited company, your loan limitation is limited to capital plus paid reserve plus free reserves. And if you want to exceed this limit, shareholder vote is required. Now let's talk about the death of the director. So if the director death, no problem. Account keeps running, no delegation allowed, common seal not mandatory. Remember, the death of the director do not affect. So we are talking about into the context of company operation. Remember it. Right now we are talking in the context of company. Suppose the director dies, what will happen? So the death of director does not affect the company account operation. Means account will keep continue as it is. First point. Second point is that company director cannot delegate their authority to others. So no delegation is required. Third point is that common seal not mandatory. So using a common seal on account opening form is no longer mandatory. Now, one more point is that if the company MOA or if the company AOA, it is specified that you have to use a common seal, so its inclusion is voluntarily. Bank cannot require it for opening account. What I'm telling you, suppose a company MOA, suppose a company AOA, clearly written in the company MOA and AOA that you have to use a common seal. So its inclusion is voluntary. Bank cannot require it for opening account. It is voluntary. It is not mandatory, right? Now friends, let's talk about the charge registration. So you must know these rules so far as charge registration is concerned. So I told you now, mortgage, goodwill, they have to be registered in 30 days. So remember, registration of charge is mandatory for hypothecation of stock, book debt, mortgage of property, SIP, goodwill or uncalled share. They are mandatory for these kinds of activity. Remember one thing, that registration of charge is not required for pledges of goods, securities, loan against fixed deposit. Remember, where charge registration is required? In the case of hypothecation, in the case of book debt, in the case of mortgage, in the case of SIPs. Where registration is not required? For pledges of good, securities or loan against fixed deposit. So remember, mortgage, goodwill have to be registered in 30 days. Then remember days also. As per the section number 125 of the Companies Act, it says that most company asset charge must be registered with the registrar within 30 days. So mortgage and goodwill must be registered within 30 days. One more point is that if it is pledge, if it is fixed deposit, then no registration is required, right? So remember, if it is pledge and if it is FD, in that case, no registration is required. And one more point is that, registrar may grant a 30-day extension for charge registration, for which additional fee up to 10 times the specified amount may apply. Yes. Suppose what are you talking about? Suppose I am unable to do the charge registration in the 30 days. So what will happen? So I will approach registrar. So registrar may grant 30-day extension. So he may say, okay, I am providing you 30-day extra. But you have to give me fee. How much fee? Fee can range up to 10 times the amount. This is a huge fee, right? So and suppose I need more extension. So extension beyond this, for that require company law board consent. I hope that makes sense. So what we learned is that AOA can be changed easily. MOA changes need 75% approval plus government nod. So friends, now let's switch our focus to the next point that we have to discuss. Did you know that a director can only hold 15 positions? And second point, did you know that loan security can vanish if this 30-day rule is missed? Let's talk about it. So first of all, maximum 15 directorship per person. What I mean to say is that, any individual cannot simultaneously hold more than 15 directorship as per the section 275 of the Companies Act. Suppose I am there. I cannot be the director of more than 15 companies. That is the point. Second point is that charge registration deadline. I told you already, if you want to register a charge, it is primarily the company responsibility. You have to register the charge, right? If it fail, the creditor may do so instead, right? And what is the timeline? 30 days. Remember it. Now, priority always matter. What is the meaning of priority always matter? Suppose you fail to register the charge. Suppose you fail to file the charge. So obviously the loan will become unsecured and obviously immediately due. When charges are created in the favor of multiple bank, priority is given based on the date of the charge creation. See, suppose, try to understand. A particular company has taken loan from multiple bank and obviously all the bank will create the charge. Now, how to decide the priority in such case? So for that, there is a special rule. What I'm talking about, suppose company A, company B, company C, company D, suppose company A, they have taken loan from bank A, bank B, bank C, bank D, right? So all these bank will create the charge. Now, how the priority is decided? Let's talk about it. So the priority rule is that first bank to register charge is the first to get paid. So what I'm talking about, very, very important aspect we're talking about. So when charges are created in favor of multiple bank, priority is given based on the charge creation. So I told you priority is given based on the charge creation. So use form CHG1 to register and CHG4 to close. So for registration of the charge or modification of the charge, you require to fill the form CHG1. And if you want to close the charge, if you want to close the charge, so then you can use the CHG4. Now, if we talk about the companies type, so remember, India's companies are regulated under the Companies Act and they must be registered as per the Companies Act 1956. One more thing is that, Section 12 of the Companies Act prescribes that a company is formed through the MOA and AOA. So company type, normal company if it is, then they need MOA and AOA. And a statutory corporation like SBI if it is, they are created by Parliament. So remember, in the MOA, it set out the company name, registered office, authorized capital, shareholder liability and the objective, right? And there are something called, a statutory corporation. So for that, there is a special act of Parliament after which they are created, like SBI. SBI, it is a statutory corporation, right? So what I'm telling you, that a company is formed through its MOA and AOA. And some company may be registered under the Companies Act or incorporated as a statutory corporation by a special act of Parliament. Right, like for example, as I given you, State Bank of India, they are autonomous entity with defined power, duties, privilege stipulated by the statute. Right, that is the point. So such corporation enjoy financial independence but remain accountable to the law that established them. Now let's talk about the trust. So friends, can trustee take loans? What if they die? 90% don't know about this trust secret, and I'm here to uncover all these secrets. Let's have a look. First of all, you must know the basics that trustee is the legal owner. See, trust is a legal arrangement where a trustee holds property for the benefit of a beneficiary or a specific purpose. So trustee. Trust is called arrangement. Trustee holds the property for the benefit of a beneficiary, ensuring that the beneficiary receive the real benefit. So check before death is still valid. Now let's talk about the key difference between the private trust and the public trust. One more point is that trust account must be operated by individual authorized through a formal resolution. So if we talk about the difference between private and public trust, you must know that private trusts are for family or known beneficiary, right? So private trusts have identifiable beneficiary, while public trust, they are for society. You have to register with the charity commissioner. So private trusts have identifiable beneficiary, while public trusts serve the general public. So private trusts fall under the Indian Trust Act, where public trusts fall under respective state Public Trust Act. That's the difference. Remember, private trusts are for family, known beneficiary. Public trusts are for society, right? And one more point is that if we talk about the operational rule, so I told you what is the trust deed. Trust deed act like a rule book. So a trust deed is the foundational documents, and the registration of the public trust is overseen by the charity commissioner. Yes. So question may be asked, who oversee, who monitor whether the trust has been registered or not? The answer is charity commissioner. So trust deed provision dictate account operation. If it is silent, all trustee must manage the account jointly. Right. So this is a very important point. Now let's talk about the operation rule. What is the operation rule? All trustee must jointly operate unless deed say otherwise. All trustee, they must jointly operate. Now second point is no power delegation, even if all agree. What I mean to say, that payments are regulated based on the authority specified in the trust deed, including any stop payment. Right. So that is the point. One more important aspect I'm talking about. Okay, let's talk about it. Yes, so I'm talking about this point, that trustee can't delegate. Club need 3 documents. POA stop at death. So let's look at this secret you are not told. First of all, trust must knowns. What are the point? No delegation even if all agree. Trust cannot delegate their authority to any other, even after the mutual consent. First point. Second point, loan is allowed only if the trust deed permit. If it is written in the trust deed, then only loan can be given. So trust deed is the foundational document, right? And registration of the public trust is overseen by the charity commissioner. Third point I told you, if the trustee died, property go to the successor, right? So means if the trustee died, right, then the payment goes to the property go to the successor. What is the rule regarding the club and society? Have a look. So club and society need registration certificate plus bylaw to open the account. And one more point is that check. Yes, suppose agent issue a check and it is presented after the agent death. So payment can be made as long as the principal is alive and the check is dated before the agent death. So check signed before the death is still valid. Now one more point is the managing committee. So managing committee control the operation. So suppose there is a small business unit. So typically up to 2 to 3 lakh. So in that case, composite loan may be provided to finance both current and fixed asset. Now basically, working capital facility like overdraft. So we're talking about it. One more point I want to tell you, that power of attorney truth. What is the truth regarding the POA? POA, power of attorney, auto cancel. Power of attorney is auto cancelled if principal dies or if principal goes bankrupt. Remember it. For every power of attorney there is a principal, and suppose the principal dies or principal goes bankrupt, what happened to the power of attorney? It automatically get cancelled. Remember, power of attorney must be stamped, must be notarized. State rule apply there. And if power of attorney is signed after revocation, so it is called bounce, the check become bounced, right? That is the point. Now let's talk about in detail about it. OD versus term loan, fund versus non-fund. Let's talk about it. So let's talk about the working capital loan, right? What is the working capital loan? So the loan which is given for day-to-day operation purpose, right? So working capital loan for daily operation like overdraft, cash credit, bill discounting. So these are the 3 categories of the working capital finance which are given for day-to-day operation. Remember, they are given exclusively for purchasing the current asset. What is the meaning of current asset? So current assets are those assets, right? Basically, which can be converted into cash immediately or within 1 year. Those are called current asset. Can you give me some example of current asset? Like inventory is current asset, raw material is a current asset, which can be encashed just within 12 months. They are called current asset. So what I'm talking about, working capital finance for daily operation include OD, it include cash credit, it include bill discounting, but remember they are sanctioned exclusively for purchasing current assets. So we are talking in the context of trust. I told you, if it is mentioned in the trust deed, yes, they are allowed to take the loan, right? Remember it. Now what about the term loan? Yes, term loan are also allowed for big purchases like machinery, vehicle, property, but term loan are only given for fixed asset only, except tiny business. Now it very well that fund-based facility. So what is the fund-based facility? So so basically there are some credit facility where fund are involved. So here fund are disbursed by the bank, and what it includes? It includes overdraft, it includes cash credit, it includes term loan, housing loan, vehicle loan. So these things are under the fund-based credit. What about the non-fund-based credit? So some kinds of credit are there where funds are not involved, like letter of credit, like bank guarantee, right? So these are called non-fund based credit. I think you know it very well. Now example of a non-fund based credit include bank guarantee, letter of credit, deferred payment guarantee, and bill co-acceptance term. So one more point is that in the non-fund based arrangement, bank fund are only released in certain circumstance, not at the point of good receipt. Suppose non-fund based arrangement is there like LC. I receive the good. Shall I pay immediately? No. Right. So basically bank funds are released only in certain circumstance. And one more point is that finance provided to support business activity within India is called the inland credit. So basically bank pay only if the default happen. This is a very, very important aspect. Now let's look at the next point. Very, very important aspect. Using term loan for daily expense or working capital for machinery, it is a big mistake. Why? Because working capital loan, the purpose is the daily operation, like inventory, like salary, like bills. So that is the main motive of the working capital loan. Suppose the borrower is involved in export or import financing, even in Indian rupees, such as packing credit, they are called forex credit. What is the meaning of forex credit? Forex credit means suppose a borrower is there, he is involved in export or import financing, even in Indian rupees. So that is called forex credit. Fund-based facility involve direct disbursement of money by the bank from the outset. Non-fund-based facility entails the bank providing a payment guarantee of assurance. So in the case of fund-based facility, direct fund is exchanged, direct fund disbursement happen. In the case of non-fund-based facility, payment guarantee is given, payment assurance is given, actual fund are not involved, right? One more point is that working capital loan, it very well. They are the short-term instrument which are designed to cover a company daily operation expense. And how to calculate the working capital? The formula is very simple. You need to add inventory, you need to add the account receivable, and you need to subtract the account payable. What is the meaning of account receivable? It is very simple. See, you have a business, you have given something on credit, you have not received the payment yet. Those are called account receivable, which means some money which are yet to be received. And what is the account payable? Suppose you have taken some items on credit and you have not paid yet. That is called account payable. So while calculating the working capital, we add account receivable because that money we will receive. That is our working capital. And we have to subtract the account payable because that money we have to give. Right? We have taken some goods and services on credit and we have not paid yet. That is called account payable. I hope the concept is clear. And it is short term, which means it must be repaid quickly. So that is all about working capital loan. Now let's switch gear and talk about the term loan. So term loan purpose is to buy the big asset like machinery, like property, like vehicle, and repayment time period it very well. It is 1 to 10 year in EMI. Yes, EMI repayment is there, and collateral are usually required. Now let's talk about the key difference. So basically working capital loan are like oxygen for daily survival, and term loan are like bones for long term growth. If you mix them up, cash flow disaster can happen. Right. So I told you now working capital is very crucial for smooth functioning and growth of any business. And if it is huge, see, working capital should not be huge. If it is huge, it can lead to operational bottleneck, while an excess increases the cost. Right. So if it is, suppose working capital is very little, suppose we don't have the money for our day-to-day operation, what will happen? Tell me, what will happen if we don't have the money for day-to-day operation? If the working capital is too little, it will cause operational bottleneck, and if it is too excess, it will increase the cost. That's the point. Now friends, one more point I'm talking about, both fixed capital and liquid capital, they are very much essential for any industry, for any business. Fixed capital needed for long-term asset, liquid capital needed for running operation. Now the question is, where fixed capital is invested. So fixed capital is invested in acquiring long-term asset like land, building, plant, machinery. And this fixed asset cannot generate income independently. They require sufficient working capital to support the production activity. Yes, very, very important aspect we are talking about. You know it very well. Why do business fail even with great machine? The secret lie in the working capital cycle. So fixed capital are given for machine and building, which means long term, and working capital are given for daily cash flow, which includes salary, which includes raw material. So friends, how the money cycle work? Let's have a look. So in the case of working capital fund, you can purchase, you can store raw material, you can make payment of salary, you can pay for utility expense, and you can pay the gap between the good supply and the payment receipt. So you can see the working capital cycle. First of all, you buy the raw material, then you make product, then you sell the goods, then you wait for payment, and finally you repeat the cycle. Buying, making product, selling goods, waiting for payment. This is how money cycle works. And you know it very well. If the cycle is faster, it is better for business. So this is a continuous type of cycle, right? Raw material convert to WIP, WIP converts to finished goods followed by receivable, then cash, and back to raw material. Now friends, let's talk about the trading business. So for trading business, that the operating cycle spans from purchasing good to their sale and the realization of proceed. In manufacturing, the cycle covers the purchase of raw material, production, sales of finished goods, and the collection of payment. So basically, to the context of working capital cycle, it works both for trading business as well as the manufacturing. One more point is that consumer goods industry experience quicker working capital cycle, while capital good industry obviously see two kinds of industries are there. One is the consumer goods industry, other is the capital goods industry. So capital goods industry, they take longer time. So obviously they have a slower working capital cycle. And consumer good industry, consumers are buying more frequently. That's why we have a shorter working capital cycle. Perishable goods like food having short cycle, while commodity like tobacco, they have a longer cycle, right? Some seasonal industry like umbrella, wool and fabric manufacturer, they require fluctuating stock level, peaking in certain month and minimal otherwise, right? These are the very important aspect. So friends, what happened during working capital cycle? During working capital cycle, your fund are tied up in cash, inventory, receivable. So all of these require financial support, right? So this is the very important part. Now friends, fixed capital, where it is invested, fixed capital invested in equity. I think this is the repetition. We have already discussed all this aspect. This is the repetition. Now friends, what is the meaning of shorter working capital cycle? Why do profitable business run out of cash? The answer lie in your working capital. Yes, because of the working capital, the profitable business run out of the cash. So the golden rule is that, if you have a shorter cycle, it means money rotation is faster. Faster money rotation, it means more profit. And if you have a longer working capital cycle, it means cash is stuck somewhere and it means simply travel ahead. Now friends, we talk about the current asset. What is the meaning of current asset? See, it is simply means, your liquid gold. How does it move? So first of all, you have cash. Those cash turns into inventory. Obviously, you purchase the material and there is an inventory. Then you sell those inventory. Then you have receivable and then you again receive the cash, right? So that is called current asset, your liquid gold. So finished good must sell within the 1 year. That is called current asset. Means such kind of asset which can be quickly sold within 1 year. They are called current asset. Like your inventory, like your receivable, they can be converted into cash quickly. That's why they are called current asset, right? Now what are current liability? So current liability are like short term debt, right? Why I'm talking about this? Because if you want to efficiently manage the working capital, it require monitoring both current asset and current liability. So current asset, you have understood, you were having cash. From cash you bought inventory. From inventory you got the receivable, and from receivable you got the cash again, right? Now let's talk about the current liability. So current liability are short term debt. What happened here? Supplier credit, right? Supplier credit means whoever is the supplier, he gives the amount in credit. Then bank overdraft. So these are the types of current liability: supplier credit, bank overdraft, upcoming loan EMI, right? So these are different kinds of liability we have. So it includes short-term obligations which are repayable within 1 year, right? They form, so remember, they means current asset and current liability. They form the primary source of working capital finance, right? This current liability, they form the primary source of the working capital finance. From where we are getting this finance? Obviously from current liability, right? So this is a very important thing. Now one more thing is that let's look at some danger sign. Danger sign is okay. What are the danger sign? Let's have a look. But before that, while we are assessing the working capital need, bank borrowing are excluded from the total current liability, right? So what happened? Whatever bank has borrowed, they are excluded from the total current liability. With the remaining terms, we call it CLOBB. What is CLOBB? Current liability other than the bank borrowing, right? So current liability are those liability which are the short terms which we have to pay within 1 year, right? So they are primarily, why we take such liability? So as to finance working capital and to acquire the current asset. They form the primary source of working capital finance. Remember, current liability form the primary source of working capital finance. And while we assess the working capital need, whatever borrowing we have done from bank, we don't include that and we exclude that. And after excluding, whatever term which is left is called CLOBB, which is the current liability other than the bank borrowing. So I told you what are the things included under the current liability, like bank borrowing for working capital, other short-term borrowing, sundry creditor, term loan installment, other payable and provision, right? These are the things which are included. So under the current liability. Now one more thing is that current asset are also called convertible, liquid or floating asset. They continually change form and ultimately convert to cash. And finished goods classified as current asset, they are intended for sale and conversion to cash within 1 year. So what are the components of current asset? Like cash inventory, book debt. What is the book debt? That's called account receivable. What is account receivable? Suppose you are providing some kind of goods and services. You provide some kinds of goods and services to some people on credit. They have not paid you. They will pay you on the due date. So such kind of payment are called account receivable, which are due, which you have not received yet. So this account receivable is also a kind of current asset. Obviously, it's a kind of asset for you, right? Then they also call book debt. Either you call him book debt or account receivable. So account receivable, cash, inventory, other loan and advance, these are the components of the current asset. Now what are the things under inventory? Raw material, work in progress, finished goods, store, packing material, these things are under inventory. Now one more important point is that let's try to understand. See, your car is a fixed asset or current asset. Tell me. Answer, it depends. Let's decode working capital in just few minutes. First of all, asset secret. If you hold excess asset unnecessarily, what will happen? It will increase business cost, because you have to pay additional interest, you have some borrowing expense. So remember, for individual like you and me, house or flat is a fixed asset. For a builder selling house, the same property is considered the current asset. You can see the same flat is fixed asset for me, while for builder it is a current asset. Sorry, it is a current asset. Yes. Similarly, suppose an individual who is running auto services for auto shop, right? For auto shop, the car is a fixed asset because it is an income tool, because it generates income. However, for the dealer, for auto dealer, the vehicle are current asset because it is a kind of inventory, right? So same material is acting like a fixed asset for some person, while current asset for another person. You can see it. Now let's look at the mathematics of the working capital. So friends, you know that through the context of working capital, there is something called working capital gap, or we call it WCG. What is the meaning of WCG? See, you subtract the current liability, excluding bank borrowing, which is called non-bank liability. You subtract the non-bank liability from the current asset, you get working capital gap. How to calculate WCG? Quite simple. First of all, you write the current asset, then you write the current liability, and from the current liability, you subtract the bank borrowing, that is called CLOBB. So if you subtract CLOBB from current asset, you will get WCG. One more thing is that okay, so that is the mathematical part. Now what is the physical meaning of this working capital gap? Try to understand. See, part of the current asset which is financed by non-bank current liability, they are called working capital gap. Sorry, some part of the current asset, from where you are financing the current asset, some part of the current asset you are financing from the non-bank current liability, right? And the remainder requiring funding is called working capital gap. So we have to finance the current asset. Whatever asset we are acquiring, we have to finance that. From where we will get the finance? So one source of financing is the non-bank current liability. The remaining source of financing is the working capital gap. I hope that makes sense to you. That's why we subtract non-bank liability from the current asset to get the working capital gap. Entrepreneur typically finance a portion of the working capital through long-term fund, and that is called the margin. Yes, whenever you go to take loan, what bank will ask for? Bank will ask for a margin. What is margin? Margin is the amount of fund, amount of the working capital that you are getting through long-term fund or capital. So how to calculate the WCG? It is very simple. You subtract CA, that is the current asset, and from CA you subtract the CLOBB. Now the second terminology is the NWC. What is NWC? It is called net working capital. Means what you fund long term. So it is technically defined as the long term source minus long term use, representing the sustainable capital, right? So it is technically defined as long term source minus long term use, basically representing the sustainable capital, or we can call it current asset minus all current liability including bank borrowing. So bank borrowing are not excluded here, bank borrowing are included here. So current asset minus current liability is called NWC. Means what you fund long term, right? So basically I told you now. So what does NWC reflect? It reflects the margin, it reflects the portion of the current asset financed by the borrower long term fund. So current asset is an asset. Liability is further categorized into long term liability and short term liability. So asset is being financed by liability, it very well. So if the borrower is financing as current asset using long term liability, so that portion is called NWC or net working capital, because it is also called margin, because whenever you go to take the loan, bank will ask for your margin, bank will ask that you should contribute also, and that particular contribution which is taken from the long term fund is called NWC or net working capital. So remember, I hope it is clear now what is WCG and what is net working capital. So WCG reflect what I told you, that WCG reflect the current asset minus, we are funding the current asset. So some funding is being done by the some funding is being done by the non-current liability, and except those funding, whatever is remainder is called WCG. And second point, we talk about the NWC, which is the net working capital, means part of the ratio. What is current ratio? It is very simple. It measures the liquidity. It is simply the ratio of current asset to current liability. That's why it's called measuring the liquidity. Means it simply means that if your current liability is 1 unit, how much is your current asset? That is what it reflects, right? So suppose if the current asset is large, it means liquidity is there, right? So current ratio assesses the business liquidity. A ratio below 1 is generally viewed as unfavorable, right? Means per unit liability, how much asset you have, right? That is what current ratio. And if the current ratio is less than 1, it is a danger zone. And suppose current ratio is greater than 1, what does it mean? That it means we have an excess inventory. Obviously, we have an excess inventory. That is what it means. We have a larger current asset. That is what it means. So excess inventory means interest cost will be higher. And so what is the golden rule is that you should just keep enough stock. So you have to just maintain the current ratio somewhere near 1, greater than 1, not less than 1, right? If it is 2 more than 1, suppose it is 1.81, suppose it is 2, it means that you are holding more inventory, right? So large industrial projects often demand significant investment in both fixed and working capital, while trading firms may not require heavy fixed asset, but then they tend to maintain large inventory, and inventory is a kind of current asset. So basically depends, it varies from industry to industry. Some industry requiring large amount of fixed and working capital, while some industry like trading firm, they require inventory only. Service sector business might need minimum working capital but sustainable investment in fixed asset. Some loan extended for acquiring current asset, they are called working capital loan, and those loan which are acquired for fixed asset, they are called term loan. I think you know it very well. Term loan and working capital loan. So current ratio formula, you know it very well. Current asset divided by current liability. If it is below 1, it is a danger zone. The second key terms is DER, that is called debt equity ratio. So basically in the numerator we write the total debt, in the denominator we write the honor investment. We divide the debt by equity, this will give us DER. And good is below 2:1. So suppose DER shows how much of the business is financed by the debt in comparison to equity. See, there are two ways of financing the business. Either you take the debt or you take the equity. So how much debt you are taking and how much equity you are taking, that comparison is being made by. So when DER is good, DER is good if it is below 2:1, and DER is at risk if it is above 3:1. Right, remember it. Very, very important aspect. So DER is also called external internal equity ratio. It reflects the balance between external liability and shareholder equity. So if it is excessive debt relative to capital can disadvantage unit, making repayment of loan installment and interest difficult if profit falls short. Right. So that is the point. An optimal DER is generally considered to be 1:1. Capital intensive business may have a higher ratio, signifying ongoing asset maintenance financed by a borrowing, which can boost the return via greater production capacity. So working capital need for manufacturing is high fixed plus working capital. If it is trading, low fixed but high inventory. If it is services, low inventory but high fixed asset. So depending on the types of industry, if it is a manufacturing activity, if it undergo manufacturing activity, its working capital needs high fixed capital is more, and working capital is also high. Trading, low fixed but high inventory. Services, low inventory but high fixed. Right. So we are talking about the DER. So I told you 1:1 is the gold standard. Above 2.1 it is a danger zone. Capital heavy business, it can go higher if the asset boosts future income. Let's talk about DSCR, which is the debt service coverage ratio. What is the formula? In the numerator we write cash profit plus interest. In the denominator we write the loan payment. So basically it compare cash available for debt servicing to the cash obligation. What is the cash obligation? Cash obligation means loan. And what is the cash available? Cash available means cash profit plus interest. So basically it compare cash profit plus interest divided by loan payment. It shows the company ability to meet its debt payment, whether the company is able to meet its debt payment or not. That is what DSCR shows you. So basically if we talk about the lengthier formula of it, right, so we can write it like net profit after tax plus depreciation plus interest, right, on term loan divided by net profit after tax plus depreciation plus interest on term loan. So basically this is divided by the interest on term loan plus principal repayment, right. So NPT plus depreciation plus interest on term loan divided by interest on term loan plus principal repayment. That is called DSCR. Because depreciation is a kind of non-cash expense. That's why it is added to the operating profit to determine the actual fund generated. So basically we are trying to generate the cash inflow, and that particular cash inflow is the cash profit, and we are adding the interest on the term loan, and we are dividing by the loan payment. How? So basically loan payment, you are paying the interest component, you are paying the principal component. That's why in the denominator you will see interest and principal. I hope it is clear, right? So basically what it says that whether our cash inflow is sufficient to service our debt or not, right? So can you tell me what will be the ideal ratio? So the safer is 1.5:2. So when I say 1.5, it means it simply means for 1 unit debt with principal plus interest, we are earning, our cash is generating 1.5. So yes, we are profitable. So and if it is 2, it means for 1 unit debt that we have taken, our cash inflow is 2 times. So yes, it is still profitable, right? So sometimes confusion arises why we add the depreciation, because the depreciation is a kind of non-cash expense, and while we calculate the total cash inflow, we need to add it. And remember, on the DSCR, numerical questions are asked every year, right? So this is the point. So if high DSCR, bank will love you. If you have higher DSCR, so bank will love it, right? Ideal DSCR between 1.5:2. I think you know it. So one more point is that while evaluating a loan proposal, it is crucial to analyze both the overall and year-wise minimum DSCR to assess the debt service coverage capacity. So basically what I am talking about, DSCR acts like a profit test. You must show the yearly repayment capacity, and red flag if anything is below 1, it is obviously rejection risk is there. Now there is something called gestation period. So the factory rule says that no income during setup, and a smart move says that you should negotiate repayment holiday. See what happened, repayment holiday should account for the gestation period and additional time needed for the realizing the sale. So business owner, they are expected to invest a portion of the project cost themselves. This is called promoter contribution. You know it very well. So the golden rule is that initially the promoter contribution is 20 to 50%. Margin represent a part of the promoter contribution, right? In sometimes margin and promoter contribution are the same, but they usually differ. Promoter contribution refers to the total project cost, while margin is calculated for each asset financed by the loan. So promoter is a big picture. You are looking at the whole picture, right? It relates to the total project cost, while margin is about the individual asset. So one more point is that what is about the interest accrued. So whatever interest accruing during the loan repayment holiday, that has to be added to the loan upon the completion of the holiday with a fresh repayment schedule. This is called interest capitalization. So what is the meaning of interest capitalization? It simply means unpaid interest get added to the loan. Now there is something called IOI, interest only installment period. So it says that you pay only interest initially, like in the case of home loan. Many home loan offer such as holiday at the start. Then we have the IPI. What is IPI? IPI means it's called interest payment installment, interest principal installment. So borrower pay fixed monthly principal installment plus interest as it accrue. And then we have EPI or EMI. So borrower pay fixed periodic installment covering actual interest first, other due second, and remaining amount toward principal. Then we have PMI, which is called post maturity installment. So if the loan remain unpaid after maturity, it enter PMI stage, governed by specific rule and governed by the specific rate. What is bullet repayment? So in the case of bullet repayment, interest is paid monthly with the entire principal repaid in lump sum at maturity. So interest is paid monthly and the entire principal get repaid in lump sum at maturity. That is called bullet repayment. It means principal repayment happen at the maturity. Now one more kind of repayment is called balloon repayment. So don't confuse these two. What is balloon repayment? Principal and accumulated interest for the entire term are paid together on the maturity date. So friends, try to differentiate the bullet and balloon repayment. In terms of bullet repayment, I told you that interest is paid monthly with the entire principal repaid in lump sum at maturity, while in balloon repayment I told you, you pay nothing until final day. Right. Now friends, let's talk about SURF. What is SURF? So basically a step up repayment facility. So basically what happened, this is a kind of a smart option. Start small, increase with salary hike. That is called SURF, a step up, right? Then we have the flip. What is the meaning of flip? That is called flexible roll installment plan. So what happened here, start big, reduce as you age. Then we have the tranche based EMI. So which means, pay only on the use fund. It is great for under construction home. right? For under construction property loan, so suppose you take loan on the under construction property, so interest is paid only on the drawn amount until full disbursement. So pay only on the used fund. So whatever fund you have used, whatever drawn amount, so pay interest only on that until the full disbursement, after which the regular EMI begins. So this is how it works. Now we have the accelerated payment. What is the accelerated repayment? So raise EMI yearly to clean loan faster. Balloon repayment, I told you na, pay nothing until the final day. That is called balloon repayment. So I hope these things are clear. Now friends, let's talk about the telescopic repayment option. It allows extended repayment tenure up to 30 years, enabling eligibility for higher loan amount. Now let's talk about the bill finance. So bill finance is a short-term self-liquidating form of credit. Who are the three parties involved in the bill of exchange? So the first one is the drawer, who is the seller. Second is the drawee, who is the buyer. And third is the bank, who is the payee. Right? So three parties I told you: drawer, drawee and bank. Drawer is the seller, drawee is the buyer, bank is the payee. Right? Now bill of exchange are categorized as two parts: demand bill and usance bill. Demand bill, they are payable immediately like a check. And usance bill, they are payable after a set period. Then we talk about the smart financing option. So clean bill. What is the meaning of clean bill? So you know it very well. And one more point I want to tell you, that advance like supply bill, they fall under the bill purchase for administrative convenience, right? Demand bill is payable on demand or at site or upon presentation without a fixed payment date. So demand bill do not attract any kind of stamp duty. What is the meaning of clean bill? So that is called CDB, clean demand bill. So clean demand bill is an unsecured check or bill of exchange payable on demand purchased by the branch. That is unsecured, high risk. Then we have the secured demand bill, or we call it SDB. This is accompanied by document of title to good and is payable on demand at an outstation location. So clean demand bill, unsecured check purchased by the branch. Secured demand bill accompanied by documents of title to good and is payable on demand and also purchased by the branch. So bill financing form part of the overall working capital financing facility. So demand bill attract no stamp duty. It is a part of the working capital finance, and telescopic option, it is up to 30-year repayment. Remember it. Now let's talk about the railway receipt. So railway receipt, in the case of railway receipt, you know it very well that your shipping document could either make or break your loan approval. So if we talk about the railway receipt, it must show the goods consigned to the bank or the consignment order and endorsed to the bank to prevent delivery against indemnity. So you must name the bank as consignee. That is what I mean to say in the terms of railway receipt. Then we have the lorry receipt. So in the case of lorry receipt, only IBA approved format is accepted. IBA, Indian Banking Association, so they have a format and only IBA approved format is accepted. If we talk about the airway bill, you must remember that it is non-negotiable. Airway bill is non-negotiable, so it must address the bank directly. Then we have, let's talk about the instant rejection. So suppose receipt for shipment bill of lading, it will be instantly rejected. They are not acceptable. So bill of lading marked receipt for shipment, they are not acceptable. Accommodation bill or check, not acceptable. Remember. So third is the unapproved transport company receipt, not acceptable. So you can see that bill of lading marked receipt for shipment not acceptable for discounting. Post parcel may be addressed to the collecting branch or bank. Airway bill are non-negotiable. Good must be consigned to the collecting bank branch. Accommodation check bill are prohibited from purchase or discount. Lorry receipt from unapproved transport operator, it should not be accepted. So which things are not accepted, you must know. Receipt for shipment, bill of lading not accepted. Accommodation bill or check not accepted. Unapproved transport company receipt not accepted. And what are the danger zone? Perishable goods. Obviously risk automatic sale in 48 hours. For perishable good, transport operator, they may sell the good after 48 hours if unclaimed, notifying and accounting to the bank letter. And only accept, carrier risk lorry receipt. You must have full set of clean bill of lading. These are the points which you must keep in mind. Then one more point is, check or bill return. Let's talk about it. Suppose a check got bounced. You need quick cash. So these banking rule can save or cost you 1,000. So suppose immediate cash rule is that under 15,000 rupees, you get instant credit. So immediate credit up to 15,000 for outstation check should be granted automatically. Above 15,000, what happen? So it is, if it is immediate check or local check up to 15,000, it can be it can be granted automatically. But above 15,000 check, you must wait for clearance. So whether local or outstation check above 15,000, you must wait for clearance. If it is bounced once, you know what happened? Never accepted again. If it is once bounced, it will never be accepted. That is the point. Advance may be extended to the buyer of such commodity through purchase of bill backed by the document subtitle like liability receipt. One more point is the LDSB. LSDB. That is a loan secured demand bill. So usance bill, you know, this is the smart bill financing option. What is usance bill? That means you pay later, not immediately. What is LSDB loan? So you must repay within 21 days. So those commodity which are listed under the SCC directive, right? So you know, some commodities they are listed under the SCC directive. So you know, for them LSDB apply. So what it says that advance may be extended to the buyer of such commodity through purchase of bill backed by document of title like railway receipt and bill of lading. Loan or LSDB advance cannot be granted against the lorry receipt or for commodity under SCC directive. And you know, one more point is that this LSDB must be repaid upon arrival of the goods or within 21 days from the discount date, whichever is earlier. So whether discount date is earlier or 20 day goods arrive earlier or 21 days from the discount date, whichever come earlier, LSDB must be repaid. Means it is a kind of loan which you have taken, right? It must be repaid within 21 days. A usance bill is payable after a you know it very well that usance bill has a due date. It will be payable after that. So what we learned is that, you know, dividend or interest warrant under rupees 15,000 instant cash, and 21-day rule start from the discount date, not the delivery date. Remember it. Now let's talk more about the usance bill. So I told you, you must use a stamp hundi paper except 90-day banking transaction. So this is what I am telling you, that usance bill attract a stamp duty and must be drawn on the hundi paper with adequate stamp value, right? Two types of usance bill are there, DA and DP. DA means, you know, document against acceptance, right, which is a riskier because, you know, documents on acceptance, and DP, you know, documents on payment, which is a safer, right? So in DA, you know, documents are handed to the drawee upon acceptance of the bill. So basically drawee is one who accepts the bill. So I told you, drawer is the seller, drawee is the buyer. So the bill will be handed to the drawee upon acceptance. And in the case of DP, documents are delivered only after the payment of the bill. That is quite safer from the seller point of view. Now if we talk about the government perks, so in case of DA, you know, bill accepted, document handed. DP, right? DP, you know, once payment is made, then documents are given. So DA is unsecured, DP is secured. Now, you know, government perks. If we talk about the government perks, stamp duty is free for 90-day bill. So, you know, such kind of bill which are payable within 90 days, Government of India exempt stamp duty on such kind of bill. Promissory note does not qualify under it, right? So this exemption does not apply to usance promissory note. So this exemption that we are talking about, basically the Government of India is stamp duty free for 90-day bill, does not apply to the promissory note. And what does the RBI rule say? RBI rule say that big loan larger than 5 crore need 25% bill finance. So according to the RBI norm, borrower with fund-based working capital limit of 5 crore or more, right, they must adhere to the financing limit on inland credit. So what it says that they need big loan greater than 5 crore, they need 25% bill finance. That you can see with at least 25% finance through the bill of exchange. So what we learned is that clean bill, no collateral. Documentary bill, secured by good, right? So they can be drawn locally or they can be drawn attestation. DA, you know, unsecured. If buyer does not pay, and wrong stamp value, this will be invalid. The bill will be invalid. Now let's talk about the supply bill. So, you know, government contract, and this means delayed payment, right? So basically what is supply bill? You know, this is the kind of bill for government or supply contract. Means such kind of transaction involving the government and public sector entity. What are the supporting documents? Supporting documents includes delivery receipt or departmental acknowledgement. So e-way bill needed. If the good value exceeds 50,000, you know, in that case electronic e-way bill is required. You can see clearly written that e-way bill is required for transport of consignment good valued over 50,000. Now, if we talk about the bill financing type, there are three types of bill financing. The first is called bill discounting, which means, you know, for future date usance bill. Then we have the bill purchasing for immediate demand bill, and then we have the negotiation, which is done against the letter of credit. So there are three ways of bill financing. First of all, discounting for future usance bill, purchasing for immediate demand bill, negotiation against letter of credit. Two systems we have talked about, right? What are the two systems? Drawer bill and drawee bill. Drawer bill, what is drawer bill? So bank fund seller, and drawee bill, what happen? Buyer's bank guarantee payment. Two bill system I told you. Under the drawer bill system, bill are discounted or purchased for the seller and bank assessing the drawer credit worthiness. And in the case of drawee bill system, the buyer bank accept the seller bill on the buyer behalf and seller bank extend finance on the strength of the acceptance. So you should use drawable if the buyer has a better credit, and e-way will avoid transport hassle. Remember, these are the important points. Now let's talk about some kind of arrangement that we have. So what is the meaning of sole banking? In the case of sole banking, one bank handles everything. Simple it is, but riskier for lender. What is consortium? In the case of consortium, multiple banks share big loan. It is common rule for all. Then we have MBA. What is MBA? Multiple banking funding. What happened here? Different bank can fund the same business. Must declare all existing loan. No splitting division artificially. So in the case of MBA, basically borrower may obtain fund based or non-fund based facility from multiple banks without formal consortium arrangement. That is called MBA. You must declare all the existing loan. So when the borrower has credit from multiple banks, declaration about existing facility must be obtained, right? So that is the point. So then we have syndication. What is the meaning of loan syndication? It means lead bank manage the group lender. So there is a lead bank. Here also many bank combine to give loan, but here the role of the lead bank who manage everything, right? So it is based for massive project, more than 100 crore. So you should watch out for hidden fee in the multi-bank deal, right? This is a very important thing. So we have talked about the consortium, multi-bank arrangement, right? We have talked about consortium financing and sole banking, consortium, multiple banking, syndicate banking. These are the very, very important aspect. Now friends, one more important point I'm talking about is that syndicate of if we talk about how do mega corporation get $100 million loan. So the secret lie in syndication. What is syndication? So the key difference between syndication, consortium and lead bank is that in the case of syndication it is global and multi-currency deal, while the consortium is local. It is quite local and single currency funding, and lead bank may lend $0 but earn big fee. So lead bank they may earn nothing, but they earn big fee. Now how syndication work? Let's have a look. What happened? One bank become matchmaker. They prepare the deal document. They recruit other lender. They take 1 to 2% fee. Right. So the one bank who is basically called lead bank, they become the matchmaker. They prepare the deal document. They recruit other lender. They take 1 to 2% fee. Right. So let's talk about the power dynamics. So I told you lead bank control everything. All banks share risk, and you must review the information memo before joining. These are the important part. Then if we talk in the context of consortium, consortium, what happened? If the loan is 150 crore plus, so it required JLA. What is JLA? Joint lending arrangement. That is called JLA. So you can see JLA. What is JLA? Joint lending arrangement is required if the loan amount exceed 150 crore plus, as you can see. So here a single borrower with aggregate credit limit of 150 crore plus, they required JLA. So in this case multiple public sector bank come together, and this is the biggest lender lead. Yes. Then we have LSDBC, that is called loan system. That is loan system for delivery of bank credit. So what it says that 60% must be term loan. So it applies to borrower with fund-based working capital facility of 150 crore or above. For such borrower, at least 60% of the credit must be in form of loan. Right, this is a very important aspect. And there are some exemption which is given to the seasonal business. Right, seasonal business, cyclical business, volatile activity. So those kinds of firms having 150 crore plus working capital, so their 60% of the federal fund must be in the form of I told you they must term loan, right? 60% must be term loan. So if it is a single entity, remember banks see all division as one. If it is under 150 crore, then they can still opt for JLA voluntarily, right? These are the important points. Now let's talk about the credit appraisal. So what we have just discussed, DSCR, I told you, debt service coverage ratio, it must be greater than 1.5, right? Then we discuss, DER, debt equity ratio, ideal is 1:1, right? Then 5 lakh plus loan, mandatory cash flow. Now there are some methods. Then the question based on these methods are asked every year. So how to do the working capital assessment? So we have the MPBF method, we have the turnover method, we have the cash budget method. In the MPBF and turnover method, sales accepted for eligibility is based on submitted estimate and projected sale. Turnover method is all about NIC committee method or projected sale method. For established business, future sale projection depends on the past performance, capability and market condition. Right. The turnover method uses accepted sale as the basis for calculating the permissible bank finance, and the MPBF system calculates permissible finance by assessing the current asset and current liability related to the accepted sale. What is the meaning of accepted sale? Accepted sale is based on submitted estimated and projected sale alongside actual balance sheet of the past 2 years. right? So turnover, calculate accepted sale as the use accepted sale as the basic for calculating the permissible bank finance. So turnover method, it was recommended by the PR Nayak committee and was reviewed by the VAJ committee. What happened under the turnover method? It says that working capital limit are set at 20% of the bank accepted provision gross sale, maintaining a minimum margin of 5%. So 5% contribution should be done by the whom? It should be done by the borrower, right? That is the turnover method. Turnover method is easy. It says that get 20% of your annual sale as loan. For MSME 5 crore, for trader 2 crore, and minimum 5% margin from your pocket. So if the available net working capital exceeds 5% minimum margin, it is considered in determining the bank finance. So it applied to MSME, it applied to non-MSME, MSME up to 5 crore, non-MSME up to 2 crore, trader, merchant, exporter, other without up to 2 crore. These are the point. So eligible fund-based credit limit under this method are computed at whatever annual sale you have, calculate 20% of that, and you can get 20% of the annual sale as loan, right? That is called working capital limit, and you have to give 5% as the margin, 5% of the total sale from your pocket. That is the margin. Okay. Then the so it is where it is applicable. I told you for MSME up to 5 crore, non-MSME up to 2 crore. And one more thing is the MPBF method. So Tandon committee, 3 methods are there: first method, second method, third method. So the formula is Tandon committee method is formula is asset minus 25% margin. So in the Tandon committee second method, it says that borrower must provide a margin of 25% on the total current asset, and MPBF is total current asset less the margin, right? So that is what MPBF is. So asset minus 25% margin. That is Tandon second committee, Tandon committee second method, and Tandon committee first method. What does it say? So in that case, 25% of the WCG, not current asset, WCG, working capital gap, right? So first of all, you have to calculate the WCG. How to calculate the WCG? Current asset minus current liability other than bank borrowing. Apply this formula to get WCG. Calculate 25% of that. So that's 25%. You have to subtract, and that is your margin. That is your margin, right? So margin you have to subtract from the total the asset. Then only you get the MPBF, maximum permissible bank finance, that bank will finance. So total current asset, and in the case of second method, you can see total current asset minus this margin. Margin is almost 25% of the current asset. And you know it very well that Tandon second method require a minimum current ratio of 1.33 with a specific relaxation allowed as needed, right? So that is what I am talking about. I think this is a repetition. Just now we have talked about all these aspects. Yes. So now who wins? So for manufacturer, use Tandon method, right? For manufacturer, use Tandon method. For trader, prefer turnover method. So if existing net working capital is larger than 5%, get better terms. So remember, MPBF method applied to fund-based working capital limit for MSME above 5 crore, non-MSME above 2 crore, within 2 crore and 5 crore. Turnover method is there. Above 2 crore and 5 crore, MPBF method is there. And for limit exceeding 25 crore, borrower may choose MPBF or cash budget method for assessment. And 10% tolerance is allowed on the assessed MPBF. I hope that makes sense to you. Now friends, that is what we have discussed just now. Now let's talk about the cash budget method, which is a kind of seasonal method. So basically it is based for tea, sugar, cyclical industry like software, construction, tea, sugar. So what it tracks, it tracks the monthly cash gap. It tracks monthly cash gap, right? And the key difference are that there are something called positive NWC, negative NWC. So if the positive NWC, it means asset is larger than liability. If it is a negative NWC, it means danger zone. And turnover method usually have 1.25 ratio is the best. That is the point. Now let's talk about the next point that we have. So the 5C that the bank check. What are the 5C? Credit history, repayment capacity, available capital, loan condition and collateral. Character, capacity, capital, condition, collateral. Character means credit history. Capacity means income versus EMI. Capital means your saving or investment. Condition means loan purpose. Collateral means security backup. So these are the 5 things that bank check before sanctioning a loan. So hidden risk type are default risk. You know it very well. Default risk means you are not able to pay the EMI. That is default risk. Downgrade risk. What is the meaning of downgrade risk? Suppose your credit score drop. That is downgrade risk. Then we have the concentration risk. So all egg in, you are putting all egg in one basket. That is called concentration risk, right? Institutional risk. When legal framework failure or issue with regulatory entity, that is called institutional risk. Who manage this risk? So there is a board of director who have the final responsibility. There is a risk committee who set the policy, CRM department who daily monitor it. So the pro tip is that you should keep debt to income less than 40% and you should diversify your income source. Remember, numerical based questions are being asked on the chapter of this MPBF and turnover. So make sure that you practice enough question before the examination. Now friends, there is the 4 decision layer. What are the 4 decision layer? The first is the board of director, right? So he set the risk limit. Second is the risk committee who balance profit versus safety. Then we have credit policy committee who make the loan rule. And finally we have the CRMD. Who is CRMD? CRMD is the police auditing every loan. How they judge you? They judge you based on the default risk. Will you pay back? Spread risk. Does your rate cover the risk? Portfolio risk. Are loan too similar? Remember, one bad sector will cause loan rejection for all in it. So your loan is stress tested against the economic crisis. So friends, let's end our discussion here for the module A. We will cover the remaining. If you think that it was really helpful, please write yes in the comment section so that I can bring module B quick revision also if it was really helpful for you. And if you want such kind of PDF, you can WhatsApp me on this particular number.